ICI 26-27. I am CA Jain, Regional Council Member WRC of ICI, heading the PR Committee and Hostel Committee, and as a Vice Chairman, Capital Market Committee and Internal Audit Committee. So please give the greater applause of the impactful, dynamic, vibrant, youngest chairman of this council, none other than CS Saurabh Ajmera ji. Welcome you, sir. We recognize the presence, the welcome of the past chairman, our mentor, senior BM Agrawal sir, and the inaugural team, the speaker, the CA Darshana Jain madam, and the inaugural team speaker of the day, none other than CA Sudha Bhushan ma'am. I request all speakers and dignitaries come for lighting of the lamp. I request Chairman Saurabh Ajmera sir join the dais and escort the past Chairman BM Agrawal sir on the dais. I welcome on dais Sudha madam and Darshana madam. So please give the great round of applause for each and everyone, the speaker of the day, the inaugural officer of the day, in each and everyone. We welcome you all. So, everyone in the FEMA practice? Everyone specific domain in FEMA practice or just? Good. So, very good morning, one and all. Once again, we welcome you all with this. I request play the ICI motto song. Everybody please rise up.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Thank you, members. So in this WRC of ICI, we have the theme as impact. We welcome our impactful dynamic chairman for back-to-back program this year. Members want to enlighten you that the more than 138 programs today there in his able leadership. He completed 140 or 139 day today, and 24/7 our chairman and all office bearers doing the very hard work. Kudos to you and give the great applause for impactful dynamic chairman. And I welcome you, CS Saurabh Ajmera sir, for opening remarks.
Good morning, one and all. I believe on Saturday morning in this rainy season, you all are here, so I can expect little more energy from your side. Good morning, dignitaries on the dais, our past chairman, a person who is known for happiness. In our circle, I can say CABM Agarwal sir, who is always motivating us to do more and more good programs, more and more activities at WRC. And my regional council colleague, CA Vijender Jain, again a very energetic personality who always believe into networking, engagement, connections, and that is much needed in a current era. Friends, we do have Darshana Jain madam with us, our inaugural speaker, and we do have a special presence of CA Sudha Bhushan ma'am, as she is the one person who is the designing all these programs at WRC. She is the architect of this wonderful conference, 2 days conference, I can say, on FEMA. And definitely through this conference we are going to learn so many stuff which is much needed for our profession. And I requested her also that keep doing such program on WRC with more and more engagement and hands-on experience where we can provide intuitive experience to all our participants. So let's have a big round of applause to welcome all our speakers and guest of today's inaugural session, CABM Agarwal sir. And most importantly, I like to have a big round of applause for each one of you, as on Saturday morning you all are here to take knowledge. Let's have a big round of applause for each one of you. The kind of motivation, encouragement you have to take more and more new updates is really a backbone of a profession in which we are serving. Because nowadays, wherever we are going, everybody is asking that our profession is going through a transformation. But I want to highlight that our profession is not going through a transformation first time. In the history also, we have seen big developments in our country, and from the inception of 1950 regulatory environment in our country, more than 400 act has been enacted into parliament. Out of 470 to 80 acts were directly related to chartered accountants and the economy of our country. And in all such type of development, we were together with our government to apply all across the nation an effective use of such type of regulations. So we are known for the updates today, be it in an AI environment or you can say ESG. There are a lot of things through the technology which is changing very rapidly. But our profession is known for the best update and best professional delivery. And that is why I must appreciate the efforts of our institute that we have already trained more than 52,000 chartered accountant in AI space. We have already trained through the 900 approx batches in AI, and very soon we will definitely organize a big program for 1,000 batch of AI. And now we are extending help to other stakeholders. So today also at the Judiciary Academy at Uttan, we are extending our helping hand to IT members. We are providing AI training to them. Similarly, we are providing AI training to all the corporates. Those are needed. All the stakeholders, be it government or private sector, we are helping them to pace with the rapidly changing environment. And today's topic is also very important, in which we are going to discuss about the FEMA. Believe me friends, in this transformation journey, India is the fastest growing economy of the world, I can say. And today we are standing at $4 trillion economy size. And when we are looking upon the intent of the government, they want to achieve 30 to 35 trillion economy size by 2047. And in this journey, if a profession can be benefited for this transformation, then I can say we are the most prominent profession which can participate in the growth journey of our country. And a topic like FEMA is also very important, where we want to assist in the regulation which is related to foreign exchange and which is much needed for a powerful economy. And believe me, friends, when I was traveling to Japan in last month for our international study tour, we had a wonderful discussion with the Japanese stakeholder. And the highlight related to 2 points was very, very interesting and which is very near to my heart also now. They have said that whenever we are looking for any further development in India or nearby territory, the first person which came in our mind is the trusted advisor, chartered accountant from India. And the kind of feedback they have given for our fraternity is really motivating, because they might be a developed country, but they are now looking upon India for the further development, further expansion. And why? They have said that in Japan, we have an average age of working around 59. As well as in India, we have an average age of only 29 years. And we are the youngest population amongst the world. And this is the backbone for again a wonderful economy which we want to see in 2047. And that is why they are also looking upon to the India for their setting up of manufacturing, service hubs, and they are very, very positive. And that is why I generally say, बड़ी दूर से आए थे, बड़ी दूर जाना है, बड़ी दूर से आए थे, बड़ी दूर जाना है, हमें हमारे स्वर्णिम भारत को विकसित भारत बनाना है, विकसित भारत बनाना. That way, definitely, we can take participation in this wonderful journey, and I am very happy to say that I am representing such a great legacy of WRC into the 75th year. I am the 75th chairperson, and this year we are celebrating Platinum Jubilee with the 75 initiative at WRC, and we have already launched all our initiative on 1st July. We are working on that, and definitely where we are looking for more and more engagement from your side, and through all the initiative we want to create an impact on our fraternity, which is very, very important. When we are saying impact, start with innovation. And in all our programs, you can feel innovation, because we are targeting more and more intuitive knowledge sharing. We are targeting to have programs like Family Office, AIF, CXO Roundtable. We have done program on GCC Conclave. We are providing workshop for business modeling and valuation, startup. Now we are coming out with workshop on AIF also, only for the 40 to 50 people. And believe me, friends, the kind of engagement we are creating through innovation is really important for our profession in the current era. Then we are striving to change the mindset of our members. M stands for mindset, because we believe that we have to focus now more on consultancy and value creation rather than on compliances. So whenever we are organizing program, we are trying to keep the stuff which is more related to value creation. And in the automation, definitely all the compliance will be automated. So we are not highly focused to share the knowledge on the compliance part. But value addition, definitely we all have to strive. We have to change our mindset. In this context, I want to say that who was the main character in the Mahabharata? Anybody can say? Krishna. And that is why I invite all my members to become Krishna and identify your Arjunas. They can execute their work, and that mindset we have to change, because we can be on a strategic role in our firm, but we have to invest in the future generation. And then only value addition, value creation, and the something material thing which is for which we all are striving can be achieved. Then friends, we are part of ICI, which is very, very important to know that we are expected to deliver highest professional delivery amongst the stakeholder, and that is the expectation from the stakeholder. And that is why we are doing so many workshops to empower all our members to accelerate our profession in a different way. Then adaptability is one of the things in the impact which is very, very important. If today I ask you that how many of you are using AI, 90% of chartered accountant will say yes, we are using some of another tool for AI. But before 2 years, if I should ask you, then probably only 10% of the chartered accountant were using AI. So this is the adaptability approach which we have. We always known for the update, and that is why WRC is targeting to have more and more updates through the professional journey, because we are expected to deliver something extraordinary amongst the stakeholder. Earlier in 2017, GST came into picture, Now in 2025, new income tax act came into picture. So whenever we say that traditional practice are no more relevant, God is great. They are giving opportunity to us to serve more and more with the participation of our country. And that is why adaptable approach is really important, and we are sharing all the knowledge on this. Most important thing of this theme is collaboration. And believe me friends, we are in the era where we have to make some collaboration for our professional engagement. And that is why WRCs came out with two important initiatives. One is CN Access and another is WRC Corporate Setu. So in CN Access, we are inviting all the proprietors, all the small partnership firms. Those are looking forward to have a collaboration. We are creating a database, and this is available on WRC website also in the initiative tab. And I'm very happy to say that in last 143 days of my chairmanship, we have received more than 100 applications in the CN Access. Those are looking forward to have a partnership collaboration. And this is aligned with the country's leadership also. When Honorable Prime Minister Narendra Modi ji said that we like to have more and more big firms, then this initiative came into picture. And we are definitely expecting very soon to cross 500 entries in this CN Access, and then definitely we will organize a wonderful physical program where we will provide interface amongst all the expected partners, you can say. Those are looking forward for collaboration, and we will invite big firms, small firms, proprietorships, all can engage, and they can create something big for which we all are waiting. And friends, in general, we have an impression. When I was entering into council, I was having a group of 25 to 30 people, and out of which 90% were in industry. When I said I am contesting for the election of WRC, they said, what is WRC, what is ICI is doing, what is the election? So our members from the industry is least connected with WRC and ICI, that is our alma mater. And that is the problem statement for which we are providing solution through the WRC Corporate Setu, a wonderful initiative in which we are targeting more and more footprint from the industry. We are doing some program which is need of them. We are inviting applications from corporates also. So we have received invitation from LIC also that they like to have one programs under the banner of WRC for their chartered accountant. And through this initiative, we can create a footprint of members in industry which is representing 70% of our population. So we have to understand their role also. Then accordingly, we can have a thought that what we are and what we want to be in future. So this is really a great initiative in the collaborative approach. Then friends, transformation, I already highlighted that we have to transform our practices also in the journey of 4 trillion to 30 trillion, which our country is intending. And today we are the pharma capital, we are the software capital. And I can say wherever we are going, we are feeling vibe for our country. And the way our economy is growing, definitely we can have more and more opportunity for our profession. And that is why generally I say, हमने जमी पे घर बनाया, हम जन्नत में रहते हैं. हमने जमी पे घर बनाया, हम जन्नत में रहते हैं. हम बड़े खुश नसीब है कि हम भारत में रहते हैं, भारत में रहते हैं. And that way, definitely we can participate more and more such initiative. Market on Monday, again a wonderful opportunity to understand the financial market. And then Sustainable Sunday is having an object to giving back to society, in which we are discussing about the carbon credit, ESG, we are doing some physical activity also, blood donation, cleaning of sea, these types of initiative we are taking care. Since we are into 75th year, we have come out with 75 impactful initiative which will be placed in the upcoming 7 to 8 months. With these, once again I welcome you all, a very important and another exciting program on FEMA at WRC. Thank you so much.
Thank you so much, Chairman, for enlightening us. So before listening the speaker, let's welcome the past chairman, the mentors of us. And I think BM Agrawal sir एक ऐसे शख्स है जो बच्चों में बच्चे, बड़ों में बड़े. I think कोई भी सीनियर चार्टर्ड अकाउंटेंट ऐसा नहीं है या कोई भी यंग सीए नहीं है जो उनसे कनेक्ट नहीं है. With this, we welcome you, sir, on dais to blessings, and I request BM Agrawal sir, past chairman, to address the audience.
Dynamic chairman and visionary Saurabh Ajmera, my good friend and regional council member Vijender Jain, again a very good friend of mine Sudha Gupta, learned speaker, and Darshana Jain, who belongs from my own village. And it is a lucky that today we met and I came to know about Darshana's background. And my all dear participants, I welcome all of you on this occasion of FEMA seminar. Always it is seen that the chairman takes an initiative where really something for the profession better, not only for the profession but for India. Now world is changing and we should know all the regulations, all the act, so that any person, any businessman should not suffer any penalty or violation which may be unintentional. And that's why the CA always guide to those people. We got also responsibility when you issue 15 CA, CB, etc., that we should know the act very well. And this learned speaker will tell you how and to deal with those issues which comes into your day-to-day journey of profession. And that's why all speakers has been made accordingly. Chairman has also told that now the world is changing, the India is also changing, and AI has become a very important tool. He has already made 52,000 members has learned, and so many thousands of batches are there. I think with the institute's all program, you will be benefit in a much in a professional journey. And with this, I will not take your much of time. All the best to all of you and for success of this seminar. Thank you very much.
Thank you, BM Agrawal sir, for kind words. And with this, I request Chairman sir to give the memento to the Darshana Jain madam. And Darshana Jain madam is a partner in BSR Associates LLP, affiliate with the KPMG, 19 years of experience in corporate international taxation, FEMA, regulatory advice. She specializes in cross-border transaction, RBI approval, foreign exchange laws, and complex tax matter, representing leading multinational companies before tax and regulatory authorities. A dual qualified chartered accountant, India, England, Wales, she is widely recognized for her expertise in international taxation, regulatory compliance, and strategic business advisory. With this, we welcome the speaker in front of the audience. I request Chairman sir and all dignitaries to. Chairman sir, for you, you are taking so much pain 24/7. हौसलों से उड़ान होती है, इरादों से पहचान होती है, नेतृत्व वही करता है जिसकी दुनिया में सोच महान होती है, जिसकी सोन महान. Over to you, Darshana madam.
Can I move the slides with the... हाँ, इसमें चलेगा. हाँ. Thank you. Good morning, everyone. Thanks to Chairman Sir, past Chairman, and Mr. Vijay and Mr. Sudha ma'am for the fantastic introduction. And actually very thrilled to, get the roots from Mr. B.N. Agarwal, what I have been sharing. In fact, I would say it's a privilege to kind of be in this session with the distinguished gathering of all the professionals. And my sincere regards to ICICI for kind of curating this comprehensive FEMA session. And all the topics have been very well thought through, be it overseas direct investment, be it foreign direct investment, external commercial borrowing. Let me tell you, all these regulations have undergone a change last 1 to 2 years. And this is the ideal best time for all of us to learn, relearn, and kind of understand what are the intricacies in each of these regulation. Before I start with the session, I would just like to talk about the journey of FEMA, right? We have 1973, when we have a very draconian law called FERA. That point in time, there was just one statement, don't use foreign exchange. Then came 2000 Foreign Exchange Management Act. Okay, you can use it, but please follow the rules very strictly. The day today now we are standing, it's a liberalized version of Foreign Exchange Management Act. It says that you can freely use the foreign exchange, but be in the spotlight. We are going to strictly monitor you wherever the compliances are not in place, right? With this background, I would say we have moved from control to permissibility to strict scrutiny. And if I have to say, okay, the law has been liberalized now, but it with liberalization with accountability, right? Today, I'm going to talk about overseas investment framework, and my endeavor would be to simplify this regulation, try to give relevant experiences, insights to make it more practical. What I'll do is, before jumping into the overseas investment framework, let me just talk about a little broad framework of FEMA. FEMA is less than 50 sections, the act itself. I would say if we have to learn FEMA, it's not about learning the law, but it's about learning the intent of this law. That's very important, right? Everything is governed by rules, regulation. The rules are notified by central government. The regulations are notified by Reserve Bank of India. Then we have this APDR circulars which keep getting issuing by the regulators based on geopolitical development, based on various other financial development. And the consolidation of all this APDR circular is nothing but a master direction. We also have FAQs, which kind of, being put up on the RBI website, which clarify all the basic queries, whatever is there, routine queries, to make the intent really clear. And last but not the least, there are various press releases so far as foreign direct investment is concerned. So this is the broad framework. Anybody entering into a cross-border transaction, I think this is the base. And all this thing is very well updated on the RBI website. We don't have to refer anything else. I think this is the first step. If at all we need any clarification, we should visit the website with all these clarifications. Okay, let's understand quickly. FEMA is divided into two types of transaction, capital account transaction and current account transaction. When I say capital and current, this is not what we understand in the accounting parlance. Capital account transaction is generally prohibited unless not permissible, and current account is a vice versa, generally permissible unless not prohibited. And few of the examples of capital account transaction, the topic what I'm going to cover today, overseas investment, foreign direct investment, we have external commercial borrowing guarantees, and on the current account side are our trade transaction, import, export, etc., including all the current account remittances like dividend, interest, royalty, FTS. So basically, this is the background of whole the FEMA structure. Accounting terms are not relevant. When in doubt, please refer to circular, notification and rules. So I thought that, for the benefit of everybody, this is little general background before we dive into the main subject. Let's understand what's happening recently. These are the recent news article in terms of aggressive monitoring of overseas investment, right? And this all news articles are last 1 year. In fact, the few recent one over last 2 months. What has happened that in August 22, the entire overseas framework has been revamped. Now, when it revamped, the idea was ease of doing business, global expansion, liberalization of many definitions with the clear intent, etc. Same time, the message from the regulator was very clear, has to be strict discipline in terms of the compliance. Now, one most noteworthy change was brought in this regulation that if at all there are any pending reporting compliances which are pending to be regularized, your future investment from India cannot be made till the time these are not getting regularized. This is the provision in the new regulation. Now, many of the companies, knowingly, unknowingly, not aware of the law, probably would have missed out all these compliances. But let me tell you, ignorance can term to be expensive, if at all, because it can stop the deal, it can stop future remittance and things like that. Also understand what's happening now in the West Asia war, right? Rupee is depreciating, a lot of dependency on the dollar. There is a strict instruction from the government to RBI that you have to keep a special focus on any penny going out of the country. And the major target would be overseas investment. And the strict monitoring is not only on the any remittance, including the strategic remittance. So the regulators have instructed all the AD bank, even in a case of a fresh remittance, which is a strategic remittance, you need to check, you need to have a step ahead in the supervisory. What is the kind of remittance? What is the source? What is the kind of ultimate beneficiary ownership? Is it bona fide or is it merely a wealth planning or a capital transfer? All this thing has been strictly monitored, strictly monetized. We can't even think the kind of resource the regulators have in their access because of course the technology, the AI and various things like that. So I think it's very important before making any global investment. I think there are three strong pillars. The first one, of course, the business strategy. Second is robust governance. And last but not the least, uncompromisable compliances. I think these are the three broad pillars of all the news articles what we have been reading. Another interesting development is in the case of ESOPs. Now what is ESOP? Employee stock option scheme. We have been seeing that many Indian employees, they receive the ESOP as an incentive plan of an overseas company of the Indian subsidiary. Typically, we believe it's a normal casual transaction, but the regulators, when I say regulators, both Enforcement Directorate and RBI, through their intel, have collected dozens of companies where these structures have been set up to whitewash the undisclosed funds. So typically what happens, maybe a company float a ESOP scheme, it issues the ESOP free of cost to the employee at a particular value, which is a very low value. That particular employee, after a particular point in time, say 1 year or 2 years down the line, sell those ESOPs and get a huge funds. So all the undisclosed income which are taxed overseas come into the country with the payment of a small tax. And when I'm saying this is not only the kind of a statistics, but the real situation where Enforcement Directorate have already issued the notices to many of the companies. And few of the companies are also the known ones, the branded ones, right? Now, because of this, what has happened that even the genuine ESOP structures have come under the aggressive monitoring. When the ESOP gets issued, the reporting requirement is on the Indian company. Let me tell you, most of the company over last 2 years we have seen, basis our experience, many of the Indian company have missed out filing of ESOPs being issued to employees of the overseas parent. Now the bankers have started kind of issuing the notices. They have been kind of investigating why this have been not filed. It is leading to a lot of time consumption, etc. Another important area what Reserve Bank have been kind of monitoring this whole ODI, they have started issuing the surveys. Now this survey are very well curated with the kind of questions they have been asking. The general perception of any company having overseas investment, it's a general question, I will reply and just get done with it. But believe me, these are all very intelligent questions. This is the base to gather the data for the regulators to kind of understand whether there is a bona fide, is there a complex structure, is there any tax planning, what are the underlying valuation. So it's very important, and these surveys have started being issuing since last 2 to 3 months in most of the companies which has been receiving the ODI. So with this context, we have understood how complex and important overseas investment framework is. We will understand the new framework in August 22 have been introduced. This supersedes the erstwhile regulation FEMA 120 and the Overseas Immovable Property Regulation, which is FEMA 7R. Now this regulation has a 3 baskets. Generally, any regulation before this was notified by Reserve Bank of India. Here the rules are notified by central government. It will monitor all the non-debt instrument, which is your equity, CCPS, and overseas portfolio investment. Then there are regulations which are issued by Reserve Bank of India. This will regulate all your non-debt instrument and non-fund based, which means loan and guarantee. And then it is also, Reserve Bank of India is also going to kind of take care of all the reporting and the administrative processes, right? Last but not the least, the important part here, what happens to the transaction which were kind of undertaken under the erstwhile regime, FEMA 120. So all those financial commitments structured are grandfathered in the new regulation. But important point is all those kind of transactions have to be compliant. Then it will get grandfathered. If those transactions are not compliant under the erstwhile law, it will be under the compounding process or penal consequences. So that's the very important provision in the new framework. And last but not the least, similarly, because of the individual who can invest overseas under the liberalized remittance scheme, we have a detailed session to be covered here, but that particular regulations have also gone phenomenal changes. So this is the crux of the regulation, what we are going to discuss further. Let's understand some key concepts. What had happened under FEMA 120, there are 2 kinds of investment. Overseas direct investment, which is a strategic investment. Large corporate houses would want to expand their business footfall outside India. And then there is a portfolio investment, which means there is a no strategic kind of investment, but you just want to invest in a company to get a benefit out of that sector. Now, in the erstwhile law, there was no category specific definition what is overseas portfolio investment called as OPI and what is overseas direct investment, which we call it as a ODI. All these definitions have been now clarified in a clear language to kind of avoid all the confusion. So overseas direct investment is any investment by an Indian company or a resident individual in unlisted shares. Even 1% of the investment you make, it could be construed as a strategic depending on what the percentage, what the bona fide reason is. Also, subscription to Memorandum of Association is construed as a ODI. And if you invest in a listed entity more than 10% with the control, then it is also kind of a ODI. Second basket is about financial commitment outside India. When I say financial commitment is, investment in addition to the equity, these are in the form of loan or a debt and a guarantee. Guarantee is basically a non-fund based kind of a investment. And I'll tell you, guarantee, a very interesting example I would like to cite here. Generally, this whole thing, there is a limit of 400% of the financial commitment what we can invest outside. One of the listed cement company in India acquired another cement company under IBC. Now, they did all the diligence of the acquiring company in terms of, the financial commitment was by way of loan, guarantee, etc. Everything, they checked the form, everything was there. Later on, there was an evocation of the guarantee related to the erstwhile or the entity which was acquired. Now, that point in time when the guarantee got evoked, the bankers looked into the agreement, the guarantee was open-ended. So what happens under the ODI framework, guarantee has to be a clear, decided period, it cannot be open-ended. Then there was a penal consequences on the successor company. This listed cement company said that why we have to bear, all these consequences because this was undertaken by the erstwhile company. But the regulators see who is the successor. They said that you should have done your due diligence. This small mistake actually led to a huge penalty on the surviving entity. So, these are the smaller nuances. And I personally believe that what is important is just not to look into the regulation, but what is the expectation of the regulatory in terms of the real business scenario. That's very important. The third basket is the overseas portfolio investment. This is investment other than ODI, investment in a listed debt instrument and the deemed OPI. Now, there have been certain definitions which have also been clarified, which were earlier not clear in the law. So what happened, India, typically the understanding is when we invest in a company, it's an equity instrument. But that is not the case in the host country. It could be LLC, it could be LLP. Every point in time, there is no equity, there are different instruments. So now the definition is very clear that any kind of perpetual instrument which is redeemable into a compulsory convertible equity shares, or technically I would say not irredeemable, but it should be a compulsory convertible, then all those instruments will fall under the definition of equity. Earlier it was creating a lot of problem because many a time when you go to banker and you say that the investment is not in equity but say some notes, some kind of a notes which are perpetual in nature, they were stopping the investment. So this definition has now been clarified. Second important definition is the term foreign entity. Under the erstwhile law, foreign entity was like a JV or a WS. Simple definition. Now again, many a time what happened that, the entity when it is in India, okay, it is incorporated, but in overseas it could be formed, registered or incorporated. Now the definition is very clear that all of this will be termed as a foreign entity, including the entity in IFSC, and the liability has to be a limited liability to the extent of your capital being contributed. Another important definition I would like to talk is about the control. What is control? Control is basically, the power to appoint majority of the director or have a stake in management decision, which will give you a right because of your holding in the company of 10% and more. And why it is important? Earlier, many Indian companies used to invest, say, capital up to 1%. 90% used to be a debt. Now the regulators feel you need to have your skin in the game. You have to have a control. You have to have minimum 10% of the investment by way of a equity to be eligible to grant or make further commitment by way of a loan. So for example, company A in India has invested in company B in Singapore. Unless it invests more than 10% or maybe 10% or more, it cannot grant a loan. That's the basic requirement. and also not only loan but including giving of the guarantee. So this definition has been introduced more so to kind of develop the bona fide and the rationale why you want to make a strategic investment. And the last definition is statutory and step down subsidiary of a foreign entity, which means the foreign entity has a control in that entity. I'll tell you why this is important. Just to extrapolate the example what I gave, company A in India has invested in company B 10%, so it has a control. So for example, company A wants to give a loan to company B, it is eligible to give. Imagine there is a company C under company B. Now can company A give a guarantee to company C? Yes, because for the non-fund based, now the liberalization is if the Indian entity has a control at the first level, which it does, then the Indian entity can give a guarantee to a step down subsidiary. So this is also a very important development, because earlier what used to happen, this kind of provisions were not available. Even if an Indian entity have to give a guarantee to a step down subsidiary, there was a requirement of equity investment. So quite welcome change, and I think all these changes are focusing on the way of business we are doing globally has changed. So we need to adapt to it, but same time there has to be a strict compliance focus. Let's understand what are the limits for the overseas investment. It's 400% of the net worth of the Indian entity, or it could go maximum up to $1 billion in a financial year. Now the definition of net worth, again, it was not drafted very well under the erstwhile law. It says that it has to be as per the Companies Act. So for example, the share premium, whether it need to be included, not to be included, it will get included under net worth. So that is one of the important change. And when we say net worth of the audited balance sheet can go back to 18 months when the transaction has to be or the commitment has to be made. So you can go back to 18 months of your audited financial to check your net worth and then make the financial commitment to the extent of 400%. One of the most important development which I told in my opening speech, the concept of bona fide. Every time we have been hearing that all the transaction has to be bona fide. Now the law has defined what does bona fide means. It says that any activity which is permissible in India, and it doesn't say or, it says and, same activity permissible in the foreign jurisdiction. So what does that and mean? Say for example, in a foreign jurisdiction, dealing in crypto probably might be allowed. Does that mean if it's a bona fide in the host country, it is bona fide in India? No. Currently in India, there is no law to govern the cryptocurrency, and hence the activity has to be bona fide both in India and outside India to make a overseas investment. So they have again tightened this kind of definition to avoid any investment which is not bona fide. They have also defined and clarified the net worth criteria in terms of LLPs and the partnership. And most important thing is, earlier under the erstwhile FEMA, what used to happen, say for example, I am company A. I need to invest overseas, but my net worth is negative. Under the erstwhile regime, I can borrow the net worth or utilize the net worth of my holding company or my subsidiary company. That has been done away with. Now the company A can invest only if it's on a standalone basis, have a positive net worth. It cannot take recourse or utilize the net worth of the holding company and the subsidiary company. Certain restrictions which are quite common, these are same as the erstwhile law. Restricted sectors are real estate activity, which means buying and selling of real estate. But if it's a development of township, construction, residential, any kind of commercial premises, etc., either for selling or leasing, that's allowed. That's not a real estate activity. Gambling in any form, and of course investment in the restricted countries like Pakistan, etc., all those are restricted, and it's very unlikely to get approval if you fall in any of this sector. Okay, this is very interesting thing, and I think we should have a little special focus here. We would have heard the term round tripping, right? What does round tripping means? Round tripping basically is investment outside India. So the first leg is a ODI, which is overseas direct investment. After making the overseas investment, that same funds come into India as a FDI, foreign direct investment. So we have a ODI and then a FDI. It could be kind of a fancy tax planning to route those transactions, get a favor of some country. or it could be a bona fide kind of a structure where maybe after doing some operation outside India, they see some value in India and they would want to invest into India. What used to happen under the old law, such kind of structures, ODI and FDI were not permissible. Regulators used to see this transaction as the tainted transaction. But I believe there was, lot of comments from the stakeholder when the draft regulation were being issued that some point in time, these structures are genuine structures. These need to be created because, say, for example, a pharma company, after doing some expansion, want to invest back in India in some, say, AI or some startup who's actually facilitating the R&D for a pharma, right? So this is a requirement of a business when the money goes out of India and comes into India. The new law have liberalized this, but what it says that it cannot be more than 2 layers. Now, what does it mean, more than 2 layers? I will give an example. Towards my left, maybe you're right. The first diagram, if you see, India, there is a IE. IE means the Indian entity. It has invested in a foreign entity, which is FE, right? Say Mauritius. Now, foreign entity has 2 subsidiaries, SDS1 and SDS1, both sister concern. And the foreign entity has also invested back into India. So there is a ODI from IE to FE and then back into India, SDS2. Is this transaction permissible? Yes. Because how many layers we have? Only 1 layer. Let's move to the second structure. There is an Indian entity, investment in FE. FE has investment in at an overseas level in SDS1, SDS3, SDS4, and SDS1, which is a second layer in the hierarchy, has an investment in India. Is this investment allowed? Answer is yes, because there are 2 layers after which the investment is coming into India. The first one is FE and the second one is SDS1. Let's look at third structure. IE has invested in FE, which is a foreign entity. FE has invested in SD1. SD1 has invested in SD2. And SD2 has invested back into India as SD4. Is this investment falling within the regulation? Answer is no, because there are 3 layers. If we see FE, SDS1 and SDS2. Similarly, in the fourth diagram, investment by IE into FE, and FE has SD1, 2, 3, and the third one is investing into 4. Again, because it's a vertical and there are 4 layers before making investment into India, this is also not allowed. But let me tell you, basis our experience, because when we keep discussing multiple structures with the Reserve Bank of India, sometimes, these structures are required based on some requirement as per the host country law, etc. Reserve Bank of India is open to look into the transaction. You make an application to them, explain the rationale, take a specific approval, and such kind of structures could work, provided we explain the genesis and the rationale. So very important, and I also like to cite an example here. What had happened in one of the listed IT company, there was a ODI FDI structure, right? And there was just a 1 layer. So let's take an example. The structure was like diagram 1. Then the law got changed. They made this investment under the erstwhile FEMA 120. Law got changed in 22. The IT company felt that under the new law, because 2 layer is allowed, my transaction is automatically grandfathered. That was the expectation of the company. And it's a listed IT entity. Imagine, so many consultants, etc. There was a kind of a love letter from RBI saying that this structure is not doable because you have set up the structure under the erstwhile law when this kind of structure were absolutely not available. Absolutely not available without approval. So you cannot take a recourse that the new law has changed, which allows the 2 layer of subsidiary, and because you have 1 layer, you will get automatically regularized. That is not the case. And believe me, when it was compounded, the structure had to be unwind, and it was compounded, and the compounding value was quite high because the investment was made in the old law sometime in, say, 2002. We are in 22, 20 years, the value has kind of accelerated 100 times. And when they levied the penalty or the compounding, it was on the today's fair value. They are not going to take the fair value then, they are going to take the fair value now. So huge consequences on that IT company, including the reputational damage. So very important to see when there are multiple structures, we need to recheck, rethink whether we fall into it. If at all something is not right, we need to get it corrected. Also, I'll tell you few of the cases we have been discussing with multiple bankers because they are the delegated power of Reserve Bank of India. Few of the cases where there are multiple fancy structures, the Reserve Bank of India has already escalated the matter to ED, where the company have not voluntarily come for the regularization, right? Okay. We will talk about some other key changes in terms of the pricing. Now, when we make any investment, either in India or outside India, pricing is very critical. So, the new law says that the pricing would be a arm's length price because the transaction would be between the related party, and the bankers have the power to evaluate the valuation and the pricing. Pricing will be determined based on the international accepted accounting principle. It doesn't define any method like a discounted cash free flow method or something else. It says that it has to be internationally accepted method, and every bank do have their board policy. Say for example, your pricing of interest on a loan comes to 8%. Bankers are flexible because they are trying to keep 3 to 5% plus or minus, and if that ratio fits into that delta, they are allowing the kind of a transaction. So pricing has been delegated to the AD banker. Another important concept is disinvestment. Disinvestment is basically exiting from your overseas investment, right? Now, typically what used to happen earlier, when Indian entity makes an investment outside India, there is a loss. Say during the COVID period, the entity has not done well and you want to disinvest. The old law used to say that if your overall investment is more than 10 million and you want to write it off, you require a prior approval from RBI. Under the new law, this has been under automatic route so far as equity investment is concerned. But if you want to write off the loan, you again require approval from Reserve Bank of India. I'll also cite one example here. So what had happened that in one of the company, the overseas entity was making loss. The Indian company merely passed a book entry for an impairment. It didn't write off. There were certain inquiries from the banker, you have written off in your books, you will be penalized, etc. But see, the important part is, it is not a permanent write-off. It was only a provision. So if an Indian entity makes a provision or an impairment of an equity, that doesn't mean the actual write-off. From a FEMA perspective, when you're actually disinvesting, getting whatever the money you have, complete write-off, you're no more a shareholder. That is what the write-off means. And I think many of the bankers were also not very clear on this aspect, which later on got cleared. So it's again a very important development here. Another particular term which has now been liberalized is a deferred consideration. So what happens that, many a time when you set up a company, it is not necessary that you have to send the funds outside India to become a shareholder. Many of the countries, you just make a commitment and the company get incorporated, right? So now the law says that the ODI, because when you file the ODI, you get a unique identification number, will get triggered when you are making a commitment. So what happens if the funds go later? That concept is called a deferred consideration. That is allowed. They have not defined the period that deferred consideration has to be 3 years, 5 years, 6 years. It is not defined, but it has to be definite. It cannot be open-ended. It cannot be contingent. It cannot be like if I make a profit or something or particular, some terms and condition get satisfied, then I will send the money or remit the money. It doesn't work like that. It can be deferred, but it has to be a definite. That's very important. And so far as reporting is concerned, when there is a deferred consideration, this would be construed as a commitment, non-fund based commitment. So it will get added to your 400% of net worth as a non-fund based. And when you remit the money, the non-fund will get a fund based. So it's just a rectification of the filing which needs to be done. Again, a very important development because many companies, do have a kind of clauses which lead to deferred consideration. So say for example, 25% will be paid upfront, balance 50% will be paid after say 5 years depending on the business. So very important development so far as deferred consideration is concerned. We spoke about debt guarantee and pledge. So for example, if an Indian entity in addition to equity instrument, if they want to fund the overseas entity by way of a loan or a guarantee, it need to have minimum 10% of capital in that entity. Similarly, what used to happen, many Indian company, they take a loan from the local banks and they are not able to fulfill it. So they get categorized as NPAs, non-performing asset. But same time, they see a business opportunity outside India. And under the erstwhile law, they used to get stuck at the regulator level. They say that you are an NPA, you cannot, unless you take a approval from the respective, financial institution or say any agency, say enforcement directorate, etc., you cannot make an investment. And it used to take hell lot of time. Now what the law says that you can make an application to the respective authority, and if the authority doesn't revert within 60 days, it would be a deemed approval for the Indian entity to make an overseas investment. So they have cut down the period to 60 days to facilitate faster investment outside India, and hence, not always sitting on the board of the enforcement directorate and things like that. Another concept is restructuring of the balance sheet. What does restructuring of the balance sheet means? Say for example, your entity is not doing well. Now you don't want to completely exit at the moment, you have to wait and watch. But at the same time, you will have to restructure your balance sheet to a particular value. Say instead of 100, it would be say 90. What used to happen under the erstwhile law? Under the erstwhile law, if you are restructuring your balance sheet, more than 25%, there is a diminution in the value, you require approval from Reserve Bank of India. Now the law says that you can restructure it if the overseas entity has a loss in preceding 2 years, and it is in case it is more than 10 million US dollar, or if the diminution in the value of the overseas investment is more than 25%, you can do it under automatic, but you will require a valuation certificate from a prescribed valuer, right? So they have again made it very clear, and here also I would like to cite a very interesting example. So they have restricted this diminution in the value of asset to the extent of accumulated loss, which is sitting outside India. There was an Indian entity, it had invested outside India, not as a WS, but as a JV. 51% by Indian entity and 49% by some other JV partner. Now the Indian entity thought that they want to diminish the value. It was considering the entire amount of accumulated losses for computing this. Now technically, if it is holding 51%, it can consider only 51% of the accumulated losses and not the accumulated loss full. So again, there was some error which had happened. They were quite ignorant about it. Bankers also processed it. Surprisingly, bankers also processed this request, but later on, when it got captured through annual filing return, I think the Indian entity was penalized by way of a compounding. So very small mistake, but there are consequences when the compliance is not followed. Okay, so we understood when the investment is made outside India by the Indian entity, what are the nuances, what are the regulations, and what are the structures. Let's talk about overseas investment by resident individual. Can resident individual make investment outside India? Yes. What is the limit? Limit is $250,000 under Liberalised Remittance scheme. Individual can also invest by way of overseas direct investment, but the condition is it cannot invest in a financial service sector if it has more than 10%. If it has less than 10%, it's fine, but if it is more than 10%, it cannot invest in a financial service sector, and then cannot be a entity below the operating entity. It can be immediate one entity. That is what the restriction for individual is. So far as portfolio investment is concerned, it can invest in the listed entity, less than 10%, listed debt instrument, etc. There are certain other ways by which the individual get the shares of the overseas entity. By inheritance. So is it allowed? Inheritance, yes, it's allowed if the resident individual receive the shares from a person resident in India or resident outside India. What happened in the case of a gift scenario? Can resident individual receive the gift of the overseas shares from person resident in India? Yes, provided he is a relative and the relative who was holding the shares earlier was in accordance with the law. Take a third situation, resident individual receiving the gift from person resident outside India, from NR. Is it possible? Answer is yes, but what will get trigger is the additional FCRA regulation, Foreign Contribution Regulation Act. When any gift is there from a non-resident into India, this FCRA gets triggered, and we need to see what kind of approvals will be required under this FCRA regulation. Another important point is ESOP. I think we did speak about the ESOP in my first slide. Any Indian employee receiving the shares of the overseas entity as an employee stock option or a sweat equity share, etc. Very important bifurcation have been made here, which was not there under the erstwhile law. Say, for example, I am an individual, I am a director of a company. I am getting a ESOP of my overseas subsidiary. Now, can I take more than 10%? Can I invest more than $250,000? Because the liberalized remittance scheme just allows me $250,000. Answer is yes. If it's a ESOP scheme, you can invest more than 10%. You can invest more than $250,000. However, this whatever the investment you have made, the LRS limit will get consumed. So you cannot make any additional investment. So you can invest more than $250,000, but your LRS limit for that particular financial year will get zero, right? And if it is more than 10%, it will be construed as a overseas direct investment. And there is a additional liberalization that if the investment is made through ESOP, there is an exception. It can be made even in a FS sector, or it could be in a sector where there is a downstream entity. So that carve-out is there so far as ESOP structure are concerned. But let me tell you, we should not structure something to do indirectly, which otherwise is not allowed directly, because all these transactions or all these structures are already under the strict scrutiny of Reserve Bank of India. Last is in the IFSC. Can resident individual invest in IFSC? Yes, it can. And if it has a downstream entity below, there has to be no control, then it can have a SDS. Otherwise, it can invest in IFSC in spite of the fact that it's in a financial service sector. Let us, little bit what we just heard, try to put it in the structure to have little more clarity. Look at the first structure, resident individual making investment in an operating entity, which is a non-financial service sector, 100%. Is it allowed? Yes, because it's a non-financial service sector. Let's come to the second structure. Resident individual investing in a holdco, 100%. And that holdco is further investing in an operating company. So we have two layers. Is it allowed? Answer is no. Because when RI has invested in the holdco, it's 100%. Had it would have been less than 10%, then the level entity below is allowed, otherwise it's not allowed. Look at the third structure. Resident individual has invested in a listed company shares less than 10%, it's allowed. And the fourth structure, which is extrapolation of the third structure, RI invested in a holdco, 100%, and the holdco has further invested maybe less than 10% in the listed financial service sector. It is not allowed because the 10% restriction should not be at a second level, but at the first level. Okay. Now we will talk about tightening of the reporting requirement. I spoke in my initial opening remark that compliances cannot be compromised. It could be very expensive if we do so. They have tightened the reporting requirement. So earlier, when any remittance was to be made out of India, it was Form ODI. Now the form has got changed. It is called Form FC. It will get triggered either at the time of sending the remittance or the financial commitment, whichever is earlier. Erstwhile law, it was only at the time of sending the remittance. And the important part is this need to be certified by the statutory auditor, the 400%. Now the statutory auditor certificate, the scope has been widened beyond imagination. You need to check multiple things, that all the filings have been done for the group company, holding company. What had happened that in one live case, one statutory auditor certified, it just merely took a declaration from the Indian entity that you please give a declaration or a management representation, all this requirement which is there has been satisfied. It took that declaration on the record and it certified it. But there were certain non-compliances. Believe me, the regulator actually issued a letter to the statutory auditor. You cannot go by the declaration of the Indian company. It's your duty to check each and every regulation has been complied with or not, and that statutory auditor was strictly punished by revocation of the certificate for some point in time. Not a permanent revocation, but a revocation for a limited time period. So I think all the statutory auditors have to be very careful when we are certifying. The way the certificate has been devised, the way the certification has to be given, it actually make you sign it, kind of doing a due diligence for the Indian entity. Similarly, from a OPI perspective, the new form has been introduced called OPI. So when there is a issuance of ESOP, and I was mentioning the Indian company need to file the form, this form needs to be filed half yearly, 2 months after the end of the 6 months. And if at all, if there is any OPI investment, then this form gets triggered. There is a requirement of annual performance, APR, return, which need to be filed annually. I think all of us would have completed 15 July is the, that is for FLA, but 31st December is the deadline. What used to happen, say for example, an Indian entity is having an investment less than 10%, so they have given a waiver. You don't need to file the APR because there is no control. Similarly, there was a law, and law have changed phenomenally under the FEMA 120. You need to get the overseas entities account audited. Many of the country, there is no requirement to get the accounts audited. Then what? Under the erstwhile law, there was a liberalization for some point in time. Now what the new law say as we stand, if your investment is less than 10% and the host country there is no mandatory requirement of a statutory auditor, then you can skip. But if your investment is more than 10%, you will have to get it audited. Even if it doesn't require in the host country, you will have to get it audited from the Indian CA or any CPA. So I think this clarity they have brought in. And so far as ODI by resident individual is concerned, then any CA can sign because they might not be subject to statutory audit, right? One important other changes are share certificate. So when you make an investment, Indian entity need to get a share certificate within 6 months. Or else any future remittance cannot be made. I'll tell you, one of the global largest private equity fund, they had made an investment in India. They made then overseas investment. And so there was a FDI, there was a ODI. And they wanted to exit from the complete structure. FDI, so automatically ODI will get exited. So to exit from a ODI, you need to get your money back. They kind of enter into a deal with another non-resident. It was a 1,000 crore deal, right? There were army of lawyers, army of consultants who did the whole diligence. When they went to the banker that we want to remit, Indian entity want to the, ODI, the money has to come back into India, Indian entity want to divest. Bankers was checking all the regulation, they checked the project profile, etc. They checked, where are the share certificate? We don't have the share certificate. So apparently there was a miss of submitting the share certificate and the entire remittance into India got stuck. And because this transaction was huge, 1,000 crore, there was an agreement being signed between the buyer and the seller. Every day in delay would lead to a penalty of 2 crore rupees. So imagine a simple share certificate being missed out in such an important deal, and the bankers were very strict. Of course, they went to RBI, took approval, got it. But I'm saying in the intervening period, the loss of the capital, the loss of the funds, and the loss of the reputation is also very important. So another important thing is any dues which are receivable on account of interest, dividend, or any other income, all that need to be realized within 90 days. Right? So these are the simple due dates. Many a time it's a miss, but let me tell you that the consequences are really harsh, and all these examples which I have cited are all live examples over the last 2 to 3 years. This is not something, the notional case study, these are actual case study which I have highlighted. And the last but not the least, the late submission fee. So welcome change again. I think most of the regulation, whether it's FDI, external commercial borrowing, this concept has been introduced, which is very similar if the non-compliance has been done under, companies law. So what it says that if at all any delay has happened in reporting, not in the structure, if there is a delay in reporting and it's a commercial lapse, right? Then you can do the needful or rectify it within 3 years from the due date. But you have to pay a late submission fee, which is a small amount of 7,500, and there is a formula based on the investment what you have made. Similarly, the law has also very clearly stated that if at all any reporting compliances are missed and it has not been regularized, they will not allow any future remittance. All your merger, demerger, restructuring could be on hold till the time these filings are not done. Right? So with this, I think these are the nitty-gritties of overseas direct investment. I would like to say that after this session, if it encourages each of you all, for your clients or any overseas investment, that one additional question need to be asked, then the objective of this session is achieved. So with this, I would like to end my session and happy to take any question if time permits. Yeah. Yeah.
In respect to the APR which you just showed us, there is a declaration which Indian Chartered Accountant is supposed to give. In your case, suppose as we were you were discussing, it's a wholly owned subsidiary where 100% stake is there, but the company is not required in the foreign country to do any audit, and neither is there any turnover happening over there. It was an investment which went, and then there was no such activity happening to generate a profit, and there it is not required to have a
Audit.
Now, as per APR, it is saying that you have to file an APR where this is the Indian Chartered Accountant can give when he is writing the rules have been audited as per the host country rules and laws.
Right.
Host country does not require that, but still the banks are insisting and APR is not going through.
So I'll tell you, in this is a very good question, and many of them have been kind of grappling with this. So when this declaration come, and many of the auditors are very finicky with the language being used, so if it is not required, then what regulations we are going to quote? So we took a clarification from Reserve Bank of India on this matter, and the RBI have in fact have given this messaging to all the AD bank that if it is not required in the host country, then the Indian Chartered Accountant can audit the assets and the liabilities based on the law which is there in India, certify it about the bona fide, and basis that the bankers has to accept the APR.
In the host country, there is no rule of share capital. How we can find from it?
So if there is no rule of, say for example, that there would be some instrument which gets generated, right? And if it's in the perpetual nature, so you have to mention, say for example, note, promissory note or something like that. It's a perpetual in nature, which is construed as a capital in that host country. So form FC in the place of equity capital, you have to put whatever the value of the promissory note is, and that would be construed as the holding or a financial commitment. So then you will have to show the definition of equity capital, and you will have to demonstrate that whatever the host country you are investing, it's a perpetual in nature. You can show your agreement or anything which clearly demonstrate an evidence. It is a compulsory convertible instrument and not a redeemable instrument. They should agree to that. Yeah. Who are your bankers, by the way? So I think maybe you can make this representation, give this definition. Probably they should accept to that. Yeah, yeah. No, I think if you give this definition, they should kind of agree to it. Because the definition have now, that's the reason the law got amended and the definition of equity has been changed.
They are telling that you go and change your memorandum and get some subscription of $100 or something.
No, I don't think so. So that's the reason I said, even if you see Form FC, what it says that either a commitment or the remittance, Form FC gets triggered. So it's a commitment. Yeah, so both, they have to read this Form FC condition along with the definition of equity capital, basis which they should accept it. Yeah, yeah. It would be construed as a debt. Yes.
There are some Indians who are non-resident and they invested in some real estate abroad. Now they come back to India and as long as they're non-resident, I don't think they require to report in the tax return. But what happens when they disinvest?
Hmm.
If they keep it, their children settle abroad. The money from their children abroad,
So when the non-resident invested in the real estate, what was the source? Was the source outside India? So if the source is outside India and you invested when you were a non-resident, that point in time FEMA is not applicable because it's outside to outside.
Yeah.
Now you have sold off those investment and you will have a proof of the source that when you were non-resident you have invested, you can get that money back into India without any reporting.
No, they don't want to bring it back to India and because they are resident. So
Now, in that case, what will
they
happen,
give
sir?
it to their children who are non-resident over there.
Yeah.
Then it's okay.
Then it's okay.
Thank you.
Yes, sir.
LRS through Gift City.
That is permissible. But as I said, you will have to follow the limit, $250,000. And the resident individual who want to invest in a gift city. So there are multiple instruments. It could be fund, it could be any vehicle, and it would be construed as a OPI.
From Gift City to abroad, any other country.
So that is again, as I said, say for example, take a case, resident individual investing in a gift city, not in, if it's in a fund and the fund investing outside India, it's fine because the first leg is a OPI. But a resident individual forming a company in a gift city with more than 10% of equity instrument and then investing outside, probably there could be a restriction because resident individual are not allowed to have more than one layer.
Thank you.
Individuals are not required to report in OPI, other than individuals. So a company would have invested, which is in the nature of OPI, then it gets triggered. So far as individual is concerned, if it's a ESOP, they would have invested, then the company is required to report. So if you see my first line, other than individuals, in the paragraph. So OPI, there is a separate form and there are certain prescribed conditions or separate descriptions which need to file. So you just need to put all those information and the form is a separate. It's not the same form as Form FC.
Ma'am, investment in safe notes by RI, what do you think, how would it be classified? I mean,
Sorry, investment, I didn't get you here.
investment in safe notes.
Sales notes.
Safe notes.
Safe
So
notes, safe notes. No,
Yes.
safe notes is not permissible.
It's not permissible.
No, that,
Okay.
yeah,
All right.
yeah. Sir, I think better if you can get the mic, please.
Yeah,
for him.
hi. When a resident individual invests abroad, right, in a foreign entity with more than 10% control, OI rules definitely get triggered, but do LRS also get triggered? So
Yeah.
we know that OI rules have a ceiling of the LRS, right?
It does. So, for example, if a resident individual want to invest outside India, it is allowed, but what is the limit? Limit would be what is allowed under LRS. So, you'll have to read both OI rules along with LRS.
Okay, only for the purpose of limit.
Yes.
All right, works. Thanks.
Yes, sir. I think. There is no, so you are saying Indian individuals giving advisory services and you receive a ESOP.
Yeah.
Does the individual have any position of director or something like that, or
No,
is
nothing,
it no? Then it's
It's purely advisory.
so advisory, sir. I'll tell you, this is a very tricky issue because we had a similar clarification. We checked what the regulators believe. Probably it might not be under automatic route because if you are in a position of a director or something like that and you are getting a kind of a sweat equity or whatever the ESOP, it's fine. But if you have no stake or no position and absolutely, there is nothing linked between the Indian entity because you are a pure consultant, then you will have to take a specific approval. If at all, you have to subscribe to the ESOP of that as a remittance towards your advisory
Specific approval from whom?
from Reserve Bank of India.
Oh, yeah. Thank you.
I think I'll be conscious of time because the other speaker is waiting. So thanks everyone. I'll be here for some time and may I request
Director as SK Patodi and Associate LLP. She advises India and multinational businesses on FDI, ODI, FEMA compliance, international structuring, and global business expansion. A distinguished speaker and committee member of WIRC ICI. She is widely recognized for her expertise in international business regulation and global opportunities for chartered accountants. Thank you, and welcome, ma'am.
Now I request Amit Joshi to please present a memento to our first speaker, Ankita Jain. Garita ji, you can also join. Now I request Ankita madam to please start the session.
Good afternoon, everyone. So, after the excellent session by Ms. Darshana Jain, I'm little bit conscious now. My topic for today is on the external commercial borrowing. Firstly, I would like to thank Sudha Bhushan ma'am, because this was originally her slot, and she has kindly allowed me to exchange the slot with her due to some health problems. And secondly, I would like to thank Chairman Saurabh Ajmera ji and all the dignitaries who are present here. Also, all of you are very interested to learn the FEMA in this July season. So it is a very busy season for all of us, and you all have come. So it's a great thing to learn FEMA. And just I would like to briefly explain you all like how I started my FEMA learning journey. So initially it was a few small assignments which I had got in my office, and then gradually deeper level of knowledge on FEMA I have gained through small study circle meetings. So I was attending a FEMA study circle with a like-minded people, some of whom were already expert in FEMA. So with the help of them, the experts and the novices like me, so we discussed on one topic of each week, and line by line we read the regulations, and gradually that's how like I got to know each and every intricacies of the law. And as and when I attended, like I kept attending many FEMA refresher courses which are organized by various institutes. So after gradually doing all these things for say 2-3 years, I gained a practical exposure along with the work that was allocated in my firm. So this is how my journey of learning the FEMA has started. And I wish you all, if there are any freshers in FEMA, I wish you all a very best to start your journey. And you can contact me anytime on LinkedIn or my email ID if you have any queries. So the today's topic is on external commercial borrowing, and this topic is of very much importance because in 2026 February there was a revamp in the ECB regulations. So in the presentation today, what we will cover is the basic ECB structure, key definitions, who are the eligible borrowers, who are the recognized lender. Then we will cover what are the borrowing limits, how to calculate MAMP, what are the permitted and prohibited end uses, and we will cover the various reporting forms under ECB, such as form ECB 1 and 2, and non-compliance and penalties. And lastly, we will cover few practical case studies for the better understanding of the audience. So what is a external commercial borrowing? This is basically a loan taken, commercial loan taken by resident of India, but not individual residents. It will be the resident entities such as company, LLP, partnership firm, but this borrower does not cover a sole proprietorship firm. So these are the eligible borrowers from a recognized lender from a foreign country. So this is a basic rule that the lender has to be from a foreign country and borrower has to be Indian. And the terms of the ECB must be governed as per the parameters of the ECB guidelines. And the objective of the parties is, Indian party is to access the lower cost overseas funds which are available from the, because in the domestic market if they go to take a loan, the higher interest rates apply, but in the global market funds are available at a cheaper price. This is a legal framework behind the ECB regulation. So basic is section 6(2) of the FEMA Act, and the earlier regulation was Foreign Exchange Management, Borrowing and Lending Regulation 2018, wherein there were 3 schedules. Schedule 1 was covering the ECB part, Schedule 2 was on trade credit, and Schedule 3 was covering the external commercial lending, ECL. So after the 2026 amendment, the Schedule 1 of this 2018 guideline has been completely substituted with the amendment of 2026, and Schedule 2 and 3 remain as it is under the 2018 regulation. Also, one can refer some of the master direction and circular if they want to learn about ECB. But the recently, after the 2026 amendment, ECB master directions are not yet issued by RBI, and even FAQ, wherever there was a ECB related part in master direction and FAQ, the same has been removed. So as of now, we have only the 2026 first amendment regulations. So by way of notification, FEMA 3R5 2026 RB, RBI has amended the ECB regulation, and the core objective behind this amendment was to, there was basically a lot of pressure from the international investor community, and they wanted to invest in India, but due to so many conditions of MAMP, the all-in cost ceiling, and various other terms, so it was becoming very difficult for them to give loan to the Indian companies. There were problems like debt to equity ratio of 7:1. Then there was also there were conditions of having minimum 25% equity participation. So all such commercial terms which were being hurdles to the ECB arrangements are now being removed by RBI, and they have liberalized so that more Indian companies can leverage the benefit of ECB. Also, in future slides, what we will cover is that there are various such one example which I can give is buying of the for real estate purpose, ECBs were not obtained. So now as per the revised regulation, what they have done is for the end use in real estate business, if it is in line with the FDI policy, like if the person is doing the construction and development of the township, then they can acquire ECB to do such funding of the real estate business. Then what happens to the loan that were acquired before 16 February 2026? So they have to follow the same guidelines which were there in the earlier regulation. But they have to, for the reporting purpose, they have to follow the new rules. So ECB 2 and ECB 1 related forms, they have to use the new form. But whatever terms and conditions, MAMP, all-in cost ceiling, all those has to be as per the old regulation. So these are some of the basic terms that you need to understand. One which we will like talk about in future slides is about the benchmark rate. And so benchmark rate is nothing but the so you must have heard about the terms SOFR or MIBOR or Eurobor. So all the countries basically have their own benchmark rate. For sterling there is a separate. For USD now they are following the SOFR, SOFAR. And in India they are following MIBOR, MIBOR. So all these benchmark rates are now used to, if there is a floating rate ECB, you have to follow this benchmark rate plus some percentage spread which is prescribed by the ECB guidelines. Then what is the cost of borrowing? So cost of borrowing will cover interest, fees, expenses, charges, guarantee fees and export credit agency charges. No, recognized lender we have covered. Then NRI and OCI. So basically loans which are taken by Indian resident individuals from NRI and OCI, and the trade credits which are for a period below 3 years. So I would not be covering that because we have a limited time available. So we will focus only on the ECB part. So these are broad framework. So key changes which the new ECB guidelines has done is expansion of the eligible borrower and recognized lender. Then end use restrictions are significantly liberalized. Borrowing limits are aligned with the financial strength. Then removal of all-in cost ceiling, pricing shifted to market determined interest rate. Simplification of the minimum average maturity norms. So earlier there were multiple MAMP period for various loans such as 1 year, 3 year, 5 year, 7 year, 10 year. Now each and every commercial loan under ECB has been given a fixed MAMP minimum maturity period of 3 years. So this is a very welcome move to simplify all the confusion. And other than, there is one exception which we will cover in the next slide. Also earlier there was a requirement to file ECB2 returns every month, even if there is no drawdown or no repayment. There is no activity in that ECB, but the loans ECB2 return had to be filed even if it was a nil return, and CA certification was to be obtained for the return. But now the same requirement is not there. So now if there is any event, then only ECB2 has to be filed. So what instruments are covered under ECB? One is so there are various instruments. So key idea is that if it is a optionally convertible preference share, optionally convertible debentures or non-convertible debentures, those will classify as a ECB because they are not covered under the NDI regulations. And if there are say FCCBs, foreign currency convertible bond, foreign currency exchangeable bonds, or loans in any form which are borrowing arrangement regardless of its structure, such as term loan, buyer's credit, supplier credit, if they meet the ECB criteria, then they are to be used as an instrument under ECB. And trade credit with a maturity period exceeding 3 years is considered as an ECB. So ECB scope is trade credit with original maturity of up to 3 years and export advances, foreign investment under the debt instrument. So these are the transactions which are not covered under ECB. Trade credit up to 3 years. Then if any investments are in particular covered under the DI regulations, debt instrument regulation. Convertible notes are not covered. Then debt investment by FVCI is not covered, and credit card transactions are not covered. So in the new ECB form, which is available on the RBI website in a Excel format. So earlier what used to happen, we used to fill the ECB form say manually, or in the PDF we used to fill the form and we used to submit a hard copy to the AD bank for processing of ECB. But now as per the new guidelines, RBI has given one on their website the soft copy in Excel format for ECB, revised ECB and ECB2. So these forms have to be in the Excel format. It has to be downloaded from that RBI website. I have shared a link in the coming slide for that particular form. So what happens is, there are formulas are given by the RBI at various places in the Excel, and instructions are also given in the tabs. So, and all these purpose codes are also taken from that form itself. So there are 21 purpose codes, and in the earlier ECB guidelines, there were ECB has to be drawn in few particular currencies such as USD, Euro, JPY, GBP, and some 2-3 more currencies. But now they have liberalized the rules. So now there is a list of 42 currencies in this Excel file in which the ECB can be drawn. And these purpose codes are also available in that Excel in the drop down. And they have given 4 sheets in the ECB form. So in the 4th sheet, all these purposes are separately listed. Yes, so in the earlier ECB regulations, there was one particular word which was used, that if the eligible borrower has who is borrower sector is open to FDI, only then they can raise an ECB. So this was giving a restriction to LLPs to raise the ECB, because in LLP we were using the term foreign investment and not an FDI. So earlier LLPs were not eligible to get the ECBs, but now this line has been removed. So now even LLP and partnership firms can also raise a ECB. And if there is any entity which is under corporate insolvency process, they can also raise the ECB if the resolution plan specifically permits it. If there is a company on which some investigations are pending, so if they disclose the details of the investigation, then even they can raise a ECB, provided they have made a proper disclosure in the form ECB1. And as I discussed, that individuals are still excluded. So proprietorship firms or individuals, they cannot get a ECB. Now, in the earlier regulation, there was a specific wording that FATF and IOSCO, if a country is under a FATF list or under a IOSCO, then they are not eligible to be a recognized lender. But this line has been removed. So now if the AD banker in India gives their prima facie approval and they do the proper KYC check of the lender, and if they approve the transaction, then you can go ahead and take that ECB even if it is from a FATF country. So this is a wonderful liberalization. Then as we discussed, that the 25% equity stake condition has been removed. Then if the loan is from a related party, then you have to consider the interest rate and all the terms on the arm's length basis. So this is also this particular word has to also be mentioned in the loan agreement, otherwise the banker will not process the transaction. So based on the transfer pricing, you have to work out the arm's length arrangement, and you have to have a proper documentation that the ECB is from a related party is taken as per the arm's length. Then now the foreign branches of the Indian bank, say ICICI Bank has a branch in Singapore, as you might have come across. So the branch of Singapore of ICICI Bank can give a ECB in INR to a Indian company. So this was not allowed earlier, but now they have permitted it. And as I explained that earlier for ECB was raised in only a few of the currencies, but now as per the new guidelines, there are multiple currencies which are allowed, not just freely convertible currency. And earlier the conversion of FCY ECB to INR was allowed, but INR to FCY conversion was not allowed, which has been now given a permission. And all the compliances will still be applicable for even in case of a conversion. And golden rule on the rates is at the time of conversion, the borrower's liability should not exceed as per their original terms and conditions. So whenever I have looked at any ODI, FDI or ECB transaction, the basic purpose of RBI is that if there are say liability from of the Indian party should not be higher. Like suppose if there is a case of ODI and there is a valuation report required, so we have to make sure that if valuation says 100, the money should not go more than 100 outside India. So liability of the Indian person has to be restricted up to that fair valuation. Similarly, in case of a FDI, if valuation comes to 100, then the foreign party cannot invest less than 100. They have to invest more than 100 in India. So in this similar way, if there are any changes in the ECB terms conditions, the liability, original liability of the borrower should not increase, so that more money does not go from India to outside. This is also one of the good amendment, that earlier there was a limit of 750 million USD per financial year when Indian company was taking any ECB, but now the limit has been increased to overall limit is given. Now there is no per financial year limit. So overall, if your ECB outstanding is up to USD 1 billion, that is your maximum upper cap. So the condition says that eligible borrower may raise ECB up to higher of outstanding ECB up to USD 1 billion or total outstanding borrowings up to 300% of net worth as per the last audited balance sheet. And similar to the OI regulation, the balance sheet can be up to 18 months. Then what is in the outstanding borrowings, it includes the proposed ECB, what we have to take now, and it covers both external and domestic and external borrowings. So this will count under the outstanding borrowing amount. We have covered one practical example to understand how this is calculated, so it will be clear to all of you. And non-fund based credit facility and mandatorily convertible securities are excluded from the computation of outstanding borrowing. And the limit of $1 billion of borrowing does not apply if you are a regulated entity such as bank, NBFC or a insurance company in India, if you are regulated by any such RBI or IRDA, then the $1 billion limit does not apply. You can borrow a higher amount. So this we have discussed, that 750 million annual cap is removed and 7:1 ECB liability to equity ratio has been done away with. So this is the example which is very good to understand the limit calculation. So company ABC has a equity capital of 500. They have a reserves and surplus of 1500. So their net worth is 2000. Domestic term loan is 2500. Working capital loan they have taken of 1000. They have a already existing of 3000 ECB. Non-fund based commitment such as bank guarantee or LC is 800. Compulsorily convertible debentures are 1200 and total liabilities is 10,500. So in this case, if we have to calculate that how much ECB they can borrow, so let us look at the steps. Firstly, I have assumed the exchange rate of 90 here. So USD 1 billion is the total available limit. So 9,000 crore is the total cap for the ECB. Out of that, their 300% of net worth comes to 6,000 crore. Then what is the total outstanding borrowing of the company? So this will be domestic term loan of 2,500, working capital loan of 1,000 and existing ECB of 3,000. So put together it will become a 6,500. So this is the limit 2, which is lower of step 2 and 3. So it will be the limit of 6,000 crore here. And now if we calculate the maximum permissible ECB, it is higher of step 1 and 4, which is 9,000 crore. Earlier, based on any person who is having a look at this case study for the first time, they might think that since they have a 6,000 crore ka already outstanding liability, now the headroom available is only 3,000 crore. But that is not the case. It is because of the word which is mentioned here in the first condition of the limit, which says that outstanding ECB up to USD 1 billion. So since they have a total ECB of only 3,000 crore and they have a upper cap of 9,000 crore, so they can raise a balance 6,000 crore because their 1 billion is not completed still. Now coming to the MAMP, so there is a uniform 3-year minimum average maturity period. What this means is that if suppose there is any loan which you have taken from outside India for say 5 year or 10 year, that is still allowed. Like minimum period is 3 years, so it is not that it's any upper cap. So if you have taken any loan for any amount of period of more than 3 years, that is allowed under the regulation, but it cannot be less than 3 years. And for manufacturing companies, they have given a relaxation that manufacturing companies always are on a lookout for a short-term liquidity. So they have given a relaxation that if you borrow any amount which does not exceed USD 150 million, then your MAMP can be in the range of 1 to 3 years. So this is a special relaxation given to them. So when does the MAMP, there are these are certain exceptions on MAMP rule. So at the time of conversion of ECB into a non-debt instrument, which is a equity, MAMP rule does not apply. Then repayments which are made using proceeds from issuance of non-debt instruments, permissible refinancing of an existing ECB. So in that case, existing ECB's MAMP will continue to apply. There will be no new MAMP on the refinanced loan. if there is a waiver of debt by the lender, then the MAMP rule does not apply. And if there is a repayment required for corporate actions such as merger, demerger, amalgamation, arrangement, acquisition, resolution or liquidation. So in all such cases, MAMP will not apply. How to compute this MAMP? So this classic example is given in the RBI's own website under the ECB regulation reporting PDF. So this example is same, which is taken from RBI website. So what happens in this case? The Indian company is borrowing total of $2 million as a ECB, and they are repaying it back as per the given schedule from 2008 to 2011. So how to calculate the average maturity period? They have given a formula that whatever loan is outstanding on a particular date, from that date till next date, when there is any event such as drawal or repayment, you calculate the number of days, then you multiply the outstanding balance by number of days and divide it by the total loan amount into 360. So this product will give you a average a particular like period for which that loan is outstanding, and if we take the average of all this, we will get the final minimum average maturity period, MMP. So we will, in the interest of time, just let me cover the slides quickly. So in the erstwhile framework, there was a all-in cost ceiling capped via prescribed spreads over LIBOR or ARR. Now, as per the new guidelines, ECB with MAMP of more than or equal to 3 years, the benchmark link caps are completely removed and pricing must simply align with the prevailing market condition. So this prevailing market condition, it becomes very confusing because I have talked to several bankers and they informed that people are not understanding like this word prevailing market condition, that how much should be the rate of the ECB, and there is a lot of confusion going on currently. Also, second most confusing thing was because most of the time ECB is from the related party overseas, so they have to decide basically the rate which is at arm's length. So this also is becoming very confusing to decide on how exactly what rate to charge for the ECB. End use restrictions are now consolidated under the regulation 3A of the 2026 amendment, and what is still there are certain things which are allowed, but let us look at some of the end uses which are prohibited. So investment in financial activities such as chit fund and nidhi company, transacting in securities. So if this transacting is for a short term period, like you are just buying and selling shares without any long term purpose, then such transactions are not allowed from the ECB proceeds. And exception to this rule is that if there is a strategic acquisition by the Indian company, like they want to acquire 100% share or acquire control of any third country in India with a view to hold it for a long term, and they are strategically expanding their business by doing this transaction. So in that case, such investment will be allowed. Or if there is any merger, demerger, amalgamation, in all such cases, ECB funds can be used. In real estate, as we discussed, that if it is purely buying and selling of the property in India or any such infrastructure, purely buying and selling not allowed. But if they are doing some construction or development activity and then they are selling it or leasing it, in that case, such end use is allowed. And Also industrial park, if the park has at least 10 units, no single unit exceeds 50% of allocable area, and at least 66% of area is for industrial use. So investment in such industrial park is allowed. In agriculture, there is a blanket prohibition, but they have given certain exceptions in line with the FDI rules. So now what is allowed is floriculture, horticulture, controlled condition cultivation, seed planting, material production, animal husbandry, pisciculture, aquaculture and apiculture. And in the plantation, basically it is not allowed, but few exceptions are there, such as tea, coffee, rubber, cardamom, palm oil, olive oil. All such investment of ECB proceeds in plantation activities allowed. If you are doing repaying loan, INR loan of a domestic, your domestic loan, which was already classified as a NPA, non-performing asset, or the end use of such loan was prohibited under ECB. So this you could not do directly, hence you cannot take a ECB and repay such loan indirectly. So this is the basic FEMA rule, that what you cannot do directly, you should not do indirectly. Then on lending for prohibited purposes. So ECB proceeds cannot be on lend for any purpose for which original ECB could not have been borrowed or utilized. So if you have taken a ECB and your money is lying idle, then you can park it in, for INR ECB, you can park it in a INR account in India, and for FCY ECB, you can park it in India or outside India in a FCY denominated account for a period up to 1 year, till when you are ready to use that proceeds. And one of the important condition when you approach any, like your client comes to you and says that I want to take this ECB and money is coming in 2-3 days. So practically it is not possible to take the ECB proceeds within 2-3 days, because RBI has a TAT of 7 days and banker will do their own due diligence for 4 to 5 days on the document. They will give you some queries. So after all this process of 10 to 12 days is done, only then the LRN, loan registration number, will be issued. So you have to explain your client that this is a basic thing and you cannot expect to get a money faster because there are reporting requirements involved. So always guide the client properly that without the LRN you cannot draw down the ECB. Then if we look at the refinancing, it is made more flexible now. So existing ECB may now be refinanced in full or in part through a fresh ECB if the person is not able to repay the amount. But in such cases, MAMP cannot shrink. So original borrowing, whatever was the MAMP, it has to continue that. Then if there are multiple ECBs obtained by a Indian party, then they have to do the weighted average calculation to test the MAMP compliance. And refinancing of an INR denominated ECB with a fresh FCY ECB is now permitted, which was not the case earlier. ECBs can also convert it to equity, such as any non-debt instruments like compulsorily convertible preference share debentures, or in case of LLP interest. And at the time of such conversion, lender's consent is required. And if the borrower has a bank NBFC credit exposure, and restructuring and other prudential norms apply to the conversion. And sectoral caps which are originally applicable in case of FDI, they will still continue to apply if the ECB is converted to a FDI. So what to do at the time of such conversion? So they have to, if it is a full conversion, they have to file FCGPR and file ECB2 for the conversion, and thereafter no further ECB2 filing is required. And if it is a partial conversion, then file the FCGPR for the portion of equity, and for the balance amount of ECB which is still outstanding, they have to continue filing ECB2 in case of any events like any drawdown or repayment or any interest payments. So changing in the terms and conditions of ECB is allowed, and one has to file a revised form ECB1 in case there are original terms of ECB which are changed. So this form is available on the RBI website. I have shared the link in the coming slide. So these are the three forms which I was discussing. One is form ECB1, another is revised form ECB1, and one of the most important thing which one have to consider now, that earlier for ECB2 it was supposed to be filed within 7 working days of the next month. So if there was Saturday, Sunday or any holiday in between, those were excluded from this 7-day count. But now the new rule says you have to file it within 7 calendar days. So this is a very, I would say, funnily termed language, because they could have easily written in the regulation that file it by the 7th of the next month, rather than using the confusing word 7 calendar days. So basically any filing of ECB2 has to be, or any revised ECB1 has to be by 7th of the next month. So this is the link which I was talking about. On this link the form is available in the Excel format. And basically earlier in the form ECB1 or ECB2, there was a specific requirement to get it signed from a CA. Any chartered accountant could certify the form. Now banks are insisting to get a separate CA declaration for basically which says that all the conditions of the ECB are as per the guidelines for the cap of USD 1 billion or the net worth condition, like all this is fulfilled by the client. So these conditions are mentioned in the, like these declarations are given by a CA that they have verified all this. And no more nil ECB2 returns are required. So only if there is any event, ECB2 has to be filed. So these are the penalties, late fees. So if there is any delay in reporting, the amount of penalty will be calculated as 7,500 plus 0.025% into amount involved into years of delay. So in most often in practice, what contraventions are seen is drawing down the ECB proceeds before LRN is obtained. So what happens is, when you get a LRN number, the bank will give you a new account related to that LRN, and the ECB proceed has to be deposited in that separate account. So this practice may not be followed if the client is not aware about the ECB guidelines. So this has to be made sure. Then whatever purpose for which you have taken the ECB, so you have to use it for that same purpose. If there is any change in the purpose, then you have to report it to the bank, and they will in turn report it to RBI. So this has to be taken care. Then borrowing from any entity that isn't an eligible borrower or from a non-recognized lender. So the conditions of recognized lender has to be followed. Then not adhering to the minimum average maturity period. If you are prepaying your ECB or not adhering to some terms, so this is also one of the most common violation. Then you miss the forms, you forget about the filings when there is an event. So this is also very common. And pricing and borrowing above the applicable cost of borrowing ceiling. Then delay the trade credit payment beyond the permitted 3 years. So if the trade credit was originally for a period less than 3 years, and you have delayed it, so then it will be a deemed ECB. So this was the list of documentation required as given to me by some bank for a particular case. At the time of ECB, what all documents the bank asks. So one is a letter addressed to RBI. Second will be their customer request letter. Third will be this form ECB1. Then they have in the form ECB itself, there is a third sheet which is for the MAMP calculation. Then a CA or CS certificate. Some banks are insisting only for a CA certificate. Then copy of the loan agreement, copy of the memorandum of the company, Indian company, to check the NIC code and the activity of that company. Then copy of the board resolution, standard FEMA declaration which the banks take from the client, and any other document as may be required by the bank. And all these documents, some of the banks are taking everything in the soft copy now, and some of the bank insist that you also send us one hard copy. So standard process what one has to follow is first they have to execute the loan document, then submit to the bank, then bank will give their preliminary approval and submit it to RBI, and then LRN number will be generated, and after that you can draw down the ECB, and then you have to do the ongoing compliance as and when required. And if in the first month at the time of doing the drawdown there was a particular term which is changed in the subsequent month of the original loan agreement, something is changed, so you file revised form ECB1 in that next month before the 7th of the month. So to summarize what all things have changed, eligible borrower base has widened, cost of borrowing caps are removed now, borrowing limit is higher limit of USD 1 billion, end use rules are rationalized, and uniform 3-year MAMP has been given, and earlier there was a mandatory hedging requirement in case of FCY denominated ECB, but now that hedging requirement is also voluntary. If the client wishes to, they can hedge, otherwise it is not mandatory. And reporting is simplified now. So let us now quickly take few case studies. So in this case, Indian manufacturing company A wants to acquire 100% of company B at a purchase consideration of 800 crore, and they want to borrow 950 crore from its foreign parent through ECB for this purpose. So can they do that? Yes, because this is a strategic acquisition to acquire a control. Second example is company A is acquiring company B using domestic funds. After the acquisition, company A wants to modernize the combined manufacturing facility. It raises an ECB to purchase the machineries. Whether this ECB is permitted? Again, the answer is yes, because they are basically doing the expansion of their business, and it is very well within the permissible end use. A waiver of ECB and change in the loan terms. So in this case, ABC is a wholly owned subsidiary of a foreign company, and foreign parent has invested USD 15 million in the Indian company. Due to poor business performance, ABC has suffered heavy losses and its entire net worth has been eroded. Company is facing financial difficulties and is unable to repay the ECB loan. So there are a few questions here. Few options are available with the foreign parent. Waive the existing ECB loan of USD 5 million and write off its equity investment. Extend the repayment period of existing ECB and provide additional funding of USD 7 million for a new business opportunity. Cancel the old ECB and provide a fresh ECB loan. So in this case, can the foreign parent waive the existing ECB loan? Yes, ECB waiver is permitted under the ECB framework subject to compliance with the applicable FEMA and RBI condition, MAMP requirement does not apply in case of a ECB waiver. So because the money is coming to India and now Indian party does not have to pay back the money, RBI is happy to give the waiver. Can the existing ECB tenor be extended and additional funds be provided under the same loan? So tenor of existing ECB can be modified subject to compliance with ECB regulation. However, additional funding cannot generally be treated as only a change in terms. Additional amount would normally be considered as a new ECB and must separately comply with the ECB requirement. And third question is, can they waive the old ECB and take a fresh ECB? So answer is yes. Now case study 4 is on working capital. So Indian manufacturing company raises ECB from an overseas bank to fund general working capital requirement. So this particular use is permitted, but with a maturity trade-off. So working capital and general corporate purpose are now allowed end uses under the 2026 regulation, but they carry the standard 3-year MAMP. There is no shortcut here. Previously, general corporate purpose ECBs required a much longer tenure. So this is meaningfully easier now, but still a short-term fix. It won't help if the company needs funds only for 6 to 12 months. If a company wants to, now next case study is on a refinancing of existing rupee term loan. So company has decided, has an existing rupee term loan from an Indian bank at a high domestic interest rate. It wants to raise ECB from its foreign parent to refinance this rupee debt. So it is permitted under the 2026 regulation. Standard 3-year MAMP applies. No exemption merely because it's a refinancing of rupee debt. The exemption is reversed for ECB to ECB refinancing. So two flags, since lender is a foreign parent, arm's length pricing is applicable, and domestic loan must not be classified as a NPA. Refinancing NPAs is prohibited. Next case study is on lending to group companies. So Indian company, holding company, raises ECB and it wants to on-lend the proceeds to its Indian subsidiaries for their capex needs. This arrangement is generally permitted for non-restricted purpose. So on-lending can't be used to route funds into an end use that would itself be prohibited if borrowed directly. So worth mapping each downstream subsidiary's actual use of funds before structuring this. Then real estate. Company raises ECB to acquire land to construct a new factory industrial shade for its own manufacturing use. It is permitted only because 2026 regulation tightened the definition of real estate to expressly carve out acquisition of land for construction development of one's own industrial or manufacturing facility. If the same company bought land purely to hold resale or for real estate development purpose, it would remain prohibited. Next query is on NBFC borrower, because as we discussed that there is a higher limit for a NBFC, so they want to raise a ECB of 1.5 billion, which is allowed. Then there is a IBC resolution applicant. A successful resolution applicant under IBC wants to raise ECB from an offshore fund to fund the resolution plan. This is permitted because it covers under the corporate actions and expressly allowed acquisition of control. This is a case study on chit fund speculative use. A registered chit fund company wants to raise ECB to expand its chit fund business. This is not allowed. Then case study 11 and 12 are the last ones. So this is on the basically the rate of interest. Company A has raised a loan 5-year ECB of USD 40 million from an unrelated offshore credit fund. The fund prices the loan at SOFR plus 650 basis points, reflecting company A's credit rating, sector risk, and the fund standard pricing grid for similar Indian corporate borrower. So here, basically, since it's a non-related party, so arm's length certification requirement is not triggered, and AD Bank's job becomes very simple in case of a loan transaction from a non-related party. So they just have to confirm that rate is broadly in line with the market conditions. And no cap applies since the loan is above 3-year MAMP. So if it were under 3 year, it would additionally need to satisfy the trade credit ceiling. Then the last case study is on the related party lender. Company A raises ECB from foreign parent company. The parent proposes pricing at SOFR plus 200 basis points, which is well below what company A would get from an unrelated commercial lender, since the parent isn't looking to profit of intercompany funding. So in this case, 2026 regulation introduced a general requirement that ECBs from a related parties are to be priced on a arm's length basis. So basically they have to banker has to verify that the rate of interest charged is on a arm's length. If it is the rate below market rate, then it is not automatically allowed. And so in this case, a below market rate isn't automatically safe just because it's cheaper than the market. Arm's length isn't one directional test. Both artificially low and artificially high related party rate raises scrutiny, because pricing is also a transfer pricing and tax based question. Company A would need a benchmarking study or comparable transaction analysis to support this SOFR plus 200 basis point or whatever rate they are finally using. And AD banker's satisfaction requirement is correspondingly more rigorous for related party loan. Expect closure questioning on the pricing methodology and likely requirement to produce the benchmarking basis as part of the Form ECB1 filing loan agreement review. So thank you so much. With this I end my presentation. And since there is one more session before the break, I would request all of you. Is there? Okay. No, my session is ending, so. So after the break, there are, okay. Yes.
You mentioned that ECB in case of agricultural activities is under the prohibited list, and they're in the current scenario looking at ECB. So what do you suggest for such companies where the main business lies into such sectors?
So if they are covered under the exceptions, there are certain exceptions to that agriculture. So if they are using the ECB funds for that purpose, then it is allowed. For other purpose, it's not allowed.
Okay, because you mentioned that agricultural sector is not allowed.
Yeah, basically there is a prohibition, but there are certain exceptions such as horticulture, floriculture. So there are some activities for which the ECB end use is allowed. So they can have, if they are taking an ECB, they have to make sure that it is used only for those purposes.
Excuse me, ma'am.
Yes.
Ma'am, for a downstream investment, if I acquire a control through an ECB, whether it is permissible or it is permissible only under the Surrogacy Act or any other act which is a...
So you are taking a ECB and you are making a downstream investment. But is that investment for a long-term purpose, strategic
Yeah.
acquisition?
Yeah.
Yes,
but,
it is
but
allowed.
in your slide for acquiring control, it is mentioned under SRFSC Act or something, some other act.
So broadly speaking, if it is not your short-term goal, and if you are like taking acquisition to have a long-term control over that company, then you can use that ECB proceeds. It's allowed.
But AD bankers are not allowing it for a private company's downstream investments. The Standard Chartered is a AD
Okay.
banker.
So we can discuss this because there are some other AD banks which are present here in the audience, so we can discuss the case with them. Yes.
Hello. Ma'am, my question is that why ECB cannot be used to fund the NPAs when they are beneficial to Indian economy or Indian banks, then why it has been prohibited?
No, NPAs cannot be funded because basically it is very risky. Like, why would Indian government want to risk the like reputation of India in terms of global market? So they don't want to, when they are sure that repayment is very doubtful, so they cannot allow it.
And second question is that now if there is a foreign company which gives its subsidiaries at a rate of interest which is beneficial, it may be lower than the prevailing Indian market rates, then under arm's length disguise, why it is not allowed? Because in a way it is beneficial
Benefiting
which
to
is
the,
maybe in
yeah,
the initial
yeah.
stages.
Yes, but
It
as
is not
per
the other way around where it is, the company and Indian companies benefited from this.
Yes, I know, but based on the transfer pricing regulations, we have to consider arm's length when it comes to related party transaction.
Okay.
Yes. Yes.
I just have a question.
Yes.
If an Indian company is borrowing from its foreign company, like associate entity, and it's going to use it for working capital purposes or general corporate purposes, and then it kind of uses it for purchase of capital asset, is it allowed under the ECB regulations?
Yes, you can change the purpose, but it has to be reported to the bank.
Okay, it has to be reported to the bank.
Yes. Purpose, end use has to be reported that there is a change.
If an Indian company is borrowing for working capital purposes and for fixed asset, then there has to be a bifurcation in terms of what quantum needs to be
Yes,
borrowed.
there is a specific percentage-wise bifurcation which is to be given in the form. So if you are borrowing, say, $1 billion, 50-50 is used for both. So you can give a bifurcation. If there are 3, 4 or more purposes for which you are using the money, you can give a percentage-wise bifurcation for each and every.
And this is in which form? ECB1?
In ECB1, yes. So the forms link is shared in this presentation. I think you all will get this presentation from Institute.
So the broad steps in terms of any loan that needs to be procured first is to do the benchmarking and then kind of go ahead with the application to the RBI in terms of the ED bank. How does one go about the practical process?
So is that a case of related party?
Related, yeah.
So first you do the benchmarking exercise, decide the rate and terms of the ECB, and then you submit all the preliminary documents with the AD bank. They will have their own team to review the case, and if they give you a in principle approval, then you can go ahead and get all the documents signed and get it submitted officially to the bank.
Okay. Thank you.
Yeah. इनको देना.
My question is related to interest payment. So, an Indian company is borrowing ECB from a related party in UAE, but the main business of the entire group is lending business. The ultimate parent company is borrowing a loan from a third party, at an interest rate of
So
say.
Indian company is a NBFC.
Yeah, Indian company is an NBFC.
Okay.
It is registered with the RBI. Now, the first leg of loan which one of the group companies borrowing from a third party is around 10.5%. So the loan is passing through two entities which are related entities and then coming to India at a rate of around say 13.04%. So it is like an Indian company borrowing from a UAE entity at 13.04%. We have all the documents to prove that the chain and all. So, and we have also got the benchmarking done. But the AD banker is saying that the rate of interest is on a higher side and it has to be as per the market standards. So when we asked him what is the market standard, then they are saying that it cannot go beyond the Euribor, which is like 2.5% for 6-month Euribor.
Okay.
So I said it is not, practical for a foreign company to lend at 2.5%. So what is your take? What you suggest to to sell this through? Like, thank you.
Yeah. So in this case, see, 13% is obviously I think higher, because if you are getting the money at 13% from any bank in India, then why would you go to the parent company to have a loan at that price? But specifically this case we can discuss with some banker. There are many bankers present here, because we have to discuss it exactly on a case-to-case basis. Yeah, I was told that I can continue. That's it. Yeah, thank you so much.
So you are going to India? And I will invite C. Anuprita Mehta. She is our next speaker. Thank you, madam.
Good afternoon, everyone. Our next speaker for the session on liberalized remittance scheme is CA Anuprita Mehta. Anuprita Mehta is Chief of Taxation, Internal Control and SOX at ArcelorMittal Nippon Steel India, with over 25 years of expertise in direct and indirect taxation, international taxation, transfer pricing and merger and acquisition tax. A globally recognized tax leader, she has been featured in the International Tax Review's Global Tax 50 and is a recipient of multiple Asia Pacific Tax Awards. She is a sought-after speaker, industry representative and board member actively shaping tax policy and business excellence. So I would like to welcome CA Anuprita Mehta to cover the topic on liberalized remittance scheme. Thank you. We'd like to give a memento to the CA Anuprita Mehta.
Good afternoon, everyone. How many people from the industry in the audience? Okay, not too many. So I am also from the industry, and I think Mr. Saurabh Ajmera will be very happy that there is a good collaboration now between industry and the institute, the initiative that he was talking about. So I think I have contributed my little bit to that initiative. As a industry person, of course, the topics that we heard in the morning about ECB, OI and all of that, of course we do. So apart from the knowledge that I have, but I have my entire battery of consultants. So Darshana is one of my consultants as well. But this topic on liberalized remittance scheme, this is mainly or purely from my personal experience, because we all as resident individuals now are permitted to carry out certain transactions where we can remit foreign currency abroad for particular set of current account and capital account transactions. So I'm going to talk mainly from my personal experience. I've spoken with some AD banks for some nuances on the LRS, which I've tried to capture in my presentation to make it a little more interesting or case study based. Because when I remit, it is mainly for OPI or maintenance of relatives, close relatives abroad. So that's little limited, right? But just to make the topic more interesting, I've spoken to a couple of AD banks and tried to put examples. So earlier, Darshana also explained that there was a FERA regime which was more controlled, and now with FEMA from 1999, it's more of a facilitation approach with, of course, lot of governance and compliance. So this liberalized remittance scheme is also part of such endeavor by the RBI to facilitate certain transactions for resident individuals. And we are permitted to remit foreign exchange. There is a yearly limit, and the foreign exchange can be remitted of any freely convertible foreign currency. So it need not be dollar or UK, but any freely convertible foreign currency repatriation that you can do for specified purposes. So what are the purposes for which we can remit money? So it is for current account transactions, meaning for our travel and personal purposes, family and support for our close relatives abroad, for education purpose, for medical purposes, if you want to migrate or if you want to go overseas for employment, then we are permitted to remit foreign currency. If you want to give a gift to a relative or a non-relative, you can remit foreign currency. For capital account transactions, investment in shares or overseas instruments, you can open overseas bank account also, but of course you have to hold that money in foreign currency abroad in a foreign bank account. Then acquisition of immovable property is also permitted. These are broadly the uses which you and I as an individual would require the foreign currency remittance for. There has been a historical evolution of the LRS limits. So when the scheme was introduced in 2004, it started with a meager $25,000. And then as India's foreign exchange position grew stronger, the limits have been increased or enhanced. So from 25,000 in 2004, it became about $200,000 in 2006-07. Of course, evolving from 50,000 to $1 lakh. Then in 2013, there was this taper tantrum. That's a term that is used. So what happened was during the 2008 global financial crisis, US Fed Reserve decided to do quantitative easing, right? So they were just pumping in dollars in the economy, and they were buying US Treasury bonds. So interest rates, they fell drastically, and then all the foreign investors, they started using this, so-called easy money to invest overseas in markets like India. And this was happening for about 4-5 years. And then in 2013, the Fed Reserve chairman, he indicated that there will be a tapering down or a slowdown of this quantitative easing. And that created some tremors, so to say. And because of the reduced quantitative easing, the interest rates increased gradually. And then all the money in the Indian stock markets or the FDI in the country, it started reducing gradually. And then there was a flee of foreign capital from India, and that's why RBI had to reduce the LRS limits to $75,000. But then again, as the situation improved in 2015, till today, we are about $250,000. It's stabilized. During this geopolitical war, a couple of months ago, again, there was news that whether the government is going to reduce the LRS limit, but they didn't do that. Now, this aggregate limit of $250,000, it covers current account transactions, capital account, or a combination of both. So it's for, again, consumption or investment purposes. Who are the remitters? It's individuals, resident individuals. So companies, partnership firms, LLPs, HUF, trusts, they are not allowed to use the LRS scheme. And again, as we've mentioned earlier, though it's a liberalized scheme, but one has to be very careful in terms of carrying out the compliances. So how do you remit the money abroad through LRS scheme? Through obviously your authorized dealer. They act as an intermediary between the remitter and the foreign exchange regulations. Documentation, what is it typically? It's a permanent account number that you need and a Form A2, which clearly defines the purpose for which you are remitting the money. And there are, of course, certain undertakings and declarations that the individual remitter has to give. The authorized dealer will verify, they will carry out KYC, the anti-money laundering provisions, genuineness checks, etc., that they will carry out. And, but of course, the ultimate responsibility for compliance remains with the remitter. This is the typical Form A2 that captures the applicant's details, remittance purpose, supporting declaration, and the AD banker's certification as well. So maybe most of you may have seen the A2 form. So there are, all the possible purposes that are listed down in the form, and then you have to appropriately check in the purpose for which you're remitting the money. Using the appropriate code is very, very critical, because the RBI through the AD will monitor the purpose. So, even if, say, your TCS on a particular remittance is the same, say gift or maintenance of close relatives abroad, the TCS is the same, but the codes under FEMA A2 are different. So one has to be very careful in terms of what code you're using, because they track it appropriately through their internal systems. And the authorized dealer, of course, they will rely on the declaration that are made in Form A2. Whatever due diligence checks they have to make, they will do it. They will assess the genuineness of the transaction. Typically, for a capital account transaction, the AD that you're using, you should have a 1-year banking relationship with them. For current account transaction, this condition doesn't apply. For a new customer for the bank, especially for capital account, they will verify the source of the funds. So suppose earlier you had a different bank account where your major source of income was getting deposited, and you change your banker. So if you want to make a foreign remittance under LRS, unless there is a 1-year track record, especially for capital account transaction, the new banker will ask you that, you give me either the ITR return of, your prior year, or 1-year bank statement of your earlier bank, just to make sure that the source of funds are authentic and you're making remittance from, you know, legitimate sources. The AD bank will also collect TCS. Now, TCS framework, as most of you would know, you know, obviously it's like a TDS, so you can claim a credit of the TCS that is done by the bank during LRS at the time of filing your tax return. For salaried people like me, I also request my employer to consider the TCS. Many a times, you know, they will say that you get the certificate from the banker, but typically the banker, after they file their quarterly TCS return, they will be able to give you. But if you, you know, get appropriate details about the TCS and the bank's certain details, etc., and you also show a redacted version of your own bank account where there is an entry of TCS along with the foreign remittance, then your employer might consider the TCS in your ongoing payroll as well. So you don't have to wait for end of the year, or you don't have to wait for end of the quarter for it to get reflected in your 26 AS. So the rates typically for TCS, there has been, after April 1, 2026, there has been some liberalization or relaxation as far as TCS is concerned. So if it's an education loan, there is no TCS that is required. I mean, you're taking education loan and then you're emitting that for education purposes. If it's a self-funded education or medical need that you have to satisfy, then now after April 26, the TCS is 2% beyond 10 lakhs. Overseas tour packages, it's flat 2%. And for other LRS purposes, up to INR 10 lakhs, there is no TCS, but beyond that it is 20%. So maintenance of close relatives abroad, for gifts typically it will be 20%. Also for your OPI investments, it is going to be 20%. For opening a bank account overseas, it's going to be 20%. If you don't have a PAN, then the 10 lakh threshold doesn't apply. And also your TCS rate, it becomes twice the standard rate, but of course capped at 20%. No double taxation rule, which means that where TDS has already been deducted under another income tax provision, then TCS will not be collected by the bank. So for example, if there is a 10% TDS that is deducted on FTS when you make payment to a foreign consultant, the TDS is already done, right? So on that remittance, bank will not make a TCS, subject to, of course, you showing them the proof of TDS that is done. And assume a scenario where a remittance is rejected and the funds they return. Then the TCS that is already done by the bank, they are not going to refund that to you. So you will have to obviously claim that refund through your tax return. Now, what are the prohibitions and where you cannot use the LRS money? It's lottery tickets, sweepstakes and football pools. So sweepstakes and football pools are akin to gambling, so under Indian laws, so they don't allow it. Margins or margin calls to overseas exchanges or counterparties. FCCBs issued by Indian companies in the overseas market, and trading in foreign exchange abroad. So these, for these purposes, you cannot use LRS scheme. Also gifting foreign currency to another another resident. So one resident gifting foreign currency to another resident, whether you give that in India or in their overseas bank account, that is restricted. Remittances are also barred for FATF countries, Financial Action Task Force countries. So this was formed by G7 countries in 1989 or something like that to handle, financial terrorism, money laundering. So the blacklisted countries, currently it's North Korea, Iran, and Myanmar. So you cannot use your LRS scheme to remit to these countries. This 2,50,000 limit is an absolute annual ceiling. So even if you have invested, say, in OPI overseas, and you sell those shares and repatriate money back to India, but once your 2,50,000 remittance is done, even if you have repatriated anything back to India, in that financial year, you cannot remit anything more than 2,50,000. So retention and reinvestment. So what does it mean? So any income from overseas investments under LRS, they may be retained and reinvested abroad for, again, long-term investment strategies. There is also a mandatory repatriation of the unutilized or unrealized foreign exchange that you must do within 180 days. So suppose you've opened a foreign brokerage account for investment in shares of overseas listed companies, and you didn't find a good opportunity in investing in shares. Your money is just lying there. Within 180 days, you have to bring back the money to India. Family consolidation. So family members, they may combine LRS limits for joint investments, subject to, of course, co-ownership and transaction type conditions. So they also need to be co-owners of that property abroad, so that as a family you can combine 2,50,000 into number of family members, but they need to co-own the property. Now, because LRS is only permitted by resident, for resident individuals, a proprietor and the individual, so there is no legal demarcation, so to say, right? So if the individual is using LRS money for investment abroad or for any other purpose, then it's commingled. So the proprietorship and the individual, the proprietor. So same or common LRS limit of $2,50,000. If an LLP is sponsoring education, for example, of its partner, then it is a current account transaction for the LLP. So it is not the partner's LRS limit that you can use here, but because the LRS is done by the LLP or partnership firm for that matter, it is a current account transaction for the partnership firm or the LLP. Loans and gifts to NRIs and PIOs, I thought I will cover this, though strictly, it is in a way linked to LRS, and we'll see how. But if you want to gift to your NRI relatives in Indian rupees, in foreign currency if you want to gift, of course, that comes under LRS. But if you want to gift Indian rupees to your non-resident relative, then that gift has to be credited to the recipient's NRO account only and not NRE account. And it remains within the $2,50,000 limit because you're gifting it to a non-resident. Likewise, if it is a loan, it has to be an interest-free rupee loan. You cannot charge interest. And because it is a rupee loan, you have to credit that money to the NRI relatives' NRO account and not NRE, or it cannot be wired overseas also. And funds, the funds that are lent in INR, they can be used only for permitted personal or business purposes in India. And this loan will fall within the annual LRS limit because, again, you're giving it to a NRI relative. The repayment of that loan, it has to come through inward foreign currency or the borrower's NRO, NRE or FCNR account. And the loan has to, of course, have a minimum maturity period of 1 year. The loan cannot be used for chit funds or nidhi companies, agriculture, plantations, farmhouse, and certain real estate business. Again, this may be important for individuals, the resident versus non-resident jurisdictions in terms of the various accounts that are permitted to be held by NRIs. So, NRO account that is opened by an NRI or a PIO. So from there, you can repatriate up to $1 million per year, subject to, of course, 15 CA-CB compliance. And LRS caps and TCS will not apply in this case when you're remitting money from the NRO account. Now, NRO to NRE shift. Again, a transfer from a domestic NRO account to an NRE account is outside the scope of LRS. TCS also doesn't apply in this case. From NRE to NRO account, the shift is much easier. But from NRE to NRE, NRO to NRE, you have to do these compliances for Form 15 CACB. Compliance and reporting caution that we were, I just briefly touched upon earlier. So, gift that you're making to, any overseas person, or if you're making remittance for maintenance of relative abroad, be very careful in terms of what code you are using on the form A2. Again, reporting any ODI as OPI or vice versa, again, is a problem. You have to then regularize it, may face compounding also. There was one situation somebody was telling me, as an authorized dealer was telling me that a person remitted money under LRS for OPI purposes, and then the investments were sold, and those proceeds were used for investing in one unlisted project for EB5 purposes, for the visa purposes. And that was not reported to RBI. So the ideal way it should have worked is that the OPI sale proceeds should have been repatriated to India, and then investment could have been made under the ODI route with appropriate RBI reporting. So this also required the regularization and compounding as well. Certain compliance traps, some practical examples. If a partner remits, say, $50,000 under personal LRS to pay the firm's overseas vendor, so that is again violating FEMA because LRS cannot fund business liabilities. It has to be a transaction of the company and not of the individual partner under LRS scheme. Likewise, HUF Karta, if he remits from the HUF bank account, then again it is not permissible because HUF as an entity, association of persons, cannot do LRS transaction. Capital pool routing. A father gifts a certain amount of money to an adult son who remits under LRS to acquire offshore equity. So again, that is not permitted because capital account remittances, they require an independent source of funds. This we discussed, family, they can combine LRS limits and provided, of course, for capital account transaction, every member should co-own the overseas asset. Also, some quick things, for individuals that may be helpful. So resident individuals, they may open and hold foreign currency accounts under LRS without prior RBI approval. LRS does not permit opening them within India. So obviously you cannot hold foreign currency account in India as a resident Indian. Grandparents and grandchildren, they are not close relatives under the definition under Companies Act. So why this is important? For maintenance of close relatives abroad, grandparents cannot remit money under that category to grandchildren who are overseas. But of course, they can use the category of gifts because gift can be given to anybody. So this is again a nuance I learned from my personal experience, which I thought is worth sharing. Dividend versus capital gains. So foreign security dividends, they must be repatriated within 180 days and cannot be reinvested abroad directly. So dividends, because they come under current account transactions, you have to apparently bring it back to India, and then you can again send money under LRS if you want to reinvest. But capital gains, if you're holding some investments abroad and there is capital gains on sale of shares, that you can reinvest. So again, this is a finer nuance which we all should know. ESOP remittances, Darshana covered it. There is no limit for ESOP related remittance, but whatever amount you are remitting will be adjusted against your LRS limit. So if you remitted $10 million, then that gets, you can remit 10 million, but it will be offset against the 250,000 LRS limit. So at least for that financial year, under LRS, you cannot send any money separately. Yeah, so that's about it. So if anybody has any questions, then I'm happy to take, yeah. Yeah, so this NRO account, so if the non-resident is having NRO account in India, then there is a $1 million limit. And for NRE account, I think it is freely repatriable. Yeah. Yes.
But can he take this is capital account transaction, can he take money as a gift from his father in his NRO account and then he can send abroad?
So Indian rupee gift may be allowed in the NRO account. So a resident can transfer Indian rupees in the NRO account.
Okay.
And then that can be repatriated with 15 CACB. So gift, if the son, he will not be chargeable to tax in India for the gift transaction, right? Because close relative.
Okay.
So then, in my view, you can remit it, because even if you do 15 CACB, it's going to be, I mean, there's no tax on that.
So as a gift, even in capital account transaction, he can take in his NRO account and transfer. That's no problem, na?
Indian rupee gift.
Yeah.
In my view, yes.
And is there any limit of, like you said, 1 million limit? So in gift account, is there any limit?
No, no. Overall NRO account limit is 1 million.
1 million per financial year.
For the? But will it be, if it's a... Correct, but if this money is coming in NRO account, his
NRO
question
account.
is NRO account. Money is coming in NRO account.
But
because it's a gift. And yeah, and in any case, even when you are gifting, I think that LRS will apply, right? Correct. Correct, yeah.
But 1 million
even though through
limit is
NRO, even...
No, 1 million, if NRO have his own income, then no 1 million limit is not there.
Income of a current year can be repatriated after paying taxes without limit.
Okay. Okay. Okay.
For assets, he can repatriate out up to
Exactly.
These are originally his own.
Yes, his own source.
For any
Okay, all right. Thanks.
Thanks, Hitesh.
Hi, I have a question whether a resident individual, when the person invests in US listed shares, the person gets a dividend. Now question number one, when the dividend is lying in that account and it is utilized as per the FEMA guidelines, is it okay or not? Second, from that US account, dividend amount is repatriated to the Singapore account and it is utilized there. Is this allowed? So the money is not coming to India, it is either utilized in US or from US transferred to Singapore, from Singapore it is utilized. In both the questions, is it a contravention or is it allowed?
So your first question, you mentioned that, so
it
so dividend money, it has to be brought back to India, is what I understand from the authorized dealer.
Correct. And the second instance that from US, that dividend amount is going to Singapore. From Singapore also it has to be brought back to India, something like that, or if that
dividend source has to come back to India.
And there it has to be go where?
Yeah.
Okay, thank you.
Just a connected question. You said dividend has to come back, but capital gains can be reinvested. So when we say capital gains, is it only the appreciation and the principal? Like if I invested 100 and there's appreciation of 120, is it that 20 has to be can be reinvested and 100 has to come back, or we can talk about
The
whole
entire
the
120.
entire. Okay.
Miss, you'd mentioned in an earlier slide that a resident Indian can open and hold a foreign currency account without RBI approval?
Subject to LRS, $250,000.
Yeah, subject to that. That $250,000 is overall limit over a couple of years or annual limit?
It's an annual limit.
Okay.
Financial year wise, April to March.
Okay. And second question about an NRO account. They have to convert it to a NRE or an external account in order to remit the funds abroad. Is that correct?
Yes.
Because
NRO, money in
yes,
NRO, you
NRO
can move
account.
it to NRE account.
And then remit it abroad.
And then you can
So
remit.
the bankers cannot give you a problem because there's an instance where the NRO account is there. They've sold some property many years ago. They have the funds over here and they want to convert it and remit the funds abroad. But the HDFC bank is giving them a problem. So if there are any bankers over here, I believe there are some bankers over here who will be able to solve that problem.
I don't know who are the bankers here, but you
We
can
were told
connect
by an
with them
earlier
offline.
person. Yeah.
But then
Okay.
I think in my view, a practical way to do this is to prove to the banker what was the original source of funds, when was this
Yes,
property
all that
bought,
is there.
then capital gains on the sale of property
All that
is
is paid. They're paying
and
regular
then
taxes over here. So I believe the CA has to give them a certificate which is already given.
Hmm.
But the HDFC bank is giving them a problem. So I think we'll have to take it up with any of the bankers who can solve this problem. But they're allowed to convert and remit the funds because they've paid the taxes. That is my
Yes,
question.
yeah.
Thank you.
So my question is that the LRS limit of 2,50,000 also covers investments that are done in Gift City.
Correct, yes. Yes.
Okay. And if I want to remit funds from my NRO to NRE, both accounts are in India only. So will that also be covered in the $1 million?
Will that be covered in?
In the limit. So from NRO, I can only repatriate up to $1 million.
Correct.
So if I'm transferring from NRO to NRE, will that 1 million be covered in this?
It will be.
Thank you.
Ma'am, there is an anomaly. As far as income tax is concerned, the individual and the HUF are treated akin. They are together. But when FEMA comes to FEMA, FEMA doesn't think that way. Like the residency, what they think for 182 days for Income Tax Act is not the concept for FEMA that talks about only your intention. So much so, there has to be a correction or amendment, or it should be brought to the thinking of RBI or central government, whosoever it is, to make it individual akin to HUF and vice versa. And the HUF should also be allowed to remit 2,50,000 or whatever it is, the remittance, whatever limit they are giving, to the HUF through the Karta.
Okay.
Because that is the only benefit what HUF can get in India. HUF is the only concept what is not practiced or understood by the tax authorities or even any bureaucrat in this country, though most of them are Hindus.
Sure. Yeah. So I hope now you can have a very hearty lunch and be geared up for the more heavy topics after the lunch session. Thank you.
Excuse me, ma'am. I just have one question, if it is. Yeah, it was from a dividend repatriation purpose. So the amount of investment that was made, that was through foreign source at the time of him being non-resident. Now he is a resident for past 2 years and has been receiving dividends in his foreign bank account. Do I still need to repatriate under the 180 days?
No, no. Because this was foreign source dividend when he was outside India through his foreign source income.
Okay, so any fresh investments from Indian source needs to be repatriated, the dividend?
Under LRS.
Yes, under that. Thank you so much.
Good afternoon, everyone. CA Garvita here, again standing in between you and your lunch. So, on behalf of everyone present here, I would like to extend a heartfelt vote of thanks to CA Anuprita ma'am for her insightful session on LRS. LRS has become one of the most relevant topics today, with more and more HNIs looking for global investment opportunities and international exposure. Understanding the regulatory framework has become more important than ever. Ma'am, thank you for simplifying the provision of LRS by explaining the eligibility, remittance limits, permitted purposes, and most importantly, the common mistakes and violations that often lead to inquiries by FEMA. Your practical insight will certainly help us all to advise our clients more confidently and compliantly. Once again, ma'am, thank you. And yeah, everyone can proceed for lunch. We will meet back in half an hour.
The learned speaker Palav, the coordinator Amit Joshi, Garvita, the earlier speaker Ankita, my colleague and very dynamic in regional council, chairman of PR committee and also international tax committee, vice chairman CA Vijendra Jain, all audience. Let me compliment the chairman WIRC for a fantastic program on Foreign Exchange Management Act. And I'm very happy to see so many people attending the FEMA conference. Recently, Government of India has started with FCNRB scheme, and people are telling that the yield of FCNRB is as high as 16%. The non-resident Indian remitting money and putting into FCNRB, and Government of India is expecting huge inflow of funds into FCNRB. All the banks, PSU, private banks, everybody is doing roadshow abroad, be it US, be it European country, be it Middle East, be it Singapore. And like past, earlier also we had some bond introduced by some of the bank, wherein the purpose of bringing such scheme was that the money of non-resident Indian, which is parked out of India for various reasons, is being brought in India, and because of which we as a country have an advantage of having better foreign exchange management and better inflow of our own money of NRI, which is parked out of India. I think, this is going to be a momentum for next couple of months, and at that time, it is a right thing to understand the various aspects relating to FEMA, be it, the liberalized scheme, be it import-export, which Palav is going to take up. And I think almost 900 billion worth of import and equal export is happening in India as per 2025 data. We welcome the Honorable Chairman of Western India Regional Council, C.A. Saurabh Ajmera. Please have a big round of applause for him. As I said, a fantastic idea from him to organize a program on FEMA. So import export, I think, strategically we as a country have done a lot of strategies. And if we see right now, curtailing the import of the fuel is one of the most important step which government of India has taken. And if we see the outflow of foreign currency largely into the fuel, and which rightly government is strategically promoting the other sources of energy, because of which the reliance on the petrol diesel reduces, and we focus on other sources of energy like solar, etc. I think the overall, if we see the spending of India into the foreign currency, largely it is, apart from the petrol or diesel, largely it is export of goods. And if we see the import, it is largely the export of services, where we are exporting the largely the, it could be software, or it could be such IT related services, or it could be the KPO, BPO, what all industries we have in India. And as far as China concerned, apart from petrol and diesel, the maximum import of good is happening through China. That is what we see overall. And also, of course, capital goods, the vehicle or some luxurious cars and all those things are there. If we try and analyze this data, and I think in almost all sectors, India is taking steps that in coming 3 year, 5 year, 10 year, you would see the much improvement in the balance of trade happening, and the reduction in import and the increase in export will happen. With this, once again, welcoming all of you to this import-export session, which is to be taken by Palav Shah. And let me request our coordinator, Shri Amit Joshi, to formally introduce Palav.
Good afternoon. Our today's speaker, C.A. Palav Shah, is a partner in BBSR and Associates LLP. She is handling corporate and international tax and regulatory services. She is having more than 19 years of experience in taxation and FEMA. She specializes in corporate and international taxation, FEMA, cross-border transaction, structuring dispute resolution, and advising multinational companies on inbound and outbound investment. She also leads the firm's Japan corridor for the West region and plays a key role in advising Japanese and life sciences clients on strategic tax and foreign exchange matters in India. With this introduction, I invite C.A. Palav Shah. For the memento, Chairman sir, please welcome.
Good afternoon, everybody. And thank you so much, ICI, for this opportunity, for letting me present on FEMA. Just a brief introduction. My name is C.A. Palav Shah, and I'm introduced. But why FEMA? And why I chose FEMA as my career? I was very passionate to learn how does the transactions in the country, outside the country work, and how do the import-export transactions work, and who governs all these transactions, basically. So, one very well-wisher in my family, who's a FEMA specialist, one of my family friends, said this is one area, as a fresher, you should watch out for. It's a very interesting space. And that's how I joined FEMA as a career in BBSR and also with international tax. Also, there were some senior partners within the firm who were practicing FEMA, and I reached out to them, look, I want to specialize in this area. And ever since then, I have not looked back. Not a single day is a dull moment. Every day we are grappling with clients with something new, something unique, which we have never dealt with before. So why import-export? I'm sure since morning we've had many sessions on FEMA, right? But why this topic is so important today? The import and export guidelines are set on an anvil. They are going to change with effect from 1st October 2016. Sorry, 1st October 2026. So we've seen a lot of recent news items, okay, wherein there is ED investigation on a lot of companies, either because they have not realized their export proceeds on time, or there are fictitious bogus payments, or there is some custom duty fraud, under a wrong declaration made under the custom code. There is extensive investigation by these agencies to find out what is a genuine transaction, what is not a genuine transaction. The IDPMS and EDPMS, as we call it, the import data processing system and the export data processing system, right? That needs to be knocked off once your payments have been made. RBI is very, very closely watching this space. It has directed all AD banks and a few of my colleagues who are working with leading banks need to bear this in mind, that with effect from 1st October, these policies are changing. A lot of powers were earlier with the Reserve Bank of India, now have been delegated to the AD bank. So there are a few banks who have also reached out to us in terms of what should be their standard operating procedures, how they should draft them, what are the do's and don'ts, what are some of the provisions that they should be mindful of. So this is a slide basically capturing what is the investigation the ED is after, and therefore import-export regulations subsume a lot of importance. As CA practitioners or CA consultants, it is very important that we understand the nuance around it. We've all known that the income tax authorities are far ahead in terms of their digital gateway presence, in terms of their adoption of tax technology. RBI is no less. Of course, it is not as advanced as the income tax authorities, but RBI is also picking up in terms of lot of automation of how they are tracking the transactions. So some of the transactions are now being tracked on a real-time basis, and that is why there is a need to update all transactions within the given portal. There is a very strict evaluation of the importer-exporter code, which is mandatory for any importer and exporter. Unless you have this code, you will not be able to import or export the transactions. We've also seen a lot of suppression on the value of the goods that are imported into the country, right? If I just see this slide of mine, there was a very recent incident where a luxury item of furniture was imported into the country, but the value that was declared was very, very minimal, just to evade the custom duty. This is how ED tracks the transactions, and then it was discovered that the value of the branded furniture is much, much higher than the value disclosed. So ED is regularly tracking the transactions, especially when the IDPMS, EDPMS are outstanding, and therefore, as a consultant, what we need to advise our clients is, it is very important that whenever our import happens in the country, it is knocked off when the payment is made, and likewise when there is an export happening, we knock it off in the EDPMS system. Okay, so this is a brief overview of how the import guidelines work. So basically Section 5 of FEMA governs the import transactions in the country, And mind you, import and export transactions are current account transactions. They are allowed unless prohibited, right? So any import or export transaction would fall under the gamut of current account transactions, and therefore generally permissible unless it is strictly prohibited under the rules. Now many times, for people who are starting FEMA, they are not very sure of how do we do our research. So basically, RBI comes out with ABDR circulars on each of the topics. Let's say in this case, import-export. Then those APDR are subsumed into a master circular, and that is where it's available on the RBI website. What is the role of the AD bank? The role of the AD bank, which is the authorized dealer bank, is to facilitate, make the clients understand of what is the law, what is RBI's view on a particular matter, and then guide all the clients. Unlike income tax, where we have a lot of past precedents, right, judicial precedents, we are able to understand that, okay, this was the view the courts have taken. But FEMA is one topic where unless you do it practically, you will never understand the nuance of the law. And so the more you do FEMA, the more you will be practically up to speed in terms of how RBI interprets particular things or particular topics. There is also a separate master direction carved out on reporting. Earlier it was all within one particular import-export circular. Now there is a circular RBI master direction on reporting. So let's say if you have to do any reporting under FEMA, you have to straight away go to this master direction, and then you have to look at which particular regulation you're talking about, and then look at the relevant clauses in that reporting. Yeah. So these circulars keep on getting updated. Yeah, and every time you go onto the website, you have to check what is the latest law, what is the latest circular, and then advise your clients. I did mention about 1st October 2026, the new regulation relevant for import and export is now FEMA 23R. So please go onto the RBI website and check for this circular. Substantial powers have been delegated to the AD bank. Now the question is, how do AD bank will draft the SOP? So there is a guidelines which is given by the FEDI in terms of how the AD bank should go about drafting their standard operating practices. These are a few definitions. Export for us in any common parlance would mean wherein the goods are taken outside the country, or a provision of services from India to any person outside India. These definitions are provided in the Act. Unlike the Income Tax Act, which is voluminous, the FEMA Act is very, very thin. If you know FEMA Act, it's not the end of it. The entire law is contained in the rules, regulations, and the master directions. The FEMA Act is only an enabler to help you understand what is the basic provision. So the export definition is given there. The import definition also says it means bringing into India any goods. The buyer of such goods and services is referred as importer. I'm sure all of us understand this. Now, what is the government trying to do? They're trying to make sure that the balance of trade position is in check. So what is the balance of trade position? Whenever you have exports minus import, there has to be a surplus, and that is where there is no trade deficit. Let's say if there are more imports than exports, then yes, there is a trade deficit, and it's a cause of concern for the government. That is why you will see there are much more incentives on the export side to clients to encourage them to make more and more exports. I mentioned about the IEC code, which is a 10-character alphanumeric code. Unless you have this code, you will not be able to do the import-export. What are few mandatory documents? So for export of goods, it's the bill of lading, lorry receipt, railway receipt, postal receipts, commercial invoice, shipping bills, and for import of goods, of course, the mandatory is bill of entry, and otherwise the bill of lading. Now, why this particular point is very, very relevant? every alternate day almost we have clients coming to us saying that there are overdue payables which are more than 3 years, and that warrants an RBI approval, because under the law it is written that ideally your imports have to be settled within 6 months. If at all you can't pay within 6 months, you have to seek an extension from the AD bank. AD bank also has powers to to grant the extension up to 3 years. But when the payment cannot happen beyond 3 years, you have to go to RBI for an approval. Now, when you go to RBI for an approval, obviously RBI is going to wanting to check whether these imports are genuine or not. You will need to have all the supportings. And that is why, as an importer, we need to advise our clients that all this should be in place. Likewise for exports as well. So this is some of the very, very important points in the import regulation. Let's say if you have done an advance payment for the import of goods, you have to make sure that the payment has been received within 6 months. What happens if you don't receive the import of goods within 6 months? Either the money should be refunded back, or you seek an extension from the AD bank. But this is very, very important, and this is also where clients go wrong, that they have given, let's say, an import advance, but they have not physically realized the goods within the given time frame. For normal imports also, the timeline is 6 months, that ideally when you make an import, you have to pay the overseas supplier within 6 months. There are rules and law to provide that yes, there is an extended period available, up to 3 years for capital goods and up to 1 year for non-capital imports. And this would be treated as a trade credit. Now, trade credit is something which is explained in the external commercial borrowing circular. Any credit that you take from an overseas supplier for a period of 1 year would be termed as a trade credit. I mentioned about the extension of timelines. So at a given point in time, the AD bank has power only to extend it up to another 6 months. So let's say if you're not able to pay within the first 6 months, then the AD bank would extend it for another 6 months. Total extension cannot exceed 3 years. The power is not within the AD bank. You will necessarily have to go to RBI to seek an approval. It is very important that the invoice for which you're seeking an extension should not be under the investigation by the Directorate of Enforcement. So there are also provisions under the law which says advance import of goods and services. Now there are thresholds permitted. Up to what amount can you make an advance payment? If it is goods, the amount is USD 2 lakh. If it is service, it is USD 5 lakh. If you want to make any advance beyond these limits, then you have to make sure that you get a letter of credit or a guarantee from a bank of international repute. Very recently, we advised one of the clients who wanted to make an advance payment for some services, and that amount was very high, which was exceeding USD 5 lakh. So we told them that, look, you will have to take a guarantee from the Bank of International Repute. They said, no, we don't want to do it. We will not obtain this. So what is the alternate? We advised them, then we have to go to RBI for an approval. A very proper carved out strategic application was made to that RBI, that why this kind of payment has to be made. And after a lot of conviction, RBI did give us this approval. But in that approval, the RBI also mentioned that the client should not be under investigation by the Directorate of Enforcement. So as consultants, we should be very mindful of any FEMA advice that we give to our clients. One of the very important questions we should ask is that are you under investigation by the ED? It's not a showstopper. If they are under ED investigation, then there are certain do's and don'ts that need to be followed. So what is coming in the new regulation with effect from 1st October? If you see, there is a lot of content on the left-hand side, right? But there is very minimal content on the right-hand side. And why so? Because RBI has simply put in the 23R that the AD bank has to decide the policy. So the onus is on the AD bank now. right? So what are AD banks doing? They are prepping up for this 1st October deadline. They are going to put it up on their website in terms of what are the do's, don'ts, what are the policy, that they believe are the right way out. So as, for our clients, we can just engage into some conversations with the AD banks. And also it is very important which AD bank do we choose, because in our experience we've seen different AD banks may have different views on a particular matter. Not necessary, all are the same, and not necessary they are the right views also. It may be a view, but yes, we have to take a practical call on that yes, and also there is a lot of medium to check it informally with the RBI, especially for any large transactions that we undertake. So it is better that on a no-name basis we seek RBI's view on a particular matter and then advise our clients. Over here also, in the advance remittance, the thresholds have to be prescribed as per the bank's internal policy. So every bank is going to make their own internal policy in terms of what are the advance remittance limits. Set off of export receivables against import payables. Now this is a very, very important circular that had come in December 2020. Let's say if you have an import of $100 and if you have an export of $300, right, from the same overseas supplier. Initially what was happening before this circular, you were mandatory required to pay that $100 and realize those $300 in the country. That was the law. Now with this APDR circular, a setting of provision was allowed, which means that if I have to import and pay $100 and I have to receive $300, then net if I receive $200, it is fine. Subject to a lot of conditions. It is the same overseas supplier. It falls within the same calendar year. I am not trying to set off export of goods versus services. I can set off only goods versus goods and services versus services, right? Any set off that I do should not result in any kind of tax evasion. And any of the invoices should not be under the ED investigation. If you see, there are certain other conditions also, but these are largely the most relevant conditions. So if you're guiding any of your clients in terms of a set-off, then you need to make sure you look at this 4th December 2020 guidelines. So what's happening now, but from 1st October, we understand that RBI is going to take a very, very lenient view on the set-off. And every bank will now decide in terms of how they will allow the set-off. There is also a discussion that export of goods can be set off against the services and vice versa. So that's a big, welcome move by the RBI to allow something like this. Of course, it has to be blessed by the AD bank. And any set off that you do has to be vetted by the AD bank. Third-party payments. Let's say if we import from X company, and now the X company says instead of paying me, you pay Y company, which is my group company overseas. Then is that kind of a transaction allowed? The answer to that is yes, provided it was pre-agreed through a tripartite agreement. It cannot be an afterthought that let's say I imported from X and now X is telling me you pay Y. That's not doable. If it was originally agreed that look, you will have a payment due to me, but because X has to anyway pay Y, then through a tripartite agreement, through the documentation, the invoice, it is mentioned that the A company will pay Y. Then it is doable. There are conditions under the regulation prescribed for that. There are also certain cases where there is an interest on import you may have to pay because you have not paid the imports on time. Then yes, that is also allowed, provided this is exceeding the 3-year time frame. Everywhere on the slide you will see with effect from 1st October, it is saying it is permitted, provided as per the AD bank's internal policy. Okay, let's say if I import, digital services or software, right? An IDPMS, I'm importing a service. there was no requirement for me to report a import of service in the IDPMS. But now the important changes with effect from 1st October 2026, I will have to report that service as well, which means for all our clients who are into service, this is a very, very important change. Yeah, so just for the benefit of everybody, I've tried to put some case study. Let's look at this case study. Indian company ABC entered into a contract with UK company for import of goods worth USD 20 lakhs and import of services worth rupees USD 7 lakhs. ABC received the goods on 1st December 2025 worth USD 20 lakhs and paid USD 12 lakhs on 31st March as import payment to UK. Now on 18 July 2026, ABC wants to pay the remaining amount. UK company is asking ABC to pay interest due on late payment. So let's look at the questions. I just give you 2 seconds to understand the case study a little better, and maybe you can just read it for your benefit. Okay, so what are the questions? What is the time frame for import settlement? I imported the goods on 1st December. Who's saying 180? And who's saying 3 months? Okay. So the answer is 180 days, 6 months. Any import that you do into the country has to be repaid within a time frame of 6 months. Okay. Now the question, and very, very relevant, and trust me, this is one of the most common pertinent issue that clients face. You know, overdue payables for more than 6 months, 3 years, so on and so forth. And when they go to the bank, they are under the impression the bank will allow them the remittance, but then that is where bank says, no, sorry, please get me an RBI approval. So over here, now ABC wants to make the payment on 1st July 2026. As somebody mentioned over here, the time limit was 30th June, right? So since you did not make within the 6 months, you have to now go to the AD bank. I'll just repeat, you have to go to the AD bank because the power till 3 years is with the AD bank. Anything more than 3 years, you have to go to RBI for an approval. Okay, so original time is to realize the 6 months. Now you can extend another 6 months. Then once those 6 months are over, again 6 months, up to 3 years. That is correct. That is correct. So in this case, yes, ABC will have to go to the AD bank to seek the extension. Whether interest payment is allowed on overdue payables, the answer is yes. Okay, let's look at another very interesting case study. There is an Indian pharma company entered into a contract with a Singapore company. Import of goods is USD 10 lakh dollars. Export of services is USD 3 lakh. Okay. ICO has paid an advance of 4 lakh on 1st December 1, 2025. ICO imported goods worth USD 10 lakh on 5th June 2025. So, okay, I'll give it in the order of importance, the facts. ICO paid US $4 lakh on 1st December 2025 as advance import for remittance to ESCO, and it imported goods worth USD 10 lakh. This import happened on 5th of June 2025. So now coming to scenario 1, what is the time frame for import of goods in case of advance remittance? Is there any non-compliance? Within how much time? Correct, correct. So when you have made a advance payment on 1st November 2025, within 6 months you should have made sure that the goods are imported into the country, right? In this case, there is a non-compliance because the import of goods has happened only on 5th June 2025. So you have already exceeded the 6-month time limit. Either you take an extension from the AD bank or you refund this import advance what you have, you take refund of this import advance what you have paid. Because you are not complying with the law otherwise. Right? So, are there any extra compliance requirements for making advance payment? Anybody on this one? In this slide, I had mentioned that if you are doing an advance against goods, USD 2 lakh is allowed. Anything more than that, you would need a guarantee from a bank of international repute, right? So in this example, I have made payment of USD 4 lakh. Therefore, it cannot be made unless I fulfill the conditions which are prescribed under the law. It is as detailed as that. Okay, let's look at scenario 2. See, ICO exported services worth USD 3 lakh on 1st November. Export dues are yet to be received by ICO even after 6 months. ESCO instructed ICO to make payment to its group company, which is in Germany. So the question is whether third-party remittance is permissible under FEMA import regulations, and if yes, what are the conditions? Yes, yes. Thank you so much. So that is absolutely correct. You need to have a tri-party agreement in place, and even if not a tri-party, at least a letter clearly documenting the invoice, also mentioning that the recipient of the amount will be the German company and not the Singapore company. So there are conditions in the law and you have to comply with those conditions, right? Okay. And here is the most interesting question. Can ICO set off the import payable of goods against the export receivable of services? Okay. That is absolutely correct. We are in July today, 18 July 2026. Today the law does not permit you to set off an import of goods against the services. With effect from 1st of October, these guidelines will change and that may permit you to set off the goods against the services. But you have to check with the bank in terms of what is the policy that they have laid out. Okay. A lot of times our clients reach out, look, I had an import payable of so and so amount, but I can't pay the entire amount. So can I write off that amount? Okay, so this is a very common question again from clients to us as consultants. So what do we advise them? So if the AD bank is satisfied for the reason that why this import payment cannot happen, then up to 5% of the invoice value can be written off, right? Provided there are conditions attached to it. The case is not subject to any civil or criminal suit. The importer is not under investigation by the Directorate of Enforcement. Internal inspectors or auditors should carry out random checks. An AD bank may close the bill of entry if the write-off is on account of quality issue, short shipment or destruction. Recently we had a client scenario where the Indian client was an importer of luxury branded goods. But it being luxury branded goods, either they were defective or they were not as per the ideal brand standards. So client obviously did not want to make payment for those kind of goods. So at that point we advised them that look, up to 5% of this you can write it off, but you have to inform your AD bank and close the IDPMS. This is also where many clients don't take it seriously, that the IDPMS, EDPMS is outstanding for a very, very long time. And the reason why this is now chronic is because there are straight away notices coming from the Directorate of Enforcement. So if you don't caution your client that you need to resolve this at the earliest, the client may be at a risk of receiving a notice from the DOE. Right? So this is one exercise we should tell our clients to focus on, to take the dump from our AD banks and resolve it at the earliest. There is also a welcome clause in the regulation which says that if there are small items below 10 lakhs, AD banks may allow it, the IDPMS, EDPMS automatic set-off basis the declaration given by the importer. So these are for small minuscule items where you need not go to the RBI or the AD bank also. This is suo motu which you can use basis declaration of the importer to set it off. This is one particular clause on how should the import documents be received. Ideally, the AD bank of the supplier should give the documents to the AD bank of the importer. There are very few scenarios where there are exceptions, that where the importer himself can take those documents from the supplier of the AD bank. There are certain limits, thresholds provided under the regulation. Let's look at this another case study. Indian company ABC entered into a contract with its parent company in Singapore for import of goods worth USD 350, import of services worth INR 9 lakh. ABC company received the goods worth USD 350 on 1st of July. ABC company received the documents from SAC for the import of goods. ABC company made payment of USD 340 against the import of goods made of 3,50,000. Date of import of services is 1st February 2026. Now let's look at the questions. Whether ABC company can write off the remaining amount to be paid against the import of goods and close the IDPMS entry. So I'll relay the relevant facts. The goods are worth USD 350 and ABC has already made payment of 3,40,000 USD dollars. So what is outstanding is only $10,000. So can ABC company write it off? Yes, yes, that is correct. All of you are very, very attentive. Full CP hours. So that is correct. That 10,000 certainly can be written off because it is less than the 5% threshold. But of course, you have to keep your AD bank in the loop. Yeah. Now, another important question. ABC company is unable to pay against the import of services worth $9 lakh. Worth 9 lakh INR. Whether write-off of remittance against services is possible and how this entry will be closed in IDPMS. Okay, okay. So now this 9 lakh, can they write it off? Can ABC write off this entire INR 9 lakh rupees? No, but you have imported worth INR 9 lakh rupees, right? You have already imported. So now you have to make the payment since it's unpayable. So the question is, can you write it off since the ABC company is not able to make payment? Okay. I'm just being a little mindful of the time. Yeah. So yes, a write-off is possible. Okay. There is no explicit mention about this fact for a service because service is not reported in IDBMS, and somebody was sharp enough to identify, when I try to play around with that question, that service is not reported in IDPMS. So technically you can write it off, but what we generally advise is that it is better you take bind of your AD bank and some counsel opinion of why a write-off was warranted in the first place. To show some kind of difficulty, let's say if the ABC Indian company went insolvent, right? So there are little more liberal views given to such kind of companies who are going through a financial difficulty. Yes, please. Sorry, can you be a bit louder? Yes, yes. But generally what happens is that these are group companies, typically. So in that case, there is a declaration which is taken from the overseas company. And you're absolutely right. If it's a third party, they may have an objection and they may not allow a write-off. In that case, the question will never arise if the other party does not agree. But generally, we've seen cases where clients have transactions with related parties, with their foreign, companies who are very cash rich, and they don't mind, writing it off a small amount. Okay, so AD Bank will ask for reasons. The first and foremost thing, we have to show that, look, we made enough attempt. In case of import, the understanding is a little different. Let's say when there's an import, they would look at your financial position of, what transpired you to not make the payment. And did you have a genuine difficulty? Did you have a bad year? Did you have a COVID kind of scenario? Did you have any kind of this? And therefore, if you plead that there was a financial difficulty or some other very strong reason, in that case, they will give you an extension. But let's say if an export receivable is overdue, then what happens is you have to convince the AD bank that, look, I made enough attempts to recover that money, but my overseas party is insolvent or having some financial difficulty because of which they are not able to pay. They will not pay today, but they will pay after 6 months. So that kind of, banks are considerate and would agree on that kind of an extension. Yeah, we spoke about this. Sorry. Yeah, so coming to export regulations, again the way how import is regulated by the DGFT, exports are also regulated, and exports to a large extent because this is foreign currency coming in the country, right? So what governs the export under FEMA? It is section 7 of the FEMA Act, read with the current account transaction rules. Similar to import master direction, there is also an export master direction, which is a culmination of your APDR circulars. And there is a one checkpoint where you will be able to refer the rules and regulations prescribed by the Reserve Bank of India. Again, over here, in case of AD, in case of export, a lot of powers have been delegated to the AD bank. So it is very important that you have a very cordial relationship with your AD bank to make sure if situations like these arise, what we discussed, the AD bank is more than forthcoming to support you on that. Similar to what I mentioned, a master direction on reporting, this is a separate master direction which has been carved out. Any transactions relating to export of services or export of goods would find place over here in the RBI master direction. So one may need to refer that. And the circulars, whenever there is a change, it is notified through an APDR circular, which gets subsumed in the master direction. Again, over here, it is important to note that a notification FEMA 23R, which is going to be in effect from 1st October 2026, is most relevant. Yeah, sorry. There's one important point I wanted to also discuss on the merchanting trade. Anybody who's briefly aware of what a merchanting trade is? Yes, yes. It's not exactly high seas, but yeah, something close, yeah. Yes. So it is a case where the goods do not enter the domestic tariff area. There is a resident person who's importing the goods, but at the same time he also has an export order for the same goods. And therefore, he instructs the importer who's outside India that look, instead of sending the goods to India, you please send it out directly to my customer who's outside India. So technically, the goods never reach the Indian borders. They, from overseas to overseas, they get ran, but yes, because a resident is involved in terms of the import leg and the export leg, this is known as a merchanting trade. Now, this is also a very, very common transactions for clients who are regularly into import and export. And there are a host of conditions mentioned in terms of an MTT, what needs to be complied. I'm going to describe or discuss some of the very, very important conditions. As I mentioned, for a trade to be classified as a mercantile trade, goods acquired shall not enter the domestic tariff area. The entire merchanting trade has to be routed through the same AD bank. Reason? Because the entire transaction has to be completed within the 9-month window. And this is the most critical condition of a merchanting trade. There have been practical cases where clients have reached out and the entire leg on the import and the export have not complied within the 9-month window. And that is where the clients have gone wrong, and we had to direct or guide them to go to the Reserve Bank of India to seek a post facto approval for regularization. Okay, goods must be permitted as per the foreign trade policy. So of course, at both the legs, when you import and export, these can't be goods which are prohibited by the FTP policy. There should be no restriction on such kind of goods. The MTT transaction is allowed only if the net result is a profit. Let's say the amount that you pay on the import is less than the amount you receive on the export. So that is also one of the classic conditions, that yes, you have to have a profit on the entire MTT trade. This is very important point. The merchanting traders shall be genuine traders, and these are not mere financial intermediaries. The important timeline I mentioned, that this has to be completed within a 9-month time frame, and the outlay of foreign exchange should not be beyond 6 months. Merchanting trade may be allowed to make advance payment on the import leg on the demand made by the overseas supplier. Now, you will observe that a lot of conditions are similar on the import leg to the import transaction. On the export leg, it is similar to what is prescribed under the export regulation. Payment for the import leg may be allowed from the EEFC account. Okay? Any receipt that you receive on account of foreign exchange, you have to make sure that you park it in a different bank account, and those proceeds are used only for making the import leg payment. Because you have an overall time frame of 9 months, so you cannot say, okay, I received the money in India, now I will use it for my other expansion and all that purpose. That same money which pertains to that import leg, that needs to be completed. There is a right of permissibility, of course, as per the export guidelines. Third-party payments for import and export legs of MTT are not allowed. Now over here, in the new regulation, what has been prescribed? Overall window for the period between outward remittance and inward remittance should not exceed 6 months. It is in sync with the old regulation. AD bank may extend the above period if required. Now this was not allowed under the old law, but this under the new law, there will be power with the AD bank to extend the 9-month time frame. AD bank may also allow receipt or payment to any third party, which is currently not allowed under the existing regulation. The AD bank will give you all this kind of liberalized view only and only if the genuineness of the transaction is explained and the AD bank is convinced about this entire transaction. So typically, and again, this is more from a practical standpoint, you should be aware what happens, when an import transaction happens. So advance remittance, let's say, or any import payment, the bank will create an ORM. ORM is basically what? Outward remittance outward remittance message. The importer will submit the BOE, which is the bill of entry, port code and date. Then the BOE is either downloaded or uploaded in the IDPMS. Evidence of import will be verified by the AD bank. The ORM will be matched with the bill of entry, and then the IDPMS entry will be closed. So this is the most important step which the AD bank will undertake pursuant to the client justifying all these steps. The final acknowledgement slip is given to the importer, and the importer preserves this as a document of proof of a genuine import undertaken. We spoke about the export regulations, and it is very similar to how import regulations are drafted. Now over here, the typical timeline to realize an export is 9 months. In between, RBI had given a lenient view for 15 months, but again with effect from 2026 June, they curtailed it back to 9 months. They are very clear that whatever exports a company will do, they have to realize the money within the 9-month time frame. This is another very low-hanging opportunity. As consultants, we should know that many times clients do not realize this money within the 9-month time frame. Then it is to guide them to seek an extension from the AD bank. And more often than not, we have seen that on the export side, bankers are okay to credit the receipts even if it goes beyond 3 years, because this is foreign exchange coming in the country. So they've not typically raised issues unlike an import payment, right? Because in an import payment, the foreign exchange goes outside the country. But it is always a good practice to take an extension from your AD bank and try to realize this money within at least 1.5 years, not beyond that. Because even if while the AD bank allows, RBI may question the client that why this payment did not come within the given time frame. 15 months is the time frame for goods exported to a warehouse established outside India. Can we extend the period of unrealized export bill? The answer is yes. Again, similar to import transactions, AD bank at a time can give extension up to 6 months. Third-party remittance, again the provisions are very, very similar to what we saw in import. In case of export also, a third-party payment is provided, is okay, provided it is supported through a tri-party agreement, and the AD bank is satisfied with the bona fide of the transaction, so on and so forth. Set-off of export receivables and import payables we already spoke about. It is the same provision for import and export. On the new regulation, you will see there are certain, most of the places it is written, can be permitted and should be as per the AD bank's policy. Over here on the set-off of import and export, it is under discussion that a criss-cross set-off may be permissible. Whenever you do an export, yeah. So currently it is 9 months. Currently it is 9 months. From 1st October, whatever exports you do, it will be as per governed by the AD bank's policy. 15 months is written from the date of shipment. If you see on the right hand side, sir, it is 15 months for now, but there also banks may have some policy around it. Yes, from the date of the shipment, that's correct. Okay, so for all exports up to 30th September, this old regulation will apply. And for exports actually undertaken from 1st October, the new regulation will apply. Yes, that's right. That's right. Sorry? Yes. Yeah. Okay, so like how we have write-off in case of imports, there may be situation where an exporter may also want a write-off of the export receivables. So there are certain thresholds which are prescribed under the law, and you need not go to the RBI. So 5% self write-off is doable. If you're a status holder, let's say for example, there are various accreditation under the export law in terms of your status basis, your track record and everything. If you're a status holder, then 10% write-off is permissible. And if it's being done by an AD bank, 10% out of the total export proceeds realized during the preceding calendar year. Anything more than that, you may need to discuss with your AD bank for an approval, okay? But yes, anything sizable, you may have to seek RBI's permission, especially on the goods part of it. And likewise services as well. Sorry. Yeah. Now there are situations where RBI may allow you the entire write-off of the export receivable. As I mentioned, if your overseas buyer has been declared insolvent, or if the goods that are exported had to be destroyed or auctioned or kind of thrown away due to certain quality issues. In that case, an entire write-off may be permissible. For export of services currently, as I mentioned, there are no forms. The exporter may do the export without any declaration, and the exporter has to realize and repatriate the export proceeds within the timeline. Whatever is applicable for goods, it is applicable for service, but with effect from 1st October, the exporter will now have to give a EDF declaration for export of services. Again, there are many times where there is a receipt of advance by the Indian party for exports that have to be made in the future. So over here, the goods, the timeline prescribed is 3 years. Let's say the exporter receives some advance. The time limit is 3 years up to which the export advance can be made. If you are not able to ship the goods within 3 years, then yes, you have to take an RBI approval. There are certain exceptions to this general rule. For case of long-term supply contracts, you have to export the goods within a 10-year window, but this is only with a condition if you have a satisfactory track record of more than 3 years. Closure of small value export items, this is again very, very similar to the export that we the import that we discussed. This can be closed by the AD bank basis the declaration given by the exporter. Generally, a EDF is required for all export transactions. There may be some waiver where there is no case of foreign exchange transaction, and there are certain conditions prescribed under the regulation wherein a grant of EDF may be done away with. It may be noted that there are no such provisions under the new regulation. Let's look at this interesting case study on the export of goods and services. Indian company is a company in Delhi, entered into an export contract with the Dubai company for resale of goods. So export of goods is worth USD 10 lakh and export of services is USD 3 lakh. Dubai company paid 4 lakh as on 1st of December as export advance to ICO against export of goods worth 10 lakh US dollars on 31st March 2026. DECO later became insolvent, hence could not pay the remaining amount of, okay, that's the scenario 2. We'll come to that a bit later. So what is the time frame for export of goods in case of advance remittance? Is there a non-compliance? Yes, no. Is there a non-compliance? So DECO paid US 4 lakh on 1st December as export advance remittance, against which the export happened on 31st March 2026. So it is complied because the time frame is 3 years. So when ICO paid an advance, ICO got an advance for export, within 3 years it had to export the goods. Here you will see that it has happened well within the time frame of 3 years. So therefore there is no non-compliance. Okay. So in this example, to continue this further, right? So what is happening is net payable for export of goods is 6 lakh rupees, 6 lakh US dollars, and for services it is USD 3 lakh you had to realize, right? Yeah. So can the Indian company write off the remaining export receivables? So yes, you will have to look at those thresholds which are provided, which we just spoke about. If it is within this permissible limits, then it is allowed. If not, then you will have to seek approval from the AD bank stroke RBI depending upon what is the percentage of write-off. Any declaration required at the time of export of services? Yes, no? Okay, okay. So it's not required as on today. Okay, so these are some of the regulations, around export factoring, project exports. There are very, very specific conditions which are attached to such kind of transactions. And, it is quite self-explanatory if you read the law. There are also certain conditions around export of goods by SEZs. And, if you have to open, warehouse abroad. So typically in our experience, what we've seen, what kind of questions come from the clients on the export side. It is mostly pertaining to the time frame within they realize. It is pertaining to the write-off. It is pertaining to outstanding non-closure of the EDPMS. It is on account of some write-off which they have already done for which they have not taken any RBI approval. So then the recourse is post facto, you go to RBI for an approval. And then yes, RBI may or may not direct you for compounding. So it's not that if you have not complied with the law, you are in danger. You have to suo moto go to RBI and accept that yes, look, we made a mistake. And in my experience, I've seen that RBI again is a very, very, very good body who would carefully, patiently hear a client's case, try to understand what caused the difficulty and why, and try and come up with a very, very minimal penalty if they are convinced that, the client was genuinely not aware of the law or made genuinely some mistake. So this is, I think, largely on import and export, and I'm happy to take if there are any more questions. But thank you so much for a very, very patient hearing. Okay, any questions? Yes, please, me. I think you'll have to use the mic, sir.
Hello?
Yeah.
So if an Indian entity receives advance against exports from a foreign entity,
yeah,
okay, and somehow they were not able to export the goods, nor they are able to repay the advance which has been received.
Yeah.
The only approach is to to resolve this is to approach the AD banker or the RBI to write off that, write back that advance against exports. This is my case, one of my clients' case.
Yeah.
We have approached the AD bank since last 1.5 years. I'm following with them, but they are saying they are not able to take any decision as far as allowing of write back of advance against export is concerned. So your any practical experience on this?
Yeah, so typically, sir, what you're explaining is not within the realm of the AD bank. The AD bank will not be able to allow you or give you an in-principle approval on the write-off for the advance. Such cases typically would require an RBI approval because this is a case of an export advance write-off.
Right. We have specifically mentioned in our application also to the AD banker that if it is not within your rights, then you can refer the case to the RBI, or shall we as a entity?
No, so as a client, you would need to prepare an application and lodge it through your AD bank on the Prava portal to the RBI. It will go to the regional office.
Okay, Prabha portal.
Yes.
Okay, and this is RBI's portal?
Yes, yes, this is RBI's portal. So under the new regime, what is happening is all applications are being routed through the Prava portal. That is their way of tracking which applications are processed under queue or not responded.
So the AD banker doesn't come in this at all?
No, so you will have to prepare your application and file it through the AD bank. You cannot directly go to the Reserve Bank of India. You'll have to get it done through your AD bank.
Okay, but we have made an application, but the AD banker is not taking any action. So we can
No, but you'll have to discuss that with the AD bank. Maybe there may be a need to discuss it with a more senior person in the AD bank that look, we want to take an approval for write-off. That's the only way out.
Okay, thank you.
But you may also need a declaration from your overseas party that they are okay to write it off.
Unfortunately, that company has gone into liquidation. So
okay, so maybe then you will need to build your story accordingly.
That we have done, but
Yeah.
still, okay.
But RBI should look at this application for sure.
Okay.
Because it's not very unique, it is very, very common.
Right, you are right.
Yeah, thank you
Thank
so
you.
much. So Softex will need to be reported, under the new EDF platform. Softex will require to, because that will be similar to a service and will require reporting. Now, whether it's good or service, you have to report. Sorry?
Hello.
Yeah, yeah. Yeah. So that's where you have to watch out for the policy, what the AD bank is doing vis-a-vis the Softex. Yeah.
Ma'am, is it possible that we furnish EDF form to one bank and we receive the consideration through another bank?
No.
So it has to be the same bank?
It has to be through the same AD bank. If you have for any reason moved to another AD bank, you'll have to take no objection from the earlier AD bank.
So suppose first 10 invoices we have reported to one bank, and 11th invoices we reported to another bank. But that bank also allowed remittance of earlier invoices to come to their account. Is it possible that way?
No. So in your example, you are saying first 10 invoices through one bank and then the next invoice through the other bank.
And we received the realization of earlier invoices in the new bank also.
No, but then how will the old bank square off in the
No, I don't know.
system?
That is the way new bank allowed that particular amount to get credited.
A little surprising because typically it happens through the same AD bank.
It has to be within the same AD bank.
Sorry? Yeah, at least that other bank will have to give a confirmation to the new bank, has to give a confirmation to the old bank that this, you please knock it off, the payment has been received.
So it is to be done by bank to bank, or we have to intimate?
Yes, you will have to loop in both the banks.
Okay.
I think there is a question behind.
Hello.
Yeah?
I have one question. There is one foreign entity.
Sorry, where is? I can't see. Yeah,
Yeah.
okay.
There is one foreign entity. They have set up a project office in India, but the foreign entity and the third party, which is a related party, they have an agreement for the expenses to be reimbursed by the original entity, the associated enterprise.
Okay. Is this a question pertaining to import-export?
Yes.
Okay.
So the AD code has been used by the Indian entity. Indian entity's AD code for the import, and the payments are directly made by the foreign entity to the related party.
Okay.
So in the IDPMS there is pendency, but the payment has already been made by the HO.
No, so these are on behalf payments which are again not allowed as per section 3 of FEMA. Let's say if a payment had to be made by a particular company, then it has to be routed through that company itself and not through any other group company or something like that.
But this is as per the agreement, so we cannot satisfy the RBI or the ID bank.
But we'll have to look at the specifics of the case before we decide in terms of how the transaction should be okay. Because typically it has to very clearly come out, even if it's a tri-part, and you're saying it's a project office.
Yeah, it's a project office.
Yeah. So we'll need to have a look at the facts of the case, ma'am.
Okay.
Yeah. Yes, please. That's the last question we take. Yeah. 1 second, you'll need to wait for the mic.
So the 3 years thing, that's for the export of goods. Does it equally apply for the exports of services as well?
That is for the advance, ma'am.
Yeah, the advance.
Yeah.
Okay, thank you.
Okay, thank you so much for a patient hearing. Thank you very much.
Good afternoon, everyone. I would like to extend a sincere vote of thanks to Sir and the whole Kotak team. Sir, I completely agree with your thought that every dollar earned and saved is valuable for a growing economy like India, especially at a time when global markets, particularly crude oil and gold, remains highly volatile. Thank you, sir, for helping us understand the role of ADs in the import and export transactions, and you're sharing us your practical insights on that. Thank you, sir. And I would also like to extend vote of thanks to CA Palav Shah, ma'am. Ma'am, import and export compliances are becoming increasingly dynamic with latest regulatory changes and technology-driven monitoring. We are seeing much closer scrutiny by authorities and a rise in ED inquiries. Thank you, ma'am, for giving us a practical understanding of the key areas professionals should keep in mind. Thank you, ma'am.
I'll request Sudha Bhushan, madam, our next speaker, and the coordinators all to come up on the dais. I'll request Chairman WIRC to give a small memento to Sudha Bhushan, madam. In fact, our sincere thanks to Sudha Bhushan for, conceptualizing this program and helping WIRC for, doing a wonderful program on FEMA. By the time these people set up, let's do that.
For Sudha madam, I can say that she was the instrumental in this wonderful program, and she has come out with the FEMA practice manual with taxmen, a complete comprehensive FEMA guide for professional, and my compliment to her for launching such a great book. And this is the 4th edition. Everybody can look upon this. Thank you so much.
I'll request Prithvi Raj to formally introduce Sudha Bhushan, madam.
Good afternoon, everyone. Our next speaker for the session on foreign direct investment (FDI) is CA Sudha Bhushan. CA Sudha Bhushan is the co-founder of Taxpert Professional and Distinguished Finance, Governance and Cross-Border Advisory, expert with over 3 decades of leadership experience in FEMA, international taxation, valuations, and corporate restructuring. A chartered accountant, company secretary, insolvency professional, registered valuer, independent director, and ESG professional. She serves on the boards of several listed companies and advises leading banks, multinational corporations, and global investors. A renowned author, speaker, and thought leader, she has addressed over 500 national and international forums and authored multiple best-selling publications on FEMA and cross-border transaction. Please welcome CA Sudha Bhushan.
Thank you so much, WIRC, for organizing this wonderful program. Chairperson, Mr. Saurabh Ajmera, and Ketan Sayaji, because we've been seeing your work, and so good to see so many good programs being organized. And thank you all of you to participate. I think the last session was sort of icebreaker for us. It was, and in fact, looking into the changes. So let me, one thing that Suyog mentioned was that he has been dealing with FEMA for 20 years, and he's still learning it. And believe me, same, at least I always tell about myself that myself, I've been dealing with FEMA for 20 years and more, and after handling more than thousands of transactions, speaking at forums, writing books, articles, educating AD Bank themselves, I'm still learning it. Now, one thing that comes out of the recent changes that has happened. See, one is that FEMA has been evolving. I mean, from FERA to FEMA to the liberalization that has been happening, and more so when the shift happened in 2015 with the budget, and actually coming in picture in 2019 through NDI rules. FEMA has been shifting, more clarity is being given, more simplicity and governance and rationalization has been happening. But the period from January 2026, if you ask me, January 2026 till date, it looks like that the whole structure, the whole architecture of the FEMA has been reshuffled. Ankita spoke about ECB, Palav spoke about export and import regulation. You see that is getting changed from October 2026. ECB already got changed. Guarantee complete simplification has happened. When it comes to NDI rule also, NDI rules we'll see NDI rules like non-debt instrument rules. Complete change, completely change. ODI 2022, it got revamped. So one thing maybe what all of us can start with is to start doing the due diligence. Due diligence of the balance sheet. Many of you will be CFOs of the company. Some of you will be the practitioners. Some of you maybe you are the student or no matter where you are. I suggest that you please pick up the balance sheet and start doing the due diligence, because every item, the way we have Ind AS, right? Revenue ka alag Ind AS hai, intangible ka AS 38 hai, alag Ind AS hai. Similar to that, every item of your balance sheet has a different regulation or rule to be followed. So I suggest that you start by doing the due diligence of the balance sheet. That will be the one of the most productive exercise that you can do in the present scenario, because really the changes that has happened across the regulations, across the rules are something which not only changes the law but which also presents a lot of opportunities to us. Like 2022 when ODI got revamped, the window for clearing all the past non-compliances was 3 years. So if you could have used those windows, so it is good to know what are the non-compliances and go for compounding, because compounding itself, in fact compounding itself has gone for change. The more, and what the overall structure of the framework of the foreign exchange is getting more and more governance oriented. It is getting more and more digitalization oriented. The complete Parva portal is online. That is my next speaker is going to maybe talk about more on the compounding. And the more and more of these things are getting changed, it makes all the sense. So the things that we are going to speak is, the agenda for today is the foreign direct investment, which I will be taking. Now, when we say about foreign direct investment, we'll be covering about the architecture of the foreign direct investment, how it can come and all. More importantly, we'll be covering about the recent changes that has happened in this foreign direct investment whole framework, and we'll talk about the practical toolkits which are there in terms of what are the do's and don'ts of when we say about the foreign direct investment, it is governed by the whole set of the ecosystem. It is the Reserve Bank of India. It is along with the central government that the FDI in the country is regulated. And the powers between these two entities are very, very fine-tuned and very, very minutely distributed. If you see, obviously and very rationally, the central government is authorized, is empowered, is entrusted to make the fiscal policy of the country, and RBI is entrusted to make the monetary policy of the country. Now, if you go by this simple understanding, everything will fall in place for you, that who is doing what and why. So let us understand what are the various agencies, various bodies, various government ministries which are involved when we speak about the foreign direct investment. In fact, when we speak about foreign direct investment, let me just correct myself, it is foreign investment, and we'll come to the foreign direct investment. Reserve Bank of India is the one which comes up with the regulations for the foreign investment in India. Then we have the ministries of government, which is entrusted with making the policies for investment in various sectors. RBI gives directions to the AD Bank, who in turn are entrusted with the making of making the policies of the of RBI operational. Now, since lot of powers of the RBI are getting delegated to the AD Bank. Now, if you see, when you are remitting the money outside India, what is whether valuation certificate is required, what are the pricing policy a company can follow. If the ECB, your all-in ceiling cost, the rate of interest is at arm's length. So all those, in fact, most recently, in fact, the license of FMMCs can also be now given by the AD Bank themselves. So lot of powers have been delegated to the AD Banks, and that calls us for a very, very important action, which is that when we are choosing the AD Bank, because they are the ultimate authority to clear the transaction, it is important that we choose them with lot of caution and care. Also, whenever the transactions like the bigger capital account transactions are being undertaken, for example, FDI, ODI, which are long-term capital transaction, it is best that the transaction is discussed with the AD Bank first before the transaction is executed. So also when any transaction is undertaken, and since morning we've been speaking about current and capital, and in fact if you ask me, current and capital is something that if we get the clarity about that, if the transaction is current or capital, a lot gets sorted. When we are dealing with FDI, it is not only that we are dealing with RBI only. There are ministries, there are the sectoral authorities also that comes in picture. What are these sectoral authorities, and how FDI, for example, is different from ODI when we talks about the sectoral authorities, and who is the master of the architecture in case of FDI? Because when the money is coming in India, For example, money is coming as NBFC. Now, RBI is also the institution, the company is also governed by RBI in addition to the RBI in its role as a banker. When the money is coming in insurance, the company is also regulated by IRDAI. So before execution of the transaction, it makes lot of sense to understand the whole of the authorities that are dealing with the transaction. In opposite to this, if you see, when we talk about ODI, it is only the RBI mainly and your government, that government that is involved in the architecture of the transaction. The regulations that regulate the foreign investment in India can be seen as the Management Act, the rules, NDI rules, that is non-debt instrument rules 2019, the foreign exchange management mode of payment and reporting of non-debt instrument regulations 2019, read with consolidated foreign direct investment policy 2020 and the press notes which are issued by DPIIT. If you see here, the whole of the powers, again, the non-debt instrument before 2019, there was a TISPRO which was there 2000, which was given by RBI. In 2019, following the declaration which was following the announcement, we can say, which was made in the budget 2014, that the power to regulate and make rules relating to non-debt instrument got shifted to the central government. Prior to that, it was RBI. Now tell me one thing. See, another thing, that most of the FEMA is yes or no if you understand few basic concepts in it. And it is more procedural also. Therefore, I'll be devoting wherever possible more time in the fundamentals, because the law in any case is available in the books. So, and I will encourage also, if you have any question in between which you need to answer, want me to answer, I'll just take it up. Because law is available in the BEAR Act, it is all available at RBI website, and if you don't get it at RBI website, the most recent is available on ED, Enforcement of Directorate and website, the whole notifications and all are available. So what I was saying, see, what was the reason of shifting of power from RBI to central government? Again, the whole power has not shifted. What powers have shifted? Only with regard to non-debt instrument. Only with regard to non-debt instrument, powers with regard to debt instruments, powers to make rules and regulations and notifications and law with regard to ECB borrowings is still with the Reserve Bank of India. Now, why? If you see, as we briefly discussed here, that RBI is interested with maintaining and making the monetary policy of India. What is that? It controls the capital account deficit. That is your inflation, your reserve, foreign exchange reserve. Now, a body which only can deal and understand money in the terms of rupee, in the term of foreign exchange, in terms of the current and capital account deficit, can it be entrusted to understand that whether my country is mature to receive funds in insurance, whether my country people need funds in defense, can my sovereignty, can my safety of the country, are my systems mature enough to invite and also fight with the foreign capital? So these type of decisions, do you think RBI could have done, or RBI could have been entrusted with? RBI was doing it for years. Now in 2019, very rightly this power got shifted to the central government, wherein now anything to do with the long-term capital, anything to do with the equity base of the country, anything to do with the non-debt capital in terms of equity, in terms of CCPS, in terms of warrants, which is the long-term liability into the country, is now, instead of RBI, it is central government which makes the rules regarding that. किस सेक्टर में कितना आना है, कैसे आना है, that is decided by the central government under the FEMA NDI rules 2019. कितना आना है, कैसे आना है, कैसे आना मतलब गवर्नमेंट रूट से आना है कि ऑटोमेटिक रूट से आना है, कैसे आना है in terms of operational framework, in terms of what is the reporting to be done, under which account it can come, all those is still with the Reserve Bank of India. Why? Why the reporting is still with the Reserve Bank of India? Any guesses, please? See, the reporting under mode and manner of foreign mode of payment and reporting of non-debt instrument is still with the Reserve Bank of India. Why? Mode of payment and reporting is still with the Reserve Bank of India. Why? They need to understand, right sir? They need to understand कितना foreign exchange reserve मेरे पास है, कितना जा रहा है. अभी सुयोग जी ने इतना बढ़िया fact बताया, 600 billion में से 32 billion we are sending by LRS only. So these type of statistics, RBI needs to make its monetary policy so that it can manage its current account deficit. For example, right now, earlier, the interest which was payable on FCNR account was regulated. Now, effective from June 17, 2026, the interest on FCNR account has been left to the RBI, to the bankers. Means what? What is the logic? Logic is that boss, invite the capital from the NRIs. Pay them whatever interest your management is able to manage. Your asset liability is able to manage. Pay them that much of interest. So those kind of policies RBI only needs to make, and for that it needs data which goes from mode and manner of reporting, payment and reporting. Okay, I'll take 1 minute here that there is a difference. I have seen people interchangeably using debt instrument and debt. My friend, there is a difference between debt instrument and debt. When we talk about debt, it is regulated by ECB, which was taken by Ankita. Now, debt instrument is something which is against which the instrument are being issued. For example, non-convertible debentures. For example, non-convertible preference shares. Those are the debt instrument. And non-debt instrument we have already discussed. So, we have already discussed this journey briefly from the prior to FEMA 2019. पहले तो FERA से FEMA, फिर 2019. In fact, उसके बाद भी there are few very good changes which have happened, and we'll be talking about that. Now, coming to the whole structure of foreign investments in India. Very nicely, it has been structured in NDI rules with the chapters, rules and schedules. So, you can take it that first 2 chapters are journal. Like obviously, all of us know, chapter 1 deals with definition. Definition defines the lawyers. So, definition defies disputes. So, chapter 1 there are journal provisions. Okay, how you read it? The whole NDI rules. Okay, how you need to read these rules is you have to look at the investment which is coming in. There are journal rules, and then there are absolutely 100% specific rules. So, chapter 1 and chapter 2 talks about the journal condition. Chapter 1 talks about the definitions and all. Chapter 3, which is Rule 6 to Rule 9, it talks about the investment by person resident outside India. Chapter 10 to, Rule 10 to 11 talks about FPI, and 12 to 13 talks about and NRIs and all. Let me ask you again a question. Why do you think that government has complicated it so much? इतने सारे तरीकों से, मतलब पैसा तो इंडिया में ही आ रहा है ना, कौन दे रहा है, क्या फर्क पड़ता है? Why did they make these many chapters around the investments? Because each of these chapter basically represent the type of investment that we get in India. Each of this chapter represents, at least when we talk about chapter 3, 4, 5 and 6, 7. So each of these chapter talks about a different type of investor, because every type of investor is different and their motive to invest in India is different, right? We know someone asked about LOB or PON. So the purpose for which money is coming in India is different. So we need to manage it differently, and therefore there is a different chapter. So we just spoke about, in fact, in the beginning what I did, I started saying foreign direct investment. The whole session today is about foreign direct investment, because this is what happens with us. We take foreign investment as foreign direct investment and foreign direct investment as foreign investment. We use these two terms as interchangeably. However, foreign investment is a bigger term, and foreign portfolio investment and foreign direct investment are subset of the foreign investment. What is required to be understand that when we say about foreign investment, what differentiates foreign investment and how transactions get categorized as foreign investment is by following the conditions, which is it happening? So, okay, I'm referring to the middle part. So, when we talk about foreign investment, we talk about any investment which is made from outside India by a person resident outside India on a repatriable basis. So the most important term that we understand for investment to be categorized as foreign investment is repatriation. Now again, repatriation, what do you mean by repatriation? Very simple term, right? Very simple term, repatriation की पैसा बाहर लेके जा सकते हैं कि नहीं लेके जा सकते, right? However, there is very important distinction when we talk about the term repatriable. See, repatriable and non-repatriable, what we talk is always in concern of the initial investment. It is never about the dividend interest that is earned or any other income that is earned on the initial investment. That is always repatriable. So any investment which is from person resident outside India and which is on a repatriable basis is termed as foreign investment. It can come under two ways. One, as a strategic investor, which is foreign direct investment, and other as a portfolio investor, like we all invest in the stock market, as a foreign portfolio investor. Very refinedly, it's defined very properly that any investment in an unlisted entity, will always be FDI, okay? And any investment above 10% or above in an unlisted entity will always be FPI, okay? So these are the two distinct factors which are there, that any investment in an unlisted entity के अंदर तो FPI आ ही नहीं सकता, because unlisted entity के अंदर जो भी investment आएगा उसको हम strategic ही मानेंगे. In comparison to this, if the investment is made in in a listed entity, in that case, any investment which is more than 10% or 10% is categorized as the FDI. Okay, we'll go slow and we'll understand the differences, why and why we need to, before, as soon as the investment comes in mind, it needs to be seen whether the investment is FDI or FPI. Why? Why? Because the way FDI is managed and the way FPI is managed, reported, and the pricing guidelines, the governance, the governing regulation is completely different in case of FPI and FDI. So that is the reason the first thing that one has to do is to see whether the transaction is FDI or it is FPI. Now, before we get into the understanding of the differentiation between FDI and FPI, let us see the 5 factors of foreign investment, which is equity instrument, who can invest on repatriable basis and beneficial ownership as FDI and FPI. I think we have already seen it. So this is the differentiation between the FDI and FPI. Let us see it with an example. AMC PLC is a company based in US. PQS Limited is an listed Indian entity. AMC PLC has had an investment of 9% in PQS Limited. Now, let's pause here and tell me what kind of investment it is. PQS listed है, AMC ने 9% PQS में invest किया है. FPI, right? FPI because, why? Because it is less than 10%. Right. Now, what happens that AMC subsequently introduces 2% in the company, taking the total to 11%. What happens that from 10%, now earlier 9% tha, now it has become 11%. So what will happen? That 2% will become FDI and 10% will remain FPI. That's what you think? No. The entire 11% will change the color to FDI. What happens that now, moving ahead in the case study, subsequently AMC sold the 2%. It reduced 11% तक गया and it reduced to by 2%. Now again it is 9%. Does that 11% which has become FDI becomes the which has become FDI becomes FPI again? No. Once the color is changed, the color remains the same. And it is the duty of the foreign FII to inform the company, to inform the bank, and to take the approval. Okay, when the shift is happening from FPI to FDI in a listed entity, it needs to inform the company, it needs to take the approval of the company, it needs to inform the bank within 5 days. Within 5 days. So the FII have only 5 days either to disinvest or to be categorized or reclassified as FDI. Now tell me one thing. There is an investment which is coming in my company, and okay, the 9% was already there. Now from FPI it is becoming the FDI. I have to file from FCGPR, I have to follow all the regulation, I have to take the board approval, I have to do all the things, and within 5 days, will it be possible for me to do it? So all these transactions which happen, it should be always tracked. Whenever there is an investment, it has to be tracked. There has to be a tracker which talks about when the investment is crossing 9% already, so that the appropriate action and strategy can be made for the transition of FPI to FDI transaction. Here, okay, now in this case, AMC PLC is a US based company, and it has invested 9% in PQS, followed by another 2%. Assume PQS is a private limited company in India. What is the consequence? Yeah, it is FDI because it's a listed entity, and yeah, it's an unlisted entity. It's an unlisted entity, and again, why there is a requirement of differentiation, because the moment it is categorized as FDI, the whole of the pricing guidelines become applicable, your sectoral conditions become applicable, that in cases your other conditionalities becomes applicable. So which are, when it comes to the FII or FPI, we can say the portfolio investor, they can come at the price of the market price. The pricing guidelines are not applicable to them. The reporting requirements are governed under SEBI and not by the FEMA NDI rules. FIIs also are governed by FEMA NDI rules. However, there is no reporting requirement which is there for FPI to inform the investment. In contrast to that, if there is an FDI, there is a form FCGPR which is required to be done within 30 days. There is a form FLA, annual report, which goes every year, that is required to be done. So those kind of changes are there. When we talk about the anatomy of entry in India by way of the foreign direct investment, these are the four things that are critical. That is a sector or activity in which the foreign money is coming in, the percentage of cap, equity limit, entry route, and the other conditions. And any investment which is coming in India, if you see, it can come in the, there are sectoral requirement, there are sectors in which are prohibited. That means the money is not allowed in those. That means no foreign entity can invest in these sectors. For those are like Nidhi companies, anything, if you want to understand on a broader level, anything to do with speculation, lottery, crypto, it was in very, so anything to do with the things, chit funds, so those are the prohibited sectors. Apart from that, there are few sectors like banking, telecommunication, in which the limit of FDI that can come is limited to 74% or 49% plus 26%, and thereby making 74%. The third category is that the money can come under the automatic route. That means the money, there is a table which talks about the sectors in which the money cannot come, till what extent the money can come, that is whether it can come till 24%, 74%, 49%. What does it mean? That only 49%, for example, of a company in India can be held by the foreign investor. Those activities which are not mentioned in table 1 of schedule 1, which talks about the sectoral caps, will fall under the automatic route. Now, one thing that we come across is that the classification of the actual activity that happens. The classification of actual activity is very important, and it is not governed only by the memorandum of association. What is the activity Indian entity is undertaking? It is more governed by the actual revenue earning segment of the company. That what is the segment which is earning revenue for the company. For example, let us see this case study with regard to the sector. A foreign PE fund proposes to invest in an Indian company that operates a digital lending platform. Now, money in digital lending platform is allowed under automatic route. And an online gaming app that includes a rummy product with cash stakes. The fund term sheet assumes the entire investment is automatic route since digital lending is not separately listed as prohibited. Now, what is important here is that one, that may be on the MOA of the company, digital lending is the only activity, and in the finer lines they have shown that they'll also be undertaking the gaming activity. So one has to look into the actual revenue earning activity of the company and not just going by the memorandum of association. Mapping the level activity level mapping has to be done. And since this company is undertaking the activity which is allowed under automatic route, plus it is also undertaking an activity which is prohibited. Therefore, till the extent the activity which is prohibited does not get hived off, the company cannot make investment in India. And the thing is that when you are making these type of contraventions, when these type of contraventions happens wherein the sectoral classification, sector identification itself is wrong, these are not contraventions. These cannot be compounded. There is no LSF for these type of activities, for this type of transaction. It has to be rewinded, it has to be undone. So by any chance, if this activity becomes that the foreign investment is coming in the sector which is prohibited, and later on it comes to the knowledge, the whole activity needs to be undone. There is no compounding, there is no prior RBI approval which shall be given in these type of cases. So, and whose responsibility is it? Tell me one thing now here. When I'm talking about that any foreign investment in India needs to go through these 4 lenses of activity, whether how much can come, the equity limit, entry route and other conditions, whose responsibility is to check it? When it comes to FEMA, a lot of, as I said in beginning, a lot of delegation of powers have been done to the AD bank. Anything in FEMA, you go to FCTRS, FCGPR or any other form, FNC or anything, you will see 4 level of certification. One, start with the management representation. Management representation that everything, even in fact you see your form A2, what it says that everything I'm complying with FEMA laws. So it says that we as a company are complying with FEMA laws. If I am remitting, let's take an example of receiving the fund in India. We have how does it start? Starting that management will give the certificate that we are complying with FEMA laws. Then it goes to a professional like ourselves. It comes to the professionals like ourselves to certify that FEMA laws have been complied with in one way or other, right? When it comes to the FCGPR, we are required to give valuation certificate. We are required to say that all the requirement of Companies Act have been complied with, right? In one way or other, it will come to the professional like chartered accountants. Then it goes to the AD bank, and then it goes to RBI. So a lot of responsibility is also there on us as a professionals to check on these the requirement of FEMA Act, that whether it has been complied with or not, because the ultimate responsibility of understanding the law, with all due respect, I'm sure you will agree with me that the ultimate responsibility of understanding the law in the finer tunes lies on whom? Can you expect an AD bank? Okay, I take classes for HDFC Bank, Bank of Baroda, RBL, IDFC Bank. I know the level of, with all due respect, I mean not all, but the level of understanding is there with regard to FEMA in the people who are responsible for clearing our transactions. So it is our responsibility to understand this law, make them understand, and thereby contributing to the client's transactions. We see so many now, that is how it is. It is, so if it is that MOA does not, we are clearing an activity which is prohibited. I mean, as basic as that, and if you think that it does not come, it do come. What do we mean by the automatic and government approval as such? See, automatic, we've been talking, right, that the money can come either under automatic route or under government route. So, what do we mean by that? The FDI in India can come in two routes, automatic route and government route. Automatic का मतलब ये है कि जितना भी पैसा आ जाए और कहीं भी, this is not the meaning of automatic route. It does not mean that it does not mean that nothing needs to be done. It means that you just follow schedule 1, you just follow, these are the requirements, you follow them and it will be sorted. So automatic route says that the prior approval of government is not required. While government route says that you have to ask government first through its various ministries, through the portal, you have to submit the application. Once the approval comes, then only the investment can be made. What kind of sectors comes to your mind wherein the government will think that these are the sectors in which the government approval should be given, should be asked for, then only it will be given. The first sector that comes to your mind? Defense, the sector of the national security, or the sectors which are still maturing, all the sectors which are like your inventory based marketplace, those sectors wherein still either the sector is maturing or there is a chances of speculation or it requires for the national sovereignty of the country. So those are the sectors which are in government approval, and as I said, very few sectors right now are under government approval. Now these are the conditions. If you see that these are the conditions that are at the time of the entry into India. However, there are certain conditions which needs to be checked on a yearly basis at least. So what happens once a funding comes, and it happens with lot many companies, once the funding has come, done and dusted, FDI, FCGPR filed, that's all. Now after FCGPR has been filed, there are other things that needs to be looked on a regular basis, on an annual basis. For example, one of very critical thing of that is the downstream investment. Lock-in and exit requirements if are there, if it is required to be looked into. Reporting, your annual reporting. So all those things are recommended that they are checked for non-compliance or compliances. Now downstream investment is like 98% of the cases people won't know to inform the RBI that there has been a downstream investment and to inform DI, because it is not understood, and since the money had already come and the downstream investment has been done after 10 years, after 6 years, and the money is already, the company in which the money has come is already the foreign owned or controlled entity, even in that case, the downstream investments are not reported. So these kind of checks in places are required to be done on the ongoing basis. So it does not end only with the one-time event-based compliance. There has to be annual compliance, annual checks which needs to be checked in, looked into. So let us go now with this basic framework, the major changes that has happened in NDI rules, very recent changes that has happened, and which is significant in terms of the requirement and the ambiguity which was there prior to those rules. So we have already discussed briefly that prior to the NDI rules, it was regulated by a Central Reserve Bank of India, and it was all bifurcated, scattered, and one thing that we saw was that how the money can come, it can come from the person resident outside India. Person resident outside India. So for the whole of the NDI rules, the way it is that person resident outside India is the way who is not the person who is resident in India. The way it is defined, person resident outside India is the person who is non-resident or who is not a resident in India. Who is not a person resident in India. So the way it is that the whole of the prior to NDI rules, it was that from where the motive behind was to only invite the capital, to attract the capital. Now since the motive was only behind to attract the capital, the restrictions with regard to people who can invest in India were very few. They were like anyone and everyone, and the only restriction was with regard to the nationality of the country. That if the person is from Pakistan, Bangladesh, he cannot invest. Otherwise, the investment can come in India from any country. No, in fact, in ECB there used to be FATF compliant countries. When it comes to NDI, there was no restriction. कहीं से कोई भी country से पैसा ले आओ, हमें तो सिर्फ पैसा चाहिए. The only restriction was with regard to कि पाकिस्तान से मत लाओ, बांग्लादेश से मत लाओ. That was the only the restriction which was there in the rules prior to the NDI rules was only in terms of the nationality. That these are the countries from which the investment cannot come. What happened after 2019 also, in the NDI rules also, this was the only condition that आप पाकिस्तान और बांग्लादेश से मत लाओ, बाकी कहीं से भी पैसा ले आओ, कोई दिक्कत नहीं है. Now what happened in COVID? That our companies, COVID में क्या हुआ? Our companies became very cheap. Because of the COVID, our companies became very cheap in the sense that they were present, they were there for half the price, they were there for 1/3 of the price. Dirt के भाव पे हमारी कंपनीज मिल रही थी. और हमारी नहीं, all over the world this was the phenomena that because of the disruption of entire business, because of the disruption of supply chain, human management and everything, the value of the companies came, too down. And China started using this opportunity to its benefit. It started accumulating the shares of Indian companies through hostile takeover. It started acquiring, it acquired, and the trigger happened when it acquired 1% of HDFC Bank. Government को दिमाग थोड़ा सा हिला. And immediately, that's popularly known as 3/2020, press note 3/2020, that any investment which is coming from the LBCs, that is land bordering countries, will come under only the government route. That was the press note 3/2020. ये क्या हुआ कि जो भी investment आएगा बाहर से, जो कि LBC से आएगा, land bordering countries of India, कौन सी हैं? China, Bangladesh, Bhutan. So these countries से अगर पैसा आएगा, it will come under the government route. Okay. ये ऐसा ही नहीं था कि ये countries से आएगा. ये countries के अगर कोई beneficial ownership भी अगर ये countries में हैं, तो भी आपका government route से आएगा पैसा. Right? Are you with me? Not only कि कोई Chinese company ने इंडिया में invest किया है, वो तो government से आएगा ही आएगा. कोई चाइनीज कंपनी ने सिंगापुर में एसपीवी बनाकर इंडिया में इन्वेस्ट किया है, बिकॉज द बेनिफिशियल ओनरशिप is with Chinese entity, it will come under the government route. Now, what was the problem here? You know, the problem here in this, what we are talking about the progression of 2019, the NDI rules 2019 in terms of person who can invest in India. We are talking about that. Earlier, it was based on nationality only. And in 2020, for the first time, the government came up with the PN note 3/2020, under which it came up with the concept of beneficial ownership. कि beneficial ownership LBC में है तो भी LBC से आ रहा है तो government approval लगेगा ही, LBC के beneficial ownership से भी आ रहा है तो भी government approval लगेगा. The problem was that they didn't define the term beneficial ownership. Now what became the problem here? The problem became, what do you mean by beneficial ownership? What do we mean by beneficial ownership if it is not defined? If I am appointing the board of director, is it a beneficial ownership? If I am having, okay, so what happened that lot of the money could not come in India because there was no clarity around this term beneficial ownership. Now imagine, let's take a scenario. In fact, I think we'll have that case study. So we'll discuss it. So let's take a scenario wherein there is a fund, okay? There is a fund based out of Singapore, okay? There is a fund based out of Singapore. GP is Singapore Management Company, and it is taking fund from all over India, all over the world. उसके 24 LPs हैं. कुछ केमेन आइलैंड में बैठे हैं, कुछ जर्मनी में बैठे हैं, कुछ यूएस में बैठे हैं. एक एलपी उसका चाइना में बैठा है, ठीक है? सिर्फ एक. You are with me, right? We are talking about the fund. Fund is taking fund from entire lot of LPs, and then it wants to invest in India startup. Now this particular, since only one LP is sitting out of China, will it be termed as beneficial ownership? We don't know. So lot of the investment got stalled because of this, that there was no clarity on the term beneficial ownership. Now press note 2 read with NDI rules amendment 2026 beautifully and in a most transformational manner. And I will tell you, it is like, chit mein jeeta pat tu hara, right? There's this term, right? That I win in both the sides. Type of amendment which government has done in this. The way they have defined beneficial ownership and the way the whole law and the amendment is structured is so much to the benefit of the country. And hats off to the makers of this and draftsmen in this case. So we'll take, let me just tell you, it's one of the most sophisticated FDI framework that could have been. Now what did they do? They defined, first of all, सबसे बढ़िया beneficial ownership का definition कहाँ मिल सकता था? Income tax में नहीं मिलेगा, Companies Act में तो मिलेगा भी तो वो सिर्फ reporting के purpose से मिलेगा. They picked they connected the definition of beneficial ownership to the PMLA Act. What it says that the way beneficial ownership is defined in PMLA Act, it will be taken as the definition of beneficial ownership. And in the vastest possible manner, they define beneficial ownership. Okay. Now what are we talking? One, we are talking about the definition of beneficial ownership, right? We are talking about how the beneficial ownership will be computed or seen. Why is it needed? Because the investment which is coming from LBCs, that is land boundary countries, directly, in any case, it needs government approval. But the investments which are coming through beneficial ownership of the LBCs also needs the approval of the government. That's why we are talking here. and they have defined beneficial ownership as it is defined in PMLA, and we will just see how beautifully and how smartly it is defined, the beneficial ownership. Now, one thing, why did I say that it is the most wisest draftsmen who have drafted this and most sophisticated FDI change that has happened? Because you know what they did? They not only defined it, they not only said that you have to take approval from government if it is the beneficial ownership. What they said, that even if you are not categorized as beneficial owner, you will still be required to report to the government. So it is like that if you are falling within the beneficial ownership, you need to take the approval. But अगर आप definition में fall नहीं कर रहे हो, उसके बाद भी आपको reporting required है. Because why? Because boss China, we don't trust you. So let us see here that what is that beneficial ownership, the way it is defined. Every possible way. मतलब कहीं भी अगर influence है China ले लेते हैं. LBC means China, because practically we are talking about China only, right? So अगर कहीं भी influence है in whatever manner, whether it is by way of shareholding, whether it is by way of holding the board position, and not only that, if the China is influencing, is having the significant influence on the Indian entity, then only it will be constituted as the beneficial ownership. So what we are talking about subjective as well as objective parameters and checks that needs to be considered while we are checking the beneficial ownership. So how the beneficial ownership is defined is it is by way of the investment, the size of investment, which is if it is 10% or more, in any case it will be constituted as constituted as the beneficial ownership. If it can influence the board member, board composition, okay, that is okay, you can appoint the board member, you can appoint nominate the chairperson and the things which are usually constituted as control, majority of board member and all. So these two things we understand. We have always understood control like that, right? That if you have 10% or more, it is constituted as the shareholding control. Okay, समझ में आ गया. वो हर जगह ही वही दिख रहा है, like 10%. ODI में भी वही दिखाता, FDI, FPI में भी 10% is the benchmark. Control over investor हमें through board position, appointment of majority of board of directors, that is also understood. Now the very important, जिसे कहते हैं थ्रुप का पत्ता, is your ultimate effective control. Means if the China company, if the Chinese government, if the Chinese fund, Chinese PE fund or any one entity from China does not have anything to do, say it does not have any ownership, it does not have any control, but it controls the management decisions, it controls the intangibles which are the main revenue earning requirement of this company. If it controls the technology, then also it will be constituted as the ultimate effective control in the manner of significant control, and thereby the approval of central government will be required. Let's see it with an example case study. So I'll just let you read it. So Tech Venture Fund 4 Delaware LP managed by GP Tech Ventures Management LLC. Delaware में fund है, ठीक है? Fund proposes to invest USD 20 million in Data SaaS Private Limited, Indian AI Data Analytics Company. Total LP in Fund 4 is 47 limited partners. Means 47 लोगों से पैसा इकट्ठा कर रखा है across 12 jurisdictions. Total fund size is 400 million USD. LP7 जो है, that is China Growth Capital Beijing, 4.8% economic interest, or you can say capital hold करता है of the Tech Ventures Management LLC. There is no governance right, pure passive LP. And LP7, which is China Growth Capital LP, there are no board representation, there is no veto, there is no investment committee seat, there is no information right over a standard NAV. GP Tech Ventures Management LLC, 100% is owned by 4 US nationals. There is no land border country connection. Investment manager is US based. Data SaaS business, B2B business है, SaaS platform है for FSCI sector in India, which owns all the algorithm that it has. Now my question to you is whether the investments which are coming from Tech Ventures Management Delaware in India, whether the investment which are coming from Tech Management LLC Delaware, it's a fund, right? It will be investing in India into various companies. Whether the particular investment which is making, will it come under the government route or will it come under the normal route, automatic route? Let the B2B platform is otherwise in the automatic route. Say. Absolutely right. Absolutely right that the money will come under automatic route only. Why? Because the China LBC which is there is no economic interest, the economic interest is less than 10%, there is no veto, there is no significant influence, there is nothing. So whatever 3 checks that we had 3 checks, right? Test A, test B, test C. None of these 3 tests A, B, C are getting fulfilled. Therefore, the money which Tech Management LLC is investing in India will come under the automatic route. As he's very rightly said that even if the money is coming under the automatic route, there is a whole system of reporting has been created under which the reporting is required to be done by the Indian entity receiving such a investment, anything to do with LBC. So this is a new reporting which has been created and effective from 1st May 2026. This reporting has been come as an SOP, Annexure 1 of the SOP of foreign investment under approval route. So the annexure talks about, it's so detailed annexure. Even if approval is not needed, only reporting is required. That reporting itself is very, very detailed. Now what it calls, let's see, let's go through the analysis step-by-step decision tree. How do we look into these investments now? Because after this amendment, as on 1st May 2026, any investment that comes should be checked for the LVC connection. Because even if it is not required government route, it is required to be reported. So it is a duty of the CFO, it is duty of the promoter which is fetching the money from outside India to check and to make it mandatory that if there is an LBC, it should be informed. Because it is the amount of disclosure which is going to the RBI, to the DPIIT, to the government is everything. They are asking for your term sheet, they are asking for your shareholder agreement, they are asking for your board composition, they are asking about your promoters, they are asking about your memorandum of association, so everything. So therefore it is important that we check on this decision tree when the investment comes in India. Let's go by step by step. Is investment directly from LBC? It has to come under government route only, right? There is no step second that happens. If it is coming from LBC, if it is no, then let us proceed to step 2, which is identification of all direct and indirect shareholder of investor entity up to the ultimate beneficial owner. What do you mean by ultimate beneficial owner? Which is your individual or human being till the time you reach that level. So if it is yes, map complete upstream structure. If it is no, create ownership chart with percentage. Any LBC citizen entity in upstream chain, if it is there, then BO threshold needs to be looked into. If no, then further go down and check that if the entity holds control over the investor entity. If yes, limb B gets triggered because there is a control. If no, then we go further, check limb C, which was significant control, which is ultimate effective control. If it is yes, then limb C gets triggered. If it is no, then only it is constituted that the investment can come under the automatic route. And plus, if it is no, then also is there any LBC direct or indirect ownership is there? If there is any ownership, then reporting is required to be done. And if no, in that case there is nothing. You just have to file form FCGPR for the investment. Otherwise, it is. So this is the change which has happened in terms of the way we look at our term sheets. So when we talk about the due diligence, when we talk about checking on the investment, it does not start with your form FCGPR. It starts with the term sheet. It starts with the instrument with the foreign entity is planning to invest, through which it is planning to invest in India. It starts with the pricing guidelines which are required to be followed. It starts with the board nomination rights. Who has the board nomination right? Does it? You have to go and check it, because even in the companies, so for the professionals, for my friends here who are CFOs, for my friends here who are in practice, it's a must. It's an action item for you to check that maybe in your client's company which have FDI in it, is there anything to do with LBC? May not be apparent, but maybe there is some board veto right which is there. There is some affirmative vote veto right which is sitting in your shareholders agreement. There is some investment committee advisory which has the say in how the investment will be done, and that investment committee member is Chinese. So these things needs to be further looked into. One thing is that any anti-dilution ROFO that these clauses that we put, they are mainly protective right and does not confer any control rights on the investor. So therefore these should be fine. And you must check it in terms of the changes in the rules that has happened. Very quickly on the second change that has happened, second amendment. Again, another very big change. What was that change? Okay, first change, any questions that you have prior to this we can take, or yes. Yeah. So it is getting from China, it was under the approval route or without approval route? It was under the automatic route. From PN3/2020 it it came under the scrutiny of the authorized dealer and Reserve Bank of India. So since it is going from China to the safer country, it is the normal requirement. Maybe the FCTRS form is required to be done, and that is the only requirement. If it was from the other country to China, the investment was shifting. In that case, particularly in first May amendment also it talks about, and also press note 3 also spoke about. So as of now, nothing to be done. But I mean, we need to go look into the finer tunes of the facts. It may be significant control, ultimate effective control. Declaration is a first thing to start with. However, deny is only, how do you deny? Because everything you are uploading to DPIIT, everything is getting uploaded, and it is what is happening that if it can be completely out of any documentation, if it can be out of anything at all, you getting me? If the investor is such that it can keep itself absolutely not visible in anything, then how do anyone will come to know? However, this doesn't happen in the practice. This doesn't happen in the real world scenario, that this can happen, that the investor can keep them invisible. They will need the rights, and the rights come through either by your agreements or any one or other way it will come. And since all the documents are required to be uploaded, it will come in picture. So better to report. See, the thing is that they are not asking you for the approval if you are not certifying coming in the beneficial ownership. So what's the harm in reporting? Yeah, I'll say that. Yes, please. I'm so sorry, I'm not audible.
Can you please let us know by when can we expect the 4th edition of the FEMA practice manual?
4th edition of the?
FEMA practice manual from tax.
Mine?
Yeah.
I think I thought I'll break the news. Oh, wait. So these are the earlier books that I have worked on in terms of FEMA. And believe me, the way it started was the FEMA due diligence. FEMA due diligence was because we were dealing into a deal, and it was 2013, and we were checking whether the escrow account, when the money is coming in India, whether it can be, till the time condition precedents are satisfied, whether the money can be put in escrow account. Investor ने लगा रहा है, investee को लगवाना है, but there are condition precedent, right? The investee company had to satisfy the condition precedent, and I was badly searching about that whether the escrow account can be opened by these two companies together, so that the money of FDI can be put in escrow account. So this was the inception of FEMA due diligence first book, because I could not find anything, and then it was written. So this is it, and I'm happy to launch it here. This is what is being pre-launched today, and can be available. It's available online now. So. Yes, okay. IRP is a very difficult profession in the sense too much regulated. Do you have 5 minutes? Yeah, okay. Just we'll talk about this. So, very important change. मतलब इतना important है that from 32 million of the investor base, it is shifted to 8 billion of investors. क्या है ये? See, under FDI, everyone could invest. अभी हमने इतना सारा बात किया, right? ये beneficial. Thank you, sir. Thank you so much. Thank you. So हमने अभी इतना सारा बात किया, beneficial ownership नहीं होना चाहिए, and इस country से आना चाहिए, उस country. Please understand that was only with regard to FDI. Okay. Now, in terms of FPI, those who can invest in FPI, that means listed entities. Listed entities in India till now, before 12th of June 2026, the foreign nationals could not invest directly in the listed entities in India. They had to get themselves registered in SEBI, then only they could invest in the listed entities in India. Now, with amendment from 12th of June 2026, amendment in 12th of June 2026, every foreign national can invest in the listed entities in India, and that increases the base of our financial markets hugely. I mean, as I said, from 32 million to 8 billion. And there are conditions which are required to be satisfied, that one individual cannot invest more than 10%. Aggregate of the individuals cannot invest more than 24% in the listed entity. And whatever we spoke about the reclassification of the FPI into FDI, that will happen. अगर 10 या 10 से ज़्यादा % हो गया तो उसको कहाँ क्या करना पड़ेगा? सेबी में जाके it will be required to be, it will be characterized as FDI, and therefore FCGPR will be required to be filed by the company, and the company will be required to give the permission of the investment as FDI. एक छोटा सा example ले रहे हैं हम लोग, and then we can wind off. ये example we can see, and because it will make everything more clear. The US-based family office with oh, it is showing only to me. So the US-based family office with no Indian origin shareholders or beneficiary wants to buy 3% stake in listed Indian IT services company directly in its own name on a repatriation basis. Before that, so the issue is that before 12 June 2026, this would have been impossible to directly invest in the Indian listed entity without being registered with SEBI. So now what is that? Under the third amendment rule, the individual, along with any type of individual, whether it is whether it is NRI, OCI or any other foreign national, they can invest in India's listed entities up to 10%. So before that, they could only come under the SEBI route. Now they can directly invest in India, like we invest in global funds through our HDFC account or any account that we maintain. Our financial markets are also open to the world, open to foreign nationals, that we can attract the investments from them. Yeah, you see the stock prices of few of these broking entities. So I had been, my tenure has ended, so I had been independent director with Choice International, and I have, I mean the way the share rose, like, yes, hugely. So as a FEMA due diligence of FDI, we can bifurcate it into entry and classification, then reporting completeness, pricing and valuation compliances, and the new thing that gets added, which was already there but is more emphasized, is governance and beneficial ownership. So any investment should follow these 4 quadrants for the proper investment legally and legally compliance. Okay, thank you. If you have any questions, I'll be happy to take. Okay. Okay, thank you.
Thank you, Sudha madam, for such a wonderful session.
It is my pleasure to introduce our speaker, CA Rahul Chheda. Rahul Chheda is a chartered accountant and MCOM with over 16 years of expertise in international tax, FEMA, UAE corporate tax, and cross-border regulatory advisory. He specializes in multinational tax structuring, global M&A, digital taxation, BEPS, and foreign investment advisory across diverse industries. A sought-after speaker at industry forums and tax conferences, Rahul is recognized for helping businesses navigate complex global tax and regulatory landscapes with strategic compliance solutions. So I request CA Rahul Chheda to deliver his session on compounding under FEMA.
Hello, good evening everyone. So this is like a last session for the day. I'm sure all the speakers during the day have, give you a lot of knowledge on the FEMA, various important topics. Compounding is a kind of a topic where, whatever contravention you would have done, in the other regulations which we have already spoken about, that is something how you can compound, what is compounding, and it is more of a more practical, and in terms of learning it is more theoretical, because in terms of the guidance available in the law is very limited. There's only one rules which are there. There are few FAQs, and there is a procedural aspect which is provided under the guidance for the FEMA. But it is lot more practical, because how you have to handle a particular situation at the time of compounding, that is more relevant. In this slides, I have tried to cover what is there in the regulations, and what are the practical ways, what are the procedures, etc., etc. But in real life, I would put it that it's more practical beyond what I would be speaking, during this session, because as you do more practice in this particular area, you would learn more about this. This is the kind of subject. Okay, so first, what is the regulatory framework of entire FEMA? I think everyone knows about it from first session we would be seeing. But why compounding is something which is there in FEMA and it's not there in tax law, or it is there in tax law but very limited way it is there. Why? Because earlier, the FEMA was FERA, where, everything was considered to be a criminal proceedings. Like, if anything violation which happened, it's like a criminal violation which was under, FERA law. I am sure that the seniors which is there in this room would have seen that particular era. At least I have not seen the FERA area. The day I have started the practice, FEMA was already in place. But FERA was, considered to be very draconian law, where it's more of, criminal proceedings. And now the FEMA has shifted towards more civil kind of a law, where if there are contraventions, etc., there are ways and means to, compound those, or, there are not so much severe implications. Overall, capital account, current account, I am sure everyone is aware about it. Administratively, the law is administered by the 3 layers. As Sudha also spoke about it, central government, RBI, and yeah, there is an enforcement director, which I am sure no one would have spoken about this part till now, because this part actually comes up along with the the compounding part of it. Whenever there is a violation and investigation getting triggered, then ED get involved, and that's the investigation authority for the FEMA. Now, firstly, what is compounding? Okay. So compounding, there, this is all this, whatever I have covered, this is there in the FAQs as well as the regulations, the rules which is there, compounding rules 2024, everything which is actually being defined in the regulations. Now compounding is basically a process of contravention of any rules, regulations, directions, notification, orders, act, and that you need to regularize either voluntarily or by force. So generally compounding is a process where it would be volunteer, and voluntary in a way that it's not that only voluntary by the person who has done the transaction. In fact, the compounding is also allowed when you receive a show cause notice from someone, like ED issues a show cause notice, but before the proceedings are initiated or any directions are being given, you can go for compounding. So compounding, basically, any contravention you do under the act, it can be compounded, barring few where, I'll cover in the separate slide that these are the contravention which is not, can be compounded. Now, there are two authorities which compounds the compounding. One is ED, one is RBI, because there are, where there are, so basically, ED basically comes into play where, you are dealing into a foreign exchange without involvement of the authorized person who is supposed to do in the forex, basically AD banker. So if you are doing any transaction without any banking channel and which is which is known to you, and you want to compound that particular violation, then ED is the authority to whom you have to go and take the compounding. And where it's other than a forex which is involved or any other regulation, then RBI is the authority which is compounds the offense. Now, what's the objective of putting the compounding in a FEMA? As I told you, it's a more practical law, and there could be very genuine, inadvertent reporting contraventions as well, and they want to make sure that the person who is taking such transaction should not be directly prosecuted, or any severe action is being taken against them, and that's where there is a compounding. One more aspect where sometimes it may happen that by oversight you have done some contravention, and because of that contravention your entire business would get struck, because any the exchequer can tell you that any foreign inward or foreign outward is not allowed for you. That's what I have seen in one of my clients' case where because of some investigation coming on them, they were not allowed to deal in any forex, and that was the order which they have brought. So that's to ensure that any such thing comes up, then you go for a compounding and make a closure of a particular thing, because generally in India any litigation, anything, it would take so many years. So it would be really difficult for the businesses to ensure closure of the same, and that's where the compounding can help to close the matter if you believe that it's a contravention at your end. And it's a voluntary disclosure and a self-reporting. So it's more of a transaction. Person who has taken the transaction goes to the authorities and accepts that this is the contravention and I want to close it by paying some fee. So rather than going into the prosecution, etc., it's a simple way just to pay the money and close out your any of the violation which you would have done for the regulations. Now law also provide that who can actually do the compounding, even within the RBI, within the ED, what is the quantum involved, at what level it would go, etc. This is more theoretical, but yeah, this is the way it would be. Based on your contravention, it would go to the particular designation within RBI or ED. Now, within RBI also, there are few contravention which is compounded at a central level, which is Delhi, and there are few contravention which can be compounded at a regional level. Why this is important is that when it goes to central, your overall process get further prolonged. When it's a regional office, through AD banker, the process is little bit more faster because you have a direct reach to the regional offices. And in fact, when you go for a post facto approvals, etc., before you go for a compounding, where regional offices are involved, your post facto approval before you go for compounding would be much more faster. And in fact, there is a recent change which has happened from a administrative perspective, is that ODI earlier used to go to the central wing at New Delhi. Now with effect from 1st April 26, it goes to the regional office. And that's something which is making, lot of ODI related transactions which would have been stuck with AD banker for, post facto approvals, etc., are, now getting moved because it's, moved to the regional offices. Now, I spoke about the post facto approval, but what's that post facto approval? So generally, before going for the compounding, you need to make sure that, all the contraventions which are being done are being regularized, in the sense that whatever actual regulations are there, whether it's a reporting related, whether if you have done anything which is violation, you can go for a approval that, this is not there in the regulation, but I've done this transaction, so give me the post facto approval, that you have to go to RBI. And there are cases where, RBI may not approve a particular transaction because it would be kind of a transaction which may affect the overall sovereignty of the country. And in that case, if you want to go for a compounding, you may have to reverse the transaction. In the sense, if you have made an investment, you have to divest those before you go for the compounding. So generally, this is kind of a prerequisite before you go for a compounding. If it's a reporting kind of a thing, then you can, do the filings and then go for compounding. If it's kind of a non-reporting, then go for a post facto approval. If you receive approval, you go ahead. If you don't receive the approval, first you unwind the transaction. And by unwinding the transaction, it does not mean that you still don't have to do the compounding, because you have done the violation in the past, and if you don't do the compounding, still there could be an investigation which can happen later on. So even after unwinding, whatever you have done in the past, you need to, compound those, or, face the investigation at the later point in time. Now, I think all these things are already being covered in the earlier sessions, but I would just try to put down few of the practical examples to, make this more lively. Otherwise, this would be more theoretical only, the way this subject is. So FDI, late reporting of FCGPR, FCTRS. So first there is, reporting related, and there are non-reporting also, like, if you have done any transfer, FCTRS is being missed to be filed, etc. These are the things which you can go for a compounding. Of course, there is one more route, which I will come to that in a later slide. Then, there could be cases where, you have not issued the shares within 60 days. Earlier it was 180 days, now it is being clarified to 60 days. If you have not issued those within that timeline, then, those can be a contravention. Pricing guidelines, as we all know, ODI, FDI, both sides, there are pricing guidelines which we have to follow if you have missed that. Deferment of consideration. If you have done any FDI transaction, there are 18 months which, which is there to, as a deferred transaction you can do. If you are not doing or closing the transaction within that particular period, then, there could be violation. ODI, late filing of FC, non-reporting something. Non-bona fide business. This is something which, many people are not paying attention, or maybe people are using this particular as a route. Like for an example, there are many big houses where, if you want to invest in an immovable property outside India, your LRS limit, stucks you. So then people use the ODI kind of a route, that you accumulate the money in an Indian LLP, and then, you do the investment overseas. But there, whether investment in a property, pure real estate is definitely not allowable, but people, try to make it a different color, and whether those can be considered to be a bona fide business, etc. Like, people actually show that it's a guest house for your director, which is doing a normal business, etc. So, whether it's a real bona fide business, that's something which one has to see. Financial services, of course, now it's more liberalized, but still, there are few concerns, and if there are any contravention around that. In incorrect modes of payments, there are specified modes of payment provided in ODI if you have not done that way, etc. Those could be the things. One of the reporting, common contravention which is there, whenever people do an ODI transaction, the new ODI rules typically talks about that whenever you subscribe to an MOA, that is considered to be an ODI. Before even if you send any a single penny to that particular company. So subscribing to MOA is a kind of an ODI. So whether at what point in time you are actually supposed to do filing of ODI 1, that becomes practically a lot of challenge where specifically in the countries where you can incorporate the company and then the actual share capital can go after some period of time. So that is, one will have to be aware of such things that you need to do a reporting first on a non-fund based commitment, and then actual whenever funds goes it would be second reporting. Of course LRS, there are multi thing, like if you have done any misreporting. So this is also a very classic case where earlier before 2012 around there was lot of unclarity where you do an ODI through LRS, whether you were supposed to do an ODI reporting, because at that point in time there was no requirement and LRS was not linked to ODI. So there were a lot of people which has done the investment outside and they have never filed an ODI. So and after that the clarification came that this is something which was covered under ODI, and always people were supposed to file that, but many people have not filed. So this kind of compounding is a route where you can regularize whatever we have done in the past, maybe knowingly, unknowingly, because there was no clarity in the law in the past as well. Of course, there are few other things, but yeah. The compounding which are not covered, okay, these are the specific bullets which is being provided under the law, that these kind of contraventions are not compoundable. Whether it's ED or it's RBI, both does not have a power to compound. One is where the amount is not quantifiable. Second is, wherever there is an illegal lawful holding of any assets, like, smuggling, etc., those kind of things. Even ED does not have power. They can investigate, but they cannot compound such offense. Any serious offense which involve terror financing or a money laundering, etc., those are also not compoundable. Any of the adjudication, any of the offenses for adjudication is already completed and order is already being passed for the adjudication, those are also not allowed. Here one more important aspect is that when you receive a show cause notice for such adjudication, you can still go for compounding. Before you receive the order, if you are going ahead with the compounding, those could be accepted depending on your contravention. You can do that, but yeah, once the order is passed, then there is no option. Then you have to go for an appeal, and it's more of judicial rule. Last is, wherever there's an investigation required, those are also not, covered for the compounding part of it. This is more of a procedural part, that how the compounding would practically work, how you have to do, what you have to do, and how you have to do. So first is, prepare a compounding application. There is a prescribed form, and as Sudha also mentioned, now there is a Pravaha portal. So at this point in time, it's an optional whether you want to go for an online or a physical application. But the way the overall regulations are coming up and the governance which is coming up, it's likely that physical mode would be discontinued in near future. But yeah, the advantage of having online is that if there are any queries, if there are any follow-ups, everything run through that particular portal, and that helps a lot, because otherwise in a physical application the overall timeline get a lot of prolonged, because RBI has issued something, they would give you some time, and the process get little bit more lengthier. First, prepare the application, pay the necessary fees. So without you pay the the compounding application fee, the generally, the RBI officer does not even start your, compounding process. Then, RBI officer definitely will scrutinize the details, the facts which you have already covered in your application. They would raise, follow-up questions, etc. They can also ask for a personal hearing. You can also put it in your application that I want a personal hearing, and you can go for a personal hearing. Discussion can happen, and then finally the order which is being actually passed, which is a compounding order, and where there would be a fee which would coming in, which is to be paid within 15 days. And if you don't pay that within 15 days, then it is, entire proceedings is as if you have not done compounding. So even the 15 days is really very crucial. If you, miss that particular portion, then overall, the process which you would have done as good as, it's not done. Yes. No, it has to be after the approval is received, because till the FCGPR is in place, the contravention is not regularized. Until it is not regularized, the RBI also does not have power to compound that. So first, you need to make sure that, and that's where, I'll tell you very practical thing, that most of the things before, people wants to go for compounding, but they are not able to reach that stage because the things get stuck at a AD level for the post facto approval. I think, a couple of sessions back, someone asked a particular question on the banker. It was some application is stuck at the AD bank. There is no option which is available. You will have to push your AD, educate them, and get those things done before you go for a compounding. Because so that's the requirement. So till your FCGPR is actually being approved by the AD, till such time it would not work. So I have a separate slide on that, but let me explain you that part. How it works is that there are two options which is available in the law. One is LSF, which I would explain little later, and second is the compounding part of it. Okay. Once you do an LSF, your reporting related violation get nullified. Then you don't have to go for compounding. It's as good as you have compounded your offense. Okay. Now, for going for an LSF, there is one of the condition that the LSF has to be filed within the 3 years of the due date of doing that particular compliance. So in your case, FCGPR, if you have already completed the 3 years, then you don't have a power to go under the LSF route. Then it's mandatory for you to go for a compounding route. Now, when you go into a compounding route, there are two ways. Okay, LSF has a separate process, which also is covered in my subsequent slide. And LSF is a process where you have to follow certain things, it would get closed. Now compounding is a separate process. When you have breached the LSF 3 years, you are falling in the second bucket, and within that bucket you need to convince your AD banker to get an approval from an RBI for delay in reporting this particular thing. So when you do that, then only you will go for a compounding. So you are falling in the second bucket where you need to push your AD. AD would say LSF part you are not covered in LSF, so that's a complete different route. But yeah, for compounding also you need to get post facto approval, and only after you get the post facto approval you will be go for the compounding. Yes. You have to, reach out to your old AD only where you have filed the FCGPR. Okay. So if in that case, you have to go with your existing AD, explain your entire case, and AD will have to take your case to the RBI on a specific case, and then it would happen. Ideally, if those bankers are still in place, but only the customer's relationship is not there with that bank, then that bank only have to, complete the entire process, and customer will have to influence in, some or the other way with that particular AD. But in your case, if it's the case where the banker itself is not in existence, then, the existing banker will have to go with your case to the specific case to the RBI and then get the post facto approval. Yeah, the power is with them only. They will have to convince to the, the RBI. And post facto, practically speaking, most of the things get stuck at the post facto thing where, there are multiple contravention. Then even the AD are little bit reluctant to go for, to the RBI, because in some or the other cases, there would be some lapses at their end also. Because generally the way our regulations are and the reporting requirement are, anything cannot be contravented without, AD's, practically speaking, not technically, as Sudha also said that, AD banker is nowhere responsible for the checking the regulation. It's the person who is doing the transaction. But yeah, practically speaking, what happens is that AD is the checker, and when when you go with some post facto approval, you would come to know that there is some or the other lapse, maybe a small lapse, which would have happened from the AD, and therefore they are also not fully, that much in control to, yeah, let's go ahead with RBI, because RBI may question them, their processes, etc., and that's where the things get stuck. But that's the way it is. We will have to, explain our case in more detail with more facts to the AD, and then AD can put up the case to the RBI. These are all, very basic things in the sense that what are the filings requirement. It's 10,000 rupees with GST you have to pay. Application should contain, the name, telephone number, email ID. Why I've, covered this in this particular slide is that the rule says that if any of these things are missing, your application is not accepted. So even though it's very, a very small thing, but because it's a requirement within the rules that all these things you need to provide in your application. If it's not there, then the RBI may say that you provide this detail, or they may say that the application itself is incomplete, so we will not move it for further. So these are the basic details, but yeah, this is something which is required. Of course, the copy of MOA, if it's a company, there is a specific undertaking which you have to give, which says that, you don't have any inquiry, investigation with the DOE. As I spoke, if there is any administrative related, things which is missing, it is incomplete application and they would not start. And RBI may allow you, to provide those additional details, etc. But, there is a timeline on the RBI to close any particular application, but they would start that timeline from the day you submit everything. So even if the email ID is missing, they would consider this as an incomplete application, and when you give the email ID, after which, the 180 days which is there to close the order would start. How RBI, looks at, any compounding application. So, generally speaking, it's a suo moto contravention, in the sense that you are going suo moto. So, in a way, you are guilty. That's what you are accepting before the authorities. Generally, if you have, not done that with, having an undue gains, or, it's not, your intention is not to do any loss to any exchequers, etc., or it is not a repetitive contravention. This is also very much important. Rule says that whenever you go for a compounding, you are allowed to do compounding only once in 3 years. In the sense, after 3 years, it is kind of a thing that, yeah, now it's neutralized, now you can come for the compounding. So, whenever, suppose for an example, you have gone for a particular compounding. Now, in compounding, you can report 10 different regulations also, ODI, FDI, LRS, ECB, all contravention. You can go for a one application. Okay, yeah, I have done this thing in my FEMA, so please, compound everything. But once, a compounding is being filed, next 3 years, you are not allowed to do also any compounding. So then, ED risk in during that particular thing is, very much high. So there, generally, whenever we go for an compounding, we make sure that there's a proper due diligence happen on a particular client before we go for a compounding, because you may have come across an ODI related contravention and you are preparing some your applications, but then the client would have also done some misreporting or export delays, etc. And in those cases, it's better that all contravention is being covered in one application, and that's where this is important. And from an RBI perspective, it's not the exchequers or the RBI officers are not like an income tax officer. To be very honest, they are more commercial minded. They actually understand what you want to put across. So your facts has to be from a business side, and to make sure that the forex of the country is not affected. So their only objective is to see that how they are able to have their forex for the country in more places. That's the only objective. But yeah, they are more business minded. They are not like an income tax officer, not like a typical bureaucrat. So that's the RBI perspective on the compounding part also. As I mentioned, compounding 180 days. Once you have all the applications, all the documents in place, 180 days within which they would compound the matter. They would give you an opportunity. You can go and explain your case with your facts, etc. And once you explain, then the order would be passed. Okay. Now, generally orders, would actually cover that what all rules, regulations you have actually violated. And in fact, the expectation of the RBIs are that when you are doing your application, you actually put down that these are the regulations which you have actually violated, and those are also being captured in the orders. One thing which is a kind of a update in 2020 was that earlier what used to happen that all the compounding order was getting uploaded on the RBI website as is, where lot of facts which were not required to be known to in public domain were getting disclosed. In 2020, they came up with the regulation, and now what they are doing is they are summarizing the things and then uploading. It's not that normal orders which are available in the public. And one more thing which even if you are referring to any compounding order for any of your client case, it's not like an income tax order which is binding. It's not like that. It can be more referential, where you would understand that what kind of contravention, how the RBI officers are looking at those contraventions for compounding part of it. But it is not binding on anyone. It's more of one-on-one who has filed the application and the way it is being compounded. Yeah, as I told, within 15 days you have to make the payment, and not only make the payment, once you make the payment, within 2 hours you need to report to the specific way which is being provided, like an email ID they would get you in the order itself, where you have to report that I made the payment. This is kind of a process, and this has to be adhered to. If you don't report, even if the mail is not being sent, then there is a possibility that the compounding which is already being done, they may not consider that as a compounded order. Pravaha portal, this is more of digitalization of the entire process which is there. And at this point in time, there is an option in 2025. So earlier, they come up that all the application has to be routed through Pravaha, but they realize that the portal is still evolving. It's not capable of the overall governance, and then they started even the physical filings, and at this point in time both is being accepted. Yeah, so this is more of again just a procedural part of it. Pravaha portal or a physical portal, entire application, all the details, more the facts, better the application would be. Undertaking, copy of PAN, cancelled check, MOA, AOA, latest audited financial statement of the company, and 10,000 rupees, the proof that it is being paid. These are the things which is to be, given along with the compounding. This is more of a regulation. So this is, I would put it that this is something which is available in the rules itself, but it is, actually a guidance. So now, earlier what used to happen, this is the prior to, 2020, where, this compounding matrix has been come in the regulation. Earlier what used to happen that each of the case, RBI officer have their power and they were computing the fees in a various different manner as per the commercial understanding which they had with respect to a particular fact of the case. Now what is being happened is that now the rules itself provides, if these kind of contraventions are there, then this is the fees which you can expect. And this is the maximum fees. Practically speaking, none of the RBI officers, if your case is genuine, your facts are genuine, would levy the full fees. It would be always lower. And this helps, also to the clients, to understand that when I'm going for the compounding, what number I'm looking at. Ultimately it's always a commercial to see that when I'm going to the authorities, what is the maximum amount which I am supposed to pay, and this actually helps for the client to take a decision whether they want to go for a compounding or they want to stay as is. So that is something which is there, and each of the regulations, like for an example here, FDI, ECB, ODI, etc. If there are contravention, there is a fixed fee and variable fee if it's a continuous offense. So it would be even some offenses are such where it's continuous offense and you don't compound that and remain open, then your amount of compounding fee which you are exposed to every year would get increased to that amount. Like a reporting is required. Now if you have not done it, you are not doing it year one fee, year two there would be an additional fee, and that's where the way it is being, entire compounding matrix which is there in the law, there is a fixed fee and then there is a variable. This is LOBOPO, 2 lakh, up to 10% of the cost which is there. Of course, the AAC, APR, FLAIR, share certificate, all the submissions or the reporting related thing, 10,000, and it can go up to 300% of the amount invested. These are more with respect to the contravention where shares were not allotted. Then these are the percentage of the amounts which are involved, and fixed fee. Just one more aspect I would like to add is that when you are going for a multiple contravention together, okay, there are a lot of questions that for a fixed fee, whether you need to consider each of the contravention separately or it would be total. Like for an example, here the fixed fee is 10,000 applied once each regulation and rule contravented. Now within the rule, within the regulation, you would have done 2 contravention. Whether you need to pay a 2 fees or it would be 1. That is something which is kind of an open point. Generally, given that it is each regulation, each rule, then it would be per rule which should apply. That's my personal view, but yeah, that is always a debatable part that how to compute that. But as I told you, this is just a maximum fee. Practically this is not the number which is comes on any of the compounding order, but yes, this is something there which is there in the law. Now the above part of it, each of the regulations which are there, each of the fees which are there, and then there is any other contravention which is there, like for an example capital current account transactions, etc., which is not covered in any of the above rules, then it would be covered in this particularly. There also there is a fixed fee, there is a variable fee. Few of the things which we should be aware of: overall compounding fee can never go beyond 300% of the amount contravented, because that was the penalty which is there in the FEMA Act also. So it cannot go beyond that. There if the contravention is less than 1 lakh rupees and it's a reporting related contravention, then it cannot go beyond 5% of the amount which is there, and if it's non-reporting, then 10% which is being provided under the law. Last bullet, wherever there is a months or a years which is involved, like for an example 10 years 7 months, which is the delay. So whether you have to consider 10 or 11, so they say that you have to round off, so it would be 11. If 10.4 months is there, then you can compound at 10 months, 10 years. LSF, I think this I already spoke about. This is an alternate mechanism which was, introduced. LSF was initially introduced in 2017, 2019, and that was only with respect to the, the FI, ECB, and ODI, OI related, regulations. But later on, it was expanded, and as on today, it is, applicable for any reporting related violence, violation which you would have done, any reporting related violation. Then it's not mandatory for you to go for a compounding. You can just close it through LSF route, and it's very simple route because every power is with the AD itself. He has to just take down those reporting part of it, and there is a process where it would report to the RBI, and RBI would send an email directly to the person who has done the contravention. He has to just pay the LSF, get the acknowledgement, and the things get closed there. So this is a route which is available where you don't have to do for a compounding, but yeah, any late submission of the reporting can be go under an LSF route. These are all the filings which are covered under LSF. Almost every filings which are required under the Act. As on today, everything is covered. What are the fee which is there under LSF? So if it's a periodic reporting, like for an example, APR, FLA, ECB2, which is now, still not periodic, but yeah, those kind of reporting where it's a periodic reporting, then it's a flat fee of 7,500 per form. So you can pay that and close it. And if it's kind of a transactional reporting which is being missed, then 7,500 plus 0.025% of the amount involved multiplied by number of years for the delay. So this is the LSF fee for any reporting related contravention. This is the route available. Only condition, as also I mentioned earlier, is that that has to be done within 3 years. So if you have missed that 3 years, then you don't have an option but to go for a detailed compounding. Process, quickly, it's very simple. Basically, you need to report the form to the AD banker. AD banker would, provide that form to the RBI. RBI would acknowledge the receipts of a provisional form. They would approve and then will issue an email for payment of LSF within 30 days once they acknowledge to the concerned person. They will have to pay, and within 2 hours once it is being paid, you need to report to the email ID of the RBI that this is being paid. LSF or compounding decision making, very simple. If within 3 years any reporting contravention, go for an LSF, or you have to go for an compounding. Difference, LSF is more simple, formula driven, very fixed fee, very basic fee. Compounding is, a detailed process, lot more thing. And LSF can be, closed within few weeks also. It may take, 6 to 8 months. 180 days is something which is there to pass the order. But to go for an compounding application, you have to, regularize everything, post facto approvals, and all those things. It may take 3-4 years also. That's my practical experience, because generally, based on your contravention, it becomes really difficult to get, post facto approvals, etc. Of course, reporting is something which is simple, where you will be able to get it easily. But yeah, the more the complicated facts, it would be more difficult. Very quickly, compounding and adjudication. So this is, compounding is a kind of a process where you suo moto go for it, and you are able to, accept that I am guilty. I'll pay the fee and you please forgive me. That's the way it is. Adjudication, it's more legal process where investigation wing would actually do a detailed investigation on what has gone wrong, what you have done wrong, and then they would pass a detailed order where, it could be even the prosecution which can get triggered, etc. So it would be more ED driven process where there would be a detailed adjudication or the detailed legal process which would be involved. And of course, once adjudication is done, you always have an option to go for an appeal before the courts. from a regulation perspective, this is more theoretical. Compounding is covered in 15, adjudication is 13 to 16. And after adjudication, enforcement director, ED get involved, and they would have their own detailed proceedings, which is provided, a separate sections which are there, all their rights, etc., which is there under the FEMA Act. Yeah, thank you for your patience listening. I know it was like a more theoretical session, being a last session, and the subject is very such that it's more practical when it comes to facts. So
thank you also. Thank you, Mr. Rahul Chheda. It was a wonderful session. As we come to the end of our long and rich day, I would like to thank to all and everyone who has. It is my sincere thanks to all the 6 speakers of today: CA Darshana Jain, CA Sudha Bhushan, CA Anuprita Mehta, CA Palav Shah, CA Ankita Shethia, and CA Rahul Chheda, for so generously sharing their time and expertise with us. Each session today reflected not just the technical depth but the real practical insights. I would like to thank the WRC for organizing such a wonderful seminar and giving us opportunity to bring together such a comprehensive view on FEMA on a single day. My thanks to all the organizing team and volunteers who worked behind the scenes to make today's run smoothly. I finally thank to all of you, all the members, for your attention, your questions, and your giving up a full day Saturday to invest in a professional knowledge day. I hope you leave today with not just the 6 CPRs but the wonderful knowledge on FEMA. With this, I end the session. Thank you very much.